As well, working our way up there, Barclays and TSB very much in focus. We know TSB currently owned by Sabadell, which is, of course, pushing the deal or the hostile takeover bid from BBVA. Some reports that Barclays may be interested in that takeover. We'll see how the market interprets that in just a few minutes. And Nestle as well in focus, Anna, getting a change of leadership, this time from Inditex.
Okay, so food to banks to shipping, very much in focus, and really interesting comments from the Shell CEO, which we'll get to during this hour, of course, around the Straits of Hormuz and the impact that any disruption there would have. So European equity markets open now. The FTSE 100 just a touch to the downside. Maybe that's not where the focus is going to be in terms of downside, though, because we've seen oil prices going higher. We see gas prices going higher this morning. Some iron ore moves to the upside too, and that typically would support the London market at least a little. There could still be downward pressure, of course, coming through from the Fed narrative and the geopolitical concerns. So all of that could add up to a slightly more resilient FTSE 100 than the rest of the markets. That's what the futures were suggesting, and that seems to be what is transpiring here. So the FTSE 100 down by 0.3%. Elsewhere, down more than that. So the DAX and the CAC 40 then, Chrissy, down by 0.6%. So we're dealing with, yes, the geopolitical concerns, but also a little bit of an adjustment, perhaps, around the Fed and our expectations of how sticky, how much the Fed is going to be focused on the inflation dynamics from here.
Absolutely. And of course, as we digest through that weakness that you're seeing in the broader markets, Anna, as expected, it's not showing up in every single sector. You are seeing broad red across the screen. But if you look at the energy sector, that's where you're trading the outperformers. No surprise there. The geopolitical risk certainly magnified in terms of risk sentiment from the broader index perspective, but also to the upside when it comes to some of these individual movers. So I'll go right to it. Shell, BP, your typical oil majors, and Total even moving this market higher, working against the grain here. We know we heard some comments from Shell as well in terms of preparation around some of the oil transportation costs as well. That's in direct reaction to risks around the Strait of Hormuz. But the rest, Anna, a very risk-off day, a very low volume, light liquidity kind of day.
Yeah, and it's interesting that energy and basic resources move in the opposite direction. So energy names, yes, absolutely moving higher this morning. That is the only sector in positive territory. So energy stocks up by 0.5%. Basic resources, the worst performing sector, that's down by 0.9%. Rio Tinto is weaker. Antofagasta, Anglo American and the like, they are all weaker this morning. And I think that's interesting, given that I think earlier I saw that we were a little firmer on iron ore prices, but just pulling that up now. Yeah, we are up by 0.7%, but that's not what's driving things. I suppose it's a sentiment trade.
Absolutely. And we should mention that there is a dollar component to all of this. In fact, you are seeing a dollar strength story today as well, and it coming in tandem with some strength in the oil sector as well. We tend to see that together. It signals signs of stress in these markets, which, no surprise, is probably feeding into that risk sentiment. So how do you navigate it? Let's bring in an expert here this morning. Nanette Heschler-Fader, Lombard ODA's EMEA CIO, joins the program this morning. Nanette, a pleasure to have you on the program. Thank you for joining us. We're trying to weigh all of these geopolitical risks and what that means for the equity markets. Walk us through your initial take of how we should be thinking about it.
I mean, it's obviously always a very tricky situation because when relying on the past, these type of escalatory movements in geopolitical terms tend to be transitory. And therefore, in terms of strategy, at the moment, we have certainly navigated it by keeping a steady hand understanding where we have in the strategy diversifiers. So we have held to a relatively constructive global equities view together, however, with an overweight in fixed income in case we are having a risk-off period. Government bonds, in our view, would be helping. So diversifying the portfolios at a time when there is a lot of uncertainty, very fluid situations, is just a very basic thing to start with.
Nanette, at the core of this, in terms of how the markets are viewing not only geopolitical risk in the Middle East, but also the trade negotiations that are happening in the background with the United States and other countries around the world, is ultimately the inflation risk. And we heard from Jay Powell that ultimately those risks are to the upside and really bolsters the case not to cut. But Nanette, the market is still pricing in 2 cuts from the Federal Reserve by the end of the year. But that's priced into the bond market. Is it priced into the equity market from your point of view?
I think that at the moment, it's really quite consistent with the fact of this transitory nature of inflation risks. In particular, when you take a look at the 10-year break-even inflation, so a long-term inflation expectations measure, it's been extraordinarily stable. Bond market is pricing the pressures from the tariffs, for example, as something that is transitory and that will wash out over time. Not too dissimilar from an increase of VAT, for example, which is a little bit more usual for other times and other markets. And then I think that now, with respect to the energy prices, what is really critical is that this very tense situation indeed remains transitory, because in the past, prior to the escalatory moves here, energy prices have been on the way down. So that is certainly something that we will have to validate over the coming weeks in order to continue having a bond pricing of currently transitory inflation moves higher and then stable long-term inflation. This needs to be validated.
Nanette, let me just park the conversation around rates for a moment. No doubt we'll return to it. There's a lot of central bank news this week. But I just want to ask you about geopolitical nervousness and how that's feeding into your thinking here. Because the big question for markets right now seems to be whether we see the US getting more involved in or directly involved in Israel's war with Iran. Maybe this all will depend on the extent of that involvement and what narrative goes along with that. But which are the assets that you're going to be watching for here? I mean, the obvious ones around oil and gold, of course. But then I'm interested in what the dollar might do, other havens, because we actually see the dollar on the rise a little bit today.
Yeah, it's always very difficult to base an investment strategy and also views on geopolitics, because these geopolitics can just change fundamentally from one day to the next. So I'm not paying too much attention now at the short-term movements here. I think that in the immediate, if there was an involvement of the US, it would definitely be detrimental to risk assets, because that is just yet another stage in this conflict that is going to spur risk sentiment. I would expect the VIX to increase, so volatility of US equities to increase and reflect that just increased overall geopolitical risk. I would also expect safe havens to immediately react. You mentioned gold. That's a natural safe haven, although it's been really going the other side in just the last 24 hours. In spite of escalatory comments, for example. Another safe haven is absolutely the Swiss franc in the currency. On the currency side, perhaps even more than the US dollar, the Swiss franc would probably rally. It's very relevant because today the Swiss National Bank is having its mid-year policy review, and it will have absolutely an implication for interest rates and for investors in Switzerland as well. And then within equities, what are the type of assets, if you like, that would be on the one hand the most negatively impacted is those that are in economies that are very exposed to higher energy prices. So these are typically European economies, but also some of the Asian economies. So we should be expecting some downward reactions on those, while energy stocks on the other side, you mentioned it in the opening, would be just benefiting from just higher prices for now.
Okay, great. So those are some of the things we should be watching for. I'm actually looking at luxury stocks a little bit weaker this morning, Nanette, and we saw some data around Swiss watch exports falling 9.5% in May, and this being attributed to the US downturn. I wonder if that, as a theme, has further to run, some US weakness at the luxury end.
I think we have to be careful. There is certainly some noise in these data that is coming also from the tariffs. What of the orders have been just front loaded, and what is just the month-to-month change here. So I'm expecting that on the luxury segment there is still some impact from the whole trade policy uncertainty from the United States. But coming back to the current situation, I mean, if there was an escalation really to the next level, that would disrupt the trade of oil at a broader scale than what we have seen so far. It would have an impact on the overall global economic growth, and any sector that is cyclical, like luxury goods, like also you mentioned materials, for example, very cyclical area and sector in equities. These would all probably have a reaction that is reflecting slower growth.
In an era of slower growth, though, Nanette, how are we thinking about the narrative, or how are the clients you're speaking to thinking about the narrative that Europe is still potentially an outperformer relative to other international markets this year?
I mean, Europe tends to be cyclical. We refer to it as a high beta market within developed markets. It's a bit like the big Asian cyclical market. So if you're going to see an overall slowdown, those markets that are particularly cyclical, take, for example, the DAX in Europe, which has a higher component exposure to industrials, that would probably come back from the extraordinary performance that it has had since the beginning of the year. And then within Europe, there are obviously some markets that are much more domestically focused and that are not so, in the end, so cyclical. Some of the peripheral markets, for example, in Europe, whether it's Spain, whether it's Italy, these are some examples that might actually decouple a little bit. So we will have to make distinctions of cyclical markets, just according to how much of it is domestically driven versus how much of it is exposed to global growth.
Nanette, thank you so much for your time. Nanette Hechterfeld, Lombard Odier, EMEA CIO. Let's look at the core six then. How are these heavyweight stocks in Europe performing this morning? We've talked about some of the weakness in the luxury end of things, and you see that there represented with LVMH. We're going to get some more analysis a little later in the program on that particular sector. That's the worst performer in the core six. Tech also a little on the back foot, down 0.9%, but really most sectors in negative territory as we see Stock 600 down by 0.6%. Let's get a check on the individual stocks this morning that are on the move. Joe has a rundown. Joe.
So one sector looking really weak today, Anna, is recruitment stocks. We've got an update from Hays here in the UK. That stock declining 14%, really negative commentary around the staffing market, not just in the UK, actually across all of their regions, pointing to Europe, pointing to Germany, Asia as well, and North America. So really negative commentary in terms of both their fees and the demand for their services. And we're seeing a feed through into Page as well, not just in London. We're seeing it feeding through to Randstad over in Amsterdam and Adecco in Switzerland. Big moves across that sector today. Recruitment really weak following that update from Hays. Then we've got the watchmakers, and I mentioned that one earlier. We've got some data out of Switzerland. Exports, some of the sales looking like double-digit declines on some of those markets. So we are seeing weakness in Swatch, the big company over in Switzerland, as well as Richemont, also Swiss listed, of course, the maker of Cartier watches, and also Watches Switzerland a little bit lower as well. Then we will turn as well to an area we don't look at too much is Swedish forests, because Stora Enso potentially going to be spinning off around $7 billion worth of Swedish trees, according to a statement. Now, that stock gaining 14%, that is actually the best performer in the entire European market today. Now, a lot of these packaging paper companies, they actually own the forest where they get the paper, so it's pretty interesting when you dig down to it. But that stock getting a decent boost, up around 14% at the moment for that one. And then another big gainer over in Paris, Eutelsat, news that they've got a deal with the French military on satellite services. Remember, this one was in focus when there was news around Starlink and Elon Musk and potentially the US pulling out support for Ukraine, and there was a lot of volatility in this stock back then. It rallied a lot, and now we've got news of this deal. It's potentially worth around $1 billion for this pact with the French military. So Eutelsat really rallying today. And finally, Whitbread, that was a difficult one to call at the open of trading. We are seeing it down. Now, the UK did look soft. The UK sales were down a couple of percentage points. Premier in, well, everything is Premier apart from the share price. I think we've done that one before, but I'll do it again. Germany looking pretty strong, but Whitbread declining today, saying their 5-year plan is on track, but shareholders not taking much notice. That one is weaker in London today.
All right, Joe Easton from our equities team, we thank you so much walking us through some of those early movers. But as we look at this market, there are a couple of luxury names that are weighing the entire market down. LVMH at the top of that pile. We're going to dive into that company next as they confront one of their worst crises in their history. We're going to break down the challenges at the luxury giant live out of Paris. Stick with us. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
what is particularly challenging right now is some of the jamming that's happening on GPS devices and the like, which is a concern. The Straits of Hormuz is, at the end of the day, the artery through which the world's energy is flowing.
Shell CEO there speaking to Bloomberg's Sherry-Ann at the Japan Energy Summit, an exhibition that takes place in Tokyo, and really setting out the stakes in terms of the oil market specifically around the Straits of Hormuz and the future developments in that particular region. Let's talk about the oil market and what we're watching for now. Bloomberg's Stephen Snapczynski joins us. He's at that same energy summit in Tokyo and can join us with thoughts. So, Stephen, really interesting to hear the CEO of Shell there responding to increased risks and tensions, thinking about what the Iranian reaction function might be if we saw U.S. involvement in this war. Talk us through your thinking around the Straits of Hormuz right now.
I think the market is looking at this as one of the high-risk areas. It is clearly something that if we do see any impact on the Strait of Hormuz, you're going to see a rocket up in prices. Some banks saying that Brent could go to over $130 a barrel from where we are right now in the $74, $75 range. Now, the Strait of Hormuz is not blocked at the moment. Flows are continuing, but that risk does remain. And while it does, still, it's a remote risk. There are fears that there could be delays or there could be impacts, or even if the situation were to spiral, Tehran could decide to start to strike ships going through the strait, which they've done in the past. Now, you have seen some precautions being taken. You know, we just had Shell here. He was speaking about how that company itself is also taking precautions. Meanwhile, you have Qatar, the world's second largest LNG exporter, telling ships coming there to load for LNG to wait outside the strait until a day before the actual loading to avoid any sort of risks there. And you have some Japanese ship companies also warning their vessels to watch the area as well as avoid going too close to Iran.
Stephen, this is compounding shipping issues in the Middle East when it comes to the Red Sea already for likes of Maersk, Hapag-Lloyd, and of course the tankers there as well that are already using alternate routes. At what point do the alternate routes, which require more labor, more fuel, get overused or saturated? Is that a risk at all?
You know, it is something that the market has been looking at. And when the Red Sea shut, that was one of the issues as well. I mean, not shut, but when a lot of shipping companies decided not to go through the Red Sea anymore, it was an issue that we were worried about, that potentially you could see shipping rates kind of skyrocket. Now, that happened at an opportune time because there was also a lot of new tankers, a lot of new carriers coming into the fleet. So it didn't result in a jump in prices or a shortage in vessels. Now, of course, the Strait of Hormuz, while it is a key waterway for the shipping of oil and gas, the risk isn't so much shipping itself, it's actually getting the fuel to places. It's about a quarter of oil, seaborne oil shipments, 20% of LNG shipments. So while, and the thing is, there are no alternate routes there. I think one thing to look at is insurance rates. You know, around the Middle East, as you're having the Red Sea, as you have Strait of Hormuz, the whole region is becoming risky for shippers. So is this going to be an issue where insurance rates increase? Is this going to be an issue where ship owners say they don't want their vessels in that area? I think that's the real risk that threatens higher vessel rates and could increase transportation costs.
Yeah. Stephen, can I just go back to the Straits of Hormuz, because I think there's such a preoccupation for markets, and go a little deeper into what kind of disruption we might see there? Because we talk about this as if it's a sort of binary situation, either it's open or closed, but actually things might become much more complicated than that. You've mentioned how there have been attacks on ships in that strait in the past. There's previous there, and shutting it entirely might be very difficult given the presence of the US military, for example. So what specifically will you be watching for?
That's a really good point, because you wouldn't be able to just shut it. One, it might not be physically possible, is one thing that I think the market has been kind of digesting. It's large. So how would you shut it? Would you sink a ship there? You know, ships could probably still go around it. It's not like when you had the Suez Canal shut because a ship was stuck in the middle. This is a much larger waterway. at the other end, you have other countries on the other side. Iran's on one side, you have Oman on the other, and you also have the UAE. So, they have their own waters and they're able to protect that as well. You mentioned the United States could come in. Now, how does this actually play out? I think the most likely scenario is probably if Tehran or Iran were to start attacking ships, you could see those vessels connected with the United States, Israel, and other countries in that alliance maybe avoiding the strait. You would still have maybe Qatar or other neighboring countries continue to send their vessels through, but maybe you'll have a situation where you don't have vessels that have connections or clear connections with the United States or Israel in the area at all. Another risk could potentially be that maybe not shutting totally, but there could be delays to loading of oil and gas itself.
Steven Sepchinsky joining us this morning out of Tokyo, walking us through some of the risks around the shipping sector. We thank you so much, as we have one eye on the risk in the Middle East. We also have an eye on the luxury sector this morning, selling off in a very big way. A 220 billion euro slump in market value, heaping pressure on LVMH founder Bernard Arnault. A widespread luxury slowdown and succession concerns, adding to what one analyst is calling, quote, the biggest crisis in the firm's history. Our very own Angelina Rascoway wrote a big take on this. She joins the program now. Angelina, just walk us through very quickly the challenges at LVMH.
Hi there. Indeed, I mean, we know that the industry is under pressure, whether it's coming, where it's troubles coming from the U.S. with the threat of tariffs that are impacting consumer confidence, or also the downturn that we've seen in China. But there are internal issues at LVMH, and that's notably at two key assets. That's Dior and also Moet Hennessy. So both of them have been, culprits of hiking prices too much over the recent past, and now there's basically what we're noticing is that there's a consumer backlash. At Dior, which is led by Delphine Arnault, so that's Bernard Arnault's eldest child, there was also a supply chain scandal last year that generated a lot of bad press. So in the past, since LVMH shares reached a record in April 2 years ago, they've lost about half of their value, but that hasn't prevented Bernard Arnault and his family from buying the equivalent of more than €1 billion since the end of January worth of their stock.
Okay, so a lot's changed in 2 years, Angelina. Talk to us about the conglomerate discount then that is applied to this business. Is that how the market is thinking about it?
Yes, indeed, Anna. I mean, LVMH is a conglomerate with 75 brands. And when you have a rising market, investors are more willing, perhaps, to ignore that conglomerate discount. But once it starts shaking, they pay more attention to it because they're invested in very different industries. If you think about hospitality, they have hotel chains, but also they own restaurants. Of course, they own fashion and leather goods and wines and spirits. So all these are very different assets with different levels of margins. And what we found out during the reporting is that about 3 years ago, they explored the listing of Sephora in 2021 and listing it in Amsterdam. And about 2 years ago, Diageo, which has a stake in Moet Hennessy, they also asked to study the potential listing of Moet Hennessy, but that was dismissed by Bernard Arnault.
Angelina, thank you very much. Thanks for joining us, Angelina Rascoway, on the subject of luxury, and her big take story is available on the Bloomberg terminal and on the Bloomberg website, of course. Coming up on the programme, we'll get back to the central banking conversation. Some economists expect the SNB to lower interest rates to 0 today. Many do. Most do, in fact. We'll get the details. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
As expected, the Swiss National Bank cutting rates to zero by the tune of about 25 basis points. Immediately, you were already seeing a little bit of strength, actually, into the Swissy this morning against the dollar and against the euro as well. But remember, this was the consensus expectation from economists. We know the Swiss National Bank has really been dealing with a real severe decline when it comes to growth in Switzerland, also trying to navigate some of the currency story there, as well as geopolitical risk around the world starts to bolster flows into the Swissy. I want to bring in our very own Valerie Teitel to walk us through how we should be thinking about this, Val, in the lead up to this moment. There was maybe not a consensus thought, but a risk that we would go into negative territory at the S&B.
Yeah, they, I guess, declined to do that, failed to surprise, but we did return to zero rates, so we're still at the zero bound, which is, again, quite a surprise, being it was only just, 3 years ago that they did leave the zero bound and go into positive rates. But again, you know, there was definitely arguments out there, Kriti, for them to cut by more than expected today. The basic one is, given the fact that the S&B only meets 4 times a year, if they want to keep pace with the ECB, it really warranted an extra cut today, and especially given that they want to tamper the Swissy strength. And if they want to keep doing that, one tool in their toolbox is to lower rates by more than the market expects. Given that the Swissy has strengthened by more than 11% versus the US dollar, which is really posing risks of deflation in the country.
And Mark Gutmore earlier raising the question of whether this will even make a difference, whether what the S&B does can make a difference on that front, because a lot of the flows into the Swiss currency, of course, are around geopolitics and around risk haven. I'm drawn to a line that I know will be interesting to you, Valerie. The S&B says it's prepared to intervene in currency markets if needed. Now, that's interesting, isn't it? Because there's been some recategorization of the Swiss and what they're doing with currency by the US administration.
Yeah, that's right. I don't think the Swiss want to stand out as being tagged anything further than a currency manipulator, but it was just in the last U.S. Treasury report that they were put on the watch list as being a currency manipulator. And look, if the Swiss National Bank is out there claiming they have many tools in the toolbox, rates is one, FX intervention is the other. But I see a quite big hesitancy for them to want to intervene in the FX market in a big way because there, frankly, will be blowback from the U.S. administration if they do that.
I think as we've been kind of digesting these numbers, you've seen a bigger move in the Swissy here. You can see it on the screen, a fairly now in positive territory. But Val, there's no more room to cut for the S&B. So if things do worsen here, I'm curious what we can learn from the S&B that applies to a Federal Reserve that's hesitant to get rid of that ammunition, a BOE, even a BOJ that's dealing with some of those risk haven moves.
Well, look, it was only a few months ago that the S&B did remind us that negative rates are in the toolbox. So in still some way, maybe they do have some ammunition, but they're maybe just less or more hesitant to use it, given negative rates do pose quite odd issues for the banking sector, for deposit rates, et cetera. But again, you know, look, we're seeing the currency strengthen off the back of this is something they probably didn't want to see today, given how much the currency has strengthened. And again, you have to tie in the Middle East tensions all into this. Let's say that we do get an escalation in the Middle East and you get more safe haven flows into the Swiss franc. That's going to be a big problem for the Swiss economy, who is already projected to be in deflation later this year.
You mentioned the ripple effects from the S&B as well. We should also mention that this morning there were questions about the stability in terms of UBS and that they didn't actually pass the stress test that the S&B put, and a lot of that has to do with capital requirements as well. So in addition to dealing with the financial market repercussions, Anna, there's also this question of how the banking sector is going to be dealing with it. But the S&B is not the only bank in focus today, the BOE as well.
Absolutely, and Valerie Teitel will stay with us as we think about what happens at the Bank of England. We've heard from the Fed, we've heard from the BOJ, the SNB, the Bank of England on deck later today. Matthew Swannell joins us, Chief Economic Advisor at EY Item Club and former MPC Advisor to the Bank of England, so a great voice for us to speak to. Good morning to you. Matt, thank you so much for coming in. So do you see the decision as complicated and difficult at the Bank of England? I mean, today's expectation seems quite clear. We expect no change in policy, but the dynamics around the UK economy, are they getting increasingly challenging?
So I think you're right today, clear hold. The big difference comes August and into the latter half of this year. And I think if we look back to May, the MPC have been clear. They're looking at UK disinflation and trying to gain a little more confidence in their forecasts. Now, what do we need to see that come to pass? Well, inflation is on track, wages are weakening, the labour market is weakening, that's all good news. But there's a lot of geopolitical uncertainty. We're still working out how firms are dealing with changing the national living wage, changing their employers' contributions, and that all feeds through to prices. So we're really seeing how this uncertainty pans out, and that's really what's going to drive how quickly rates can come down in the second half of this year.
Yeah, so you seem quite, you're not too worried about the inflation picture, and you and an earlier guest, I think, were also telling us that they think the second half of this year we will see the Bank of England moving to cut more in the second half, despite any inflation pressure, and Bloomberg Economics saying that any stickiness in inflation is not going to stop the Bank of England cutting rates. I mean, why are we also dismissive of what looks like a fairly persistent inflation picture in the UK?
Yeah, I think we can really point to three things. The first is that in the UK, rates are restrictive. So the Bank of England can go a lot further before it gets to neutral. The top of their range is 3.75, so they've got a couple of more cuts in the bag before they get to that level. The second is that the labour market is cooling. Now, we've seen a big drop in the May data, that's preliminary, but if we look below the surface, hiring is certainly slowing, and that's probably going to cause sort of an orderly loosening in the labour market. That'll feed through to price pressures eventually. And the third is that if we look at just what firms are saying they're paying their workers, those settlements are coming down, and that's a key indicator the Bank of England's pointed to as well.
Matt, how are the folks at the Bank of England thinking about the geopolitical risk in the world right now, specifically emanating out of the Middle East and having oil price ripple effects? Dan Hansen, our chief UK economist, put out some analysis this morning saying that the $85 barrel threshold is where the BOE starts to get concerned about the ripple effect. Is that a fair price level to be looking at?
I think that's totally fair. The movements we've seen potentially so far, they're going to have relatively small impacts on inflation. And even going to 85, that might be something historically the Bank of England might have looked through. But we're in quite a unique phase at the moment. We've seen inflation expectations very high. People are hyper aware of the inflation environment. And the Bank of England are also quite worried about this becoming embedded. So if you put all those together, that really does mean that it's something the Bank of England has to think quite carefully about, and particularly given their concern about cutting too quickly rather than too slowly.
Yes, I feel like it's really interesting that have we almost forgotten the lessons of Russia's invasion of Ukraine? Oil prices went higher, and inflation in the very first months we talked about this being maybe transitory, but it was quite clear quite quickly that this wouldn't be transitory. It would have secondary effects on the rest of the economy. Companies had pricing power. Companies used that as an excuse, perhaps, in some cases, to put up prices. That reaction function is still very recent. That could happen again, couldn't it?
Certainly, and I think I always point people back to the remarks from Claire Lombardoli at the end of last year. And she simply said that the cost of being too aggressive in rate cuts is much greater than the cost of going too slowly. And I don't think you have to be sort of a keen observer to see that that calculus is the same. We've seen inflation 3.5%, probably going to remain around that level for the rest of the year. Pay at 5%, that's clearly above the rate, consistent with inflation getting back to target. And services, similarly, close to 5%. So all that together, the direction is good. The level is still concerning for the Bank of England.
How do you think the Bank of England thinks about currency appreciation? The British pound has strengthened nearly 10% versus the US dollar. And we've just seen the SMB cut, a lot of that having to do with not wanting to have this strengthening currency move. How does the Bank of England think about that?
I think the Bank of England set out its framework quite clearly, and that is it's domestic inflationary pressures that matter at the moment. That means wages and services price and inflation. So currency movements are second order, and we have to sort of look back perhaps to like 2016 when we saw huge movements in the currency really affecting the Bank of England's reaction function.
Yeah, what do you think about the vote split today? Are we going to get a surprise three-way again?
I don't think so. I think we'll be looking for 225 basis point cut votes from the known doves, and I think perhaps the risk and the intention of a more dovish committee might appear if we see maybe Ramsden vote in that group as well.
Okay, so 7-2 is the consensus.
That's right.
Yeah.
Talk to us about the trade deal. The last time we heard from the Bank of England, a trade deal between the United States and the UK, there was a framework. We didn't have the details just yet. Is that something that's going to get addressed today?
So I don't think we're going to see anything in terms of what they think that trade deal means for the outlook. I think that'll be saved to the August report. What I think we might see is an acknowledgement that progress is welcome, but there's still a huge amount of uncertainty around what that means for the UK economy. In terms of what that means for the Bank of England thinking, I think we have to remember that they were like relatively optimistic in their May projections as to the negative effects of the sort of trade tensions. They only had a 0.3% hit to GDP, so progress has a relatively limited upside for them.
Yeah, and the negativity is that around reduced exports to the United States. I mean, we saw that in the most recent set of data on GDP, didn't we? It was visible there.
So of that 0.3, 0.2% comes from trade, and then there's a further 0.1 from uncertainty. So there is a trade effect that will have diminished slightly. Uncertainty, that will still probably persist for a little bit longer.
Matthew, thank you very much. Matt Swannell, Chief Economic Advisor at EY Item Club and former MPC Advisor to the Bank of England. We thank you very much for joining us. It could be an interest. I mean, we don't get any change in forecast from the Bank of England today. So in that sense, maybe we moderate our expectations just a little, and no change expected, as we've seen from lots of central banks this week, Valerie, no change.
At least for the Fed, wanted to keep the market impact as minimal as possible, and they were successful in it last night. It was kind of a snoozer. So maybe we get that same from the Bank of England today.
Okay, well, certainly we'll have here on Bloomberg TV all of the latest news lines coming through from the Bank of England later on today. Coming up, as President Trump refuses to say how the US will react, officials are fearful of a wider Middle East escalation. We'll discuss the economic implications of that next. This is Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
You don't seriously think I'm going to answer that question? Will you strike the Iranian nuclear component? And what time exactly, sir? Sir, would you strike it? Would you please inform us so we can be there and watch? I mean, you don't know that I'm going to even do it. You don't know. I may do it. I may not do it. I mean, nobody knows what I'm going to do.
The level of trust between our countries is rather high. We have very good relations with Iran. We could continue this work and ensure their interests in this area. I will not go into details now, as there are many. All these details have been discussed with both the Israeli and American sides, and we have sent certain signals to our Iranian friends. Overall, it is possible to ensure Iran's interests in the field of peaceful nuclear energy. At the same time, it is possible to address Israel's concerns regarding its security. In my opinion, such options exist.
Russian President Vladimir Putin and U.S. President Donald Trump both commenting on the situation in the Middle East. So where do we go from here? We've got the perfect guest around the table this morning, Ziad Daoud, visiting us from the Dubai office, the Chief Emerging Markets Economist for Bloomberg Economics. Ziad, just walk us through the possibilities here.
Well, geopolitical possibilities, there are three, right? So there is already a war between Iran and Israel that is on the 7th day. What's the next step? It depends on the U.S. intervention. The U.S. could intervene. It's currently defending Israel. It could intervene by striking Iran, and that's probably the most likely scenario, given the developments over the last 2 days. The U.S. could sit things out and leave Iran and Israel engage in a prolonged war. That's the least likely scenario. And there is sort of a middle scenario in which the U.S. actually negotiates a ceasefire between the two countries. Unlikely, but it's possible. The most likely thing is that the U.S. will probably intervene by striking Iran.
That's your most likely. And how do you come to that conclusion? Do you attach percentages to those? Are there percentage chances of all of these three things coming to pass? Is it close? I suppose is my question.
It's getting less close over the last 2 days, given what we're hearing from the U.S., given also the fact that Israel is pushing for a U.S. intervention and is unlikely to accept a ceasefire, and given also, I think, the possibility that the U.S. would sit things out and let a prolonged war to continue is probably unlikely. And given that what we're hearing over the last 2 days, I think the scenario of the U.S. involvement is getting more and more likely, and that obviously has an impact for oil prices, has an impact for the global economy as well.
Okay, so let's think about that scenario. If the U.S. does get involved in direct conflict with Iran, where do you see the oil price going? Because in some way you can argue that maybe we won't see a big oil price rise because there hasn't been any impact on Iran's production of oil, and the U.S. has no interest and having an oil price shock, and they might perhaps deter, Israel or themselves from hitting any production. How do you view oil prices?
That's a big question, and I think the big lesson that we've learned, the Middle East has been in a state of war for the past 20 months. And I think the big lesson that we've learned from the past 20 months is that the geopolitics could escalate even beyond anything we've imagined, and yet oil prices could continue decoupling from that. So if you think about the geopolitics, 2 years ago, every risk scenario that we could have thought of, even the remote ones, the tail ones, have happened. A war in Gaza that devastated Gaza, that has happened. An expansion of the war into neighboring countries, that happened in Lebanon. Regime change in the Middle East, that has happened in Syria. A direct war between Iran and Israel, it's entering its 7th day, and now we're talking about possible U.S. involvement in a war in the Middle East. And yet, if you look at oil prices today, even after the surge over the past week, they're still lower than the level on October 6, 2023. So the big question is whether this decoupling between geopolitics, which is heating up, and oil prices, which seem calm, will continue or not. And we can discuss basically scenarios.
Sorry, that's really interesting, the expectations around how oil prices will respond here. Because if I'm thinking about when Russia invaded Ukraine, and I know this is gas, not oil, but thinking about energy markets, it was quite clear quite quickly that this was going to have a long-term impact. Parts of the West were going to need to find new sources of energy. There's not quite the same conversation as happens when it comes to Iran. Of course, the Straits of Hormuz matter a lot in flows of oil and getting things out, and so that's why this sticks to oil prices. But the Iranian flow is not supposed to go to the West. A lot of it goes to China. So how does that influence your thinking, I suppose, on how oil prices are going to respond here?
You're absolutely right. So how geopolitics impacts oil prices is fundamentally how it impacts supply and how it impacts transportation routes. And over the past 20 months, the reason that there was a decoupling between geopolitics and oil is that neither supply, oil fields, nor transportation routes have been affected. So that same scenario could continue even with the U.S. involvement. It may not hit Iranian energy facilities. It could hit Iranian energy facilities and they could be affected, but that's only 3% of global supply. And prices would react, but probably going to be in the 70s, maybe low 80s. But there is a scenario in which you have disruption through the Strait of Hormuz, which supplies 20% of global oil supply. But even if that happens, it can happen and then that clears up very quickly, or it can happen and that disruption could continue. So even within that, we're talking about different possibilities.
Yeah, there's so many different ways of defining disruption out there when it comes to the Strait.
Well, disruption, but then also sustained disruption, right? So the sustained level of the oil prices. But my question to you, Ziad, is what is that level? We're at 77 at the moment today, 78 when the headlines first crossed and we hit that peak. How high do oil prices need to stay for a more sustained impact on inflation, on growth, et cetera?
Okay, so let's talk numbers. So before the recent Iran-Israel war, what we had oil in the mid-60s. I think if you get a disruption to Iranian supply, which is 3% of the global supply, you could imagine oil being in the mid-70s. Now, if you have a disruption to the Strait of Hormuz, that's 1/5 of global supply, you can imagine oil going to $130 per barrel. But then there is the other question, which is how long can that last for? If there is a ceasefire negotiated after that, then oil prices could drop, which is what happened after, even with Russia-Ukraine, that lasted a few months, but then oil did come down. If that becomes sustained, then oil prices will remain high. The impact on the global economy, the general rule is, in aggregate, higher oil prices means slower growth, means higher inflation, and means higher interest rates. That's basically a simple rule. There's obviously a distributional impact. When oil prices go up, producers gains and consumers lose.
There's a question, though, that with these sustained oil prices, if you do see it at, you mentioned the 80s as a possibility, that actually incentivizes more shale production out of the United States and actually adds to the supply that OPEC is already pumping into the market. So in that train of thinking, or that line of thinking, is there a question here of just you oversupply this market so that the inflationary impact is subdued? Is that how we should be thinking about this?
I think there's two things here. And if you look at not just the past 20 months, but over the past 50 years, there has been a decoupling between geopolitics and oil. And there has been some form of, not decoupling, but a weakening of the relationship between oil and its economic impact. So if you think about the impact between, higher oil prices and the global economy, the sensitivity of the global economy to oil price shocks is probably lower now. Because you have alternative source of supply. You spoke about U.S. shale. We have alternative energy supplies, not just oil. There are other energy sources. we have, more spare capacity in terms of oil. And also, there is inflation. So a $100 oil price today is not a $100 oil price 10 or 20 years ago. That's
And a lot of the Middle Eastern economies that you follow closely, Ziad, they're very much focused, of course, on the geopolitical developments here and probably very worried about what's happening in their backyard. But you mentioned distribution effects. They could be some of the winners if they are oil producers, for example, Saudi Arabia with a higher oil price. Is that kind of thinking going to be cutting through in Saudi and other countries that produce energy products in the Middle East?
I think there's a couple of things here. I think the biggest worry is the geopolitical one. There is external threats on them from an Iran-Israel war that could spill over to their territory. And there is a domestic threat from their population. People are not happy with this war, and that could be, that could have ramifications. But in terms of the economy, generally high oil prices is good for most Middle Eastern countries. But if the spike in oil prices, the one that goes to 130 because the Strait of Hormuz is shut, they won't benefit from it because oil prices spiking because the world is losing their supply. So countries like Russia might benefit from it, but maybe not the Middle East. So it depends on what type of shock and what kind of disruption we get to the oil market.
Yeah, absolutely. Ziad, thank you very much for joining us. Ziad Daoud from Bloomberg Economics with us this morning to think about the impact on emerging markets and the region economically from a disruption in the Strait of Hormuz, if that comes to pass. Let's focus in on some of the other central banking activity that's taking place today. We talked about the Bank of England, that decision due at 12 noon at UK time. 9 a.m., that's in, 6.5 minutes, we get the Norges Bank rate decision, so we'll have coverage of that. US markets are closed, of course. It is Juneteenth, so no cash trading on stocks or on treasuries. And EU finance ministers will be meeting later on today. And no doubt some of the things we were just discussing with Ziad will be on their agenda, thinking about the way that oil prices higher impact on these markets. Now, geopolitics and its impact on central banking, really clear to see. We started this half hour talking about the SNB and the way that they are cutting interest rates, but they're fighting against big geopolitical forces, aren't they, Valerie? They're cutting interest rates, but it wasn't really interest rates that was driving money into the Swiss franc. It was that haven status. Yeah,
they don't necessarily welcome this haven flow, especially after currency has already appreciated so much on the back of this phenomenal dollar weakness to start the year. But look, dollar Swiss at the moment trading roughly flat. So the markets kind of absorbed the fact that they didn't go for that jumbo 50 basis point cut, nor did they really signal in their commentary that they intend to cut in September. That might have been something that could have helped the Swissy weaken today, but we didn't get that kind of commentary coming out of the SNB.
It's fascinating as well. We're talking about this currency impact, the currency manipulation label coming from Washington as well. We are also waiting for what they have to say on pharmaceutical sectors and tariffs as well on that sector. And that's something that's going to affect the Swiss economy in a very big way that you can't really model out at all.
And that's another reason why perhaps the SNB is hesitant to do any direct FX intervention while these negotiations are ongoing. They do want to stay on a stable footing in terms of their relationship with the Trump administration. You know, we kind of saw that happen to some of these Asian economies, like the Taiwanese, for example, kind of unwilling to intervene when their currency strengthened because they didn't want to get on a sour footing with Donald Trump.
Right, and thinking of Donald Trump and his policies, that takes us back to trade. And while we've been thinking about geopolitical risk, the ECB is talking about the other big risk out there, and that is around global trade. The ECB's Christine Lagarde saying that greater regional trade can offset global losses, which I think is an interesting line to be taking. So not using the US example as a sort of test case or as a blueprint for what other regions are going to do, but suggesting that Europe can still be at the forefront of global trade and pushing that global trade narrative. But just some of the comments that we're getting through from the ECB.
Yeah, we also did hear from Olli Rehn speaking about the Middle East conflict, actually saying that the Eurozone risks stagflation shock, if this Mideast crisis extends. So stagflation on the mind of not just the Fed, but also the ECB amidst this Middle East crisis.
It'll be interesting to see what the BOE has to say on that later. And before, of course, we hear from the BOE, we're going to hear from the Norges Bank as well. Also an oil-exposed economy, also needing to be thinking about maybe the positive for the Norwegians, but something that factors into their decision-making.
Yeah, certainly something that will come up in the conversation, no doubt, as it will when it comes to the Bank of England. We don't get a change in forecasts, but no doubt a lot of the conversation will be looking for any kind of guidance around the second half of this year. How are they thinking about geopolitical risks and what that could do to the UK economy? That is it for the opening trade. The Pulse is up next. We don't have US trading today, as we've said a few times, but we do have European trading, and we'll be here to take you through all of that. European equity markets are weaker this morning. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg. Senior U.S. officials said to be preparing for a possible strike on Iran in the coming days. President Trump says he's keeping his options open. The Fed leaves interest rates unchanged, but warns some of the impacts of tariffs will fall on the U.S. consumer. Plus, Switzerland cuts interest rates to 0. We'll bring you the preview of today's decision from the Bank of England. Now, first thing is first to the markets. Actually, we start with oil. I know you know it, but I'll remind you anyway that actually cash and treasuries are closed today for the celebration of Juneteenth in the U.S. Oil definitely dominating some of the headlines and some of the anxiety of what's happening between Iran, the U.S., and Israel, including concern that actually something could be closed in the Strait of Hormuz. Now, if you look at Brent crude 77.09, we look at sterling because it's Bank of England day. And then although equity futures are closed in the U.S. today, this gives us an indication maybe of some of the question marks that markets have when it comes to equities because of what we heard from Jay Powell, euro dollar 114.58. Now, if you look at the European markets map, again, they're kind of like on the downside. A lot of concern about what happens next, especially if there's a resurgence of inflation because of oil. The CAC 40 down 0.8%, similar losses for the FTSE MIB and the DAX. Norges Bank just coming out with an interest rate decision, cutting its benchmark interest rate to 4.25%. The estimate was 4.5%, so it has having maybe an impact on Euro NOK, and this is the picture, 11.5883. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that senior U.S. officials are preparing for the possibility of a strike on Iran in the coming days. Now, President Trump has publicly considered an attack, saying he has ideas as to what to do and that all options remain on the table. Now, Trump met with top advisors to discuss those options, but says he's yet to make a final decision. He also says Iran is ready to negotiate.
Iran's got a lot of trouble, and they want to negotiate. And I said, why didn't you negotiate with me before? All this death and destruction. Why didn't you negotiate? I said to the people, why didn't you negotiate with me 2 weeks ago? You could have done fine. You would have had a country.
Well, Jumana Raseche, of course, based in the Middle East, has more. Jumana, good morning. So how likely is a U.S. military intervention in this conflict, and what's Iran saying?
Well, at this point, it seems quite likely, Francine. U.S. officials told Bloomberg in a story that we reported overnight that they are working on plans to start their military intervention as soon as the coming days. Possibly could be looking at action if it does happen over the course of the weekend. Now, those officials also did stress that the plans are in a state of evolution. They're still fluid. And of course, there hasn't been an ultimate authorization to act on those plans. The decision ultimately does lie with the U.S. president. He was asked about it yesterday, and again, similar to the ambiguity that has been shrouding his decision-making the last few days, he also said, I may do it, I may not. A final decision will be made even 1 second before it's due. So that's not very helpful in terms of thinking about what the U.S. president has going on in his mind right now. But from the Iranian side, we heard from the supreme leader, the Ayatollah, yesterday in televised remarks, and he said that there will be no option of a surrender. They will not capitulate. They plan to fight hard, and they'll be watching what the U.S. do very closely, because if the U.S. join in the bombardment, is what they say, they will then cause, quote, irreparable damage on U.S. assets, and that the response will be proportional. So the region, Francine, is on a high state of alert right now.
It certainly is. Jumana, is there a way of actually de-escalating this through the diplomatic route?
The Iranian Foreign Minister Abbas Araghchi put a post out on social media yesterday saying that they are still keen on pursuing the diplomatic channel, which is somewhat at odds with the remarks that the Ayatollah himself delivered, which were remarks of defiance. And actually, interestingly enough, there are reports that the Iranian foreign minister will be meeting with the foreign ministers of UK, Germany, and France, possibly in Geneva tomorrow, to talk about the nuclear deal. So there is perhaps a sliver of hope that the diplomatic channel can be pursued. Whether the U.S. wants to go in that direction ultimately does reside, the decision does reside with the U.S. president. Earlier on in the week, he seemed to want to perhaps look in or renew the possibility of bringing Iran to the table, taking advantage of this moment of vulnerability from the Iranian regime perspective to perhaps demand more onerous criteria when it comes to those nuclear deal discussions. But over the past 24 hours, it's pretty obvious that his stance towards the region has turned a lot more hawkish, which is why, as I said, the region is bracing itself for the real possibility that the U.S. get involved.
Jumana, thank you so much. Jumana Raseche there with the very latest from the Middle East. Now, to talk about geopolitics, but also to talk about everything banking, because we have two stories from central banks today. Norway, we thought, would have kept waiting before the first interest rate cut. Not so. They cut to 4.25%, and they also said that they can continue doing so this year. And then the earlier story was that SNB was introducing in Switzerland stealth negative rates to keep money markets going. So I'm delighted to be joined by Yari Sten. He's chief European economist at Goldman Sachs. Yari, thank you for joining us. There's a lot, right? There's the Middle East concerns, of course, about what happens to the price of oil and inflation. And then there's this central bank news with you see a divergence of central banks. What do you think will mainly drive the economy over the next couple of months?
Yeah, as you say, a lot to digest here. I would say focus is on the increase in energy prices very much at the moment. That's clearly going to have an upward effect on headline inflation, is going to act as a little bit of a headwind to growth. So it might reinforce some of the concerns that are coming from the trade side, acting to be slightly inflationary and weighing on growth. But I think we should also keep in mind that, of course, for now, what the energy price increases have done is really unwind the declines that we saw in April and in May. And so, roughly speaking, energy prices are back where they were in the first quarter. And so I think for now, it's not going to be the driving force for what central banks will do. More important, I think, are still the trade tensions. And of course, we heard that yesterday from Powell. We are seeing that also, of course, in the commentary by the European central banks, that there's still a lot of uncertainty around this. I think, generally, I think for Europe, it means weaker growth, weaker inflation, and is probably going to keep a downward bias on rates across Europe for now.
Yeah, on the price of oil, I mean, is there an assumption that Donald Trump just can't afford for oil prices to go at 150? So even if something happens with the Strait of Hormuz, Saudi Arabia would be pressured into doing something. So is it a concern that is bubbling, but is there an assumption that actually will be dealt with?
I think that's probably right. I mean, it's obviously a very fluid situation right now, but the scenarios that we have set out, our commodity experts, is, upside scenario, for example, where oil goes to 90, but then doesn't stay there very long, because, as you said, there's an assumption that broader OPEC supply of oil would then come through. So we think of it as something that's going to matter for headline inflation, for energy prices, but it's probably not going to be something that's really going to derail the outlook here.
So, Jari, let's go back then to central banks and actually inflation, and as you say, the impact of tariffs and trade. This is what Jay Powell said yesterday.
The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
I mean, we heard it pretty clearly. There's not much certainty on the U.S. economy, except for the fact that Jay Powell thinks prices will go up. What does it mean for the rest of the world and Europe?
Yeah, I mean, so just on the Fed, I mean, we expect that they will take the time a little bit. We think they will cut in December, so they're in a good place now. They want to see more evidence about the effects of tariffs on the economy. I think the European central banks are generally still in the mode of cutting rates. Now, the Bank of England today, of course, is going to pause. I think there's focus on the vote split. Most people would expect 7-2 with Dingler and Taylor dissenting. There's probably some chance that you get a little bit more support for a cut today. And then focus will be on how they describe the economy. They will acknowledge that there has been progress with underlying inflation, with pay growth, but they will probably also note the upward pressure from energy prices. So I think bottom line today for the Bank of England that we are unlikely to see much of a shift, but we continue to think that they will cut in August. I think that now seems quite likely, and we think they will cut rates more than priced this year because rates are high. We are seeing progress on inflation, and we do ultimately think that tariffs are negative for the UK economy, for the European economy, and therefore rates will fall more in the UK.
Yeah, so Jari, actually, let's also bring Morwenna to talk about the Bank of England for the decision. I love our decision guides. Morwenna Konyam, of course, joining us. I mean, Jari beautifully laid out what we're expecting from the Bank of England. Again, it's a small open economy, so a little bit different to the ECB, and especially given the context that we've seen with the Swiss National Bank and Norges Bank, it'll be interesting to see how they're thinking of things.
Absolutely, because whilst all of these geopolitical risks are going to be hugely in play, particularly in terms of the trajectory going forward, there is the domestic economic situation to consider as well. And it is going to make things quite tricky for the MPC because we've seen evidence of sluggish growth. April GDP figure showed the biggest contraction in the economy for 18 months. We've seen softening in the labour market with job cuts, the most in May since the pandemic. But we've also seen CPI inflation staying elevated, 3.4% yesterday we saw. And of course, those geopolitical risks, particularly with spiking crude prices, do pose a big upward risk to inflation going forward.
Yeah, Jari, is there a concern? I mean, inflation is taking its sweet time, actually, to show up in the real data. So the surveys kind of point to it. Is there a danger that we see the same in the UK, around the third quarter?
Yeah, I mean, we're going through a bit of a hump on inflation in the UK now from a headline perspective. I do think the rise in energy prices that we're seeing has the potential to prolong that hump a bit. But at the same time, I think we are now seeing quite clearly that the domestic price pressures, so on pay growth and on services inflation, are slowing. They're still high, no question about it, but they are coming down. And as was just said, the labour market is also showing signs of weakening. It's hard to read given all the data issues, but I think if you average across some of these indicators, you're clearly seeing a labour market that's slowing. And so I think rates are high for a reason because inflation is high, but we do think inflation will come down. And so I think there's a compelling case to then also expect rates to continue to come down in the UK.
Yeah, it seems pretty tough actually for Governor Bailey to navigate it going forward. And also the way that the voting system works in the UK makes it a little bit more difficult maybe to markets to really latch on like a main narrative.
Well, absolutely, and we have seen some surprises in the recent past. Economists are expecting today's vote to come in with a sort of 7-2 split, with the majority, of course, voting to hold the rate, but with 2 members voting for a quarter-point reduction. Of course, last meeting we saw a 3-way split with some members voting for a bigger cut. And there is some economists are saying that maybe another person might vote for a quarter-point cut this time round. So it will be interesting to see, and whether that's also seen as being a slight message as well. We've seen Catherine Mann, use her sort of activist position before to try and make a point about, what she sees the risks to be. So I think that, but also the commentary will be particularly crucial. We're not expecting any change, particularly obviously there's no actual forecasts. We think they'll probably keep their official forward guidance consistent at the sort of careful and gradual process of rate cuts, but in between the lines, the fine print, I think, could be quite interesting in terms of whether they put more weighting on those inflationary risks or the risk to, the challenges for growth in the domestic economy.
Morwenna, thanks so much. Morwenna Konyam, there are Markets Today editor. And so you're sticking, actually, Yari, in terms of forecast, sequential cuts. So once they start, it's it'll be, not as progressive as others think.
Yeah, I mean, we think the message today will continue to be gradual and careful towards quarterly. So we think that will then essentially hint towards August, that if we continue to make progress, we can then cut in August. And then we do think in the second half of the year, conditional on that inflation progress that we are seeing, we think there's a good chance that they speed up the rate cuts. Now, that's not what they're currently saying, so it really is based on our forecast of where we think the economy is headed, where we think inflation is headed, because we do have a weaker forecast for growth. We have more slowing in the labor market, and we do think pay growth and services inflation will come down more than the MPC expected in May. And so we have them cutting to 2.75% in sequential terms from September onwards.
Yari, I want to ask you a little bit about Norges Bank, because the euro has shot up against the Norwegian kroner because of this, surprise cut from Norway. They also were flagging the possibility of at least one more this year. I know this is a different economy and it's, different complex to the rest of Europe, but if Norway can do this, could we be surprised by other central banks?
So Norway was definitely surprising on the day. We hadn't expected that today. I don't think many people had, given the guidance. Now, at some level, of course, it makes sense that rates are high there. We had expected them to cut a fair amount later in the year, so they decided to front load it. But of course, the price of oil will also matter for them, so I think we need to monitor that. But as I said earlier, we do think there's generally still a bias across central banks in Europe for more cuts. We have one more cut from the SNB, so we do think they will go slightly negative. We have one more cut also from the ECB. They've, of course, said that, for now in a good place, but we do think that the trade tensions are ultimately going to force one more cut from them in September. And so I do think over the next few months we'll see rates coming down more across Europe.
Yeah, from the S&P, we're just getting some headlines saying the reason for the rate cut is lower inflation, and Mr. Schlegel also saying they're not taking the decision to go negative lightly. The ECB has also a larger, concern because of the proximity to, countries that are more affected by Ukraine. Is this the most, after the Fed, the most complicated central bank to see what they do?
Probably right now, yes, because they've already cut a lot. They're 2% down from 4%, and they're saying we're in a good place. We can afford to, take a bit of time now. So it's not as obvious as it was a few months ago what they're going to do next. But I do think that The inflation dynamics in Europe look quite benign, and that is despite the increase in energy prices, because I think that will matter mainly for headline and not so much for core in Europe. And then on the trade front, obviously, a lot of uncertainty, but we do think that we will ultimately get slightly higher tariffs than what the ECB staff assumed in the June projections, particularly for the tariffs on pharma that are quite sizable. We think there's a good chance that we'll get some announcements there in coming months, and the staff didn't include that in June. And so those are arguments, I think, for them to do one more cut in September. But as you said, it's no longer obvious because they've already come down to a level that's roughly neutral, whereas many other central banks, the Bank of England, Norges, and so on, are still clearly above what is a normal level. So it's a bit easier for those central banks.
Yeah, I keep on getting asked, like, how bad does the economy have to go below 2% interest rates? Yari, thank you so much, as always. Yari Sten, he is Chief European Economist at Goldman Sachs. Now, coming up, we talk geopolitics, banking, and, of course, the debate around U.S. exceptionalism with Hugh Van Steenis from Oliver Wyman. That's next, and this is Bloomberg.
Geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg. Now, a new report explores whether the decades-long dominance of U.S. wholesale banks is at a risk in an era of geopolitical tensions and economic fragmentations. Well, I'm delighted personally to be joined by Hugh Van Steenis, partner and vice chair at Oliver Wyman, who published The Outlook with Morgan Stanley. Hugh, so good and so great to actually have you also on a busy day to try and understand some of the dynamics. But if you're a wholesale bank in the U.S. right now, you would have started January thinking like all gung-ho, it's going to be great, deregulation, I have so much to do. And now many more question marks.
Yeah, look, I think it's a very uncertain outlook. I think on the positive side, the volatility has helped the trading businesses for the US banks, and particularly FX volatility has been a huge boon. But obviously the expectations for deals, the uncertainty reinforced by the last week, has just meant that corporate activity is being pushed to the right. And so they're sitting there thinking, how can they really gain share in this environment? I do think, though, the deregulation agenda has got very strong winds in their sail, and I think that'll be very supportive for the banks over time.
But Hugh, I mean, you hear it in corridors, right, of chief executives in Europe saying, oh, we might get business because we're Europeans and not Americans. I just don't see it, right? I mean, the U.S. banks are still strong. They're frankly just very well organized. That's right. And so it's difficult to see the Europeans, unless we have a capital union or a banking union, to really come in and get market share.
I think that's right. I mean, look, the network effects of the large banks are super intense. Look, I think even if we do get a savings investment union, some of the US firms will benefit from that. Right. What was really striking 2 weeks ago at Super Return was how the US leaders in private credit and private markets were eyeing up the opportunities in Europe. Actually, the securitization report, which came out this week, super nerdy, but actually was really quite a good step forward and actually went quite a bit further than consensus had expected. Probably not as far as you'd want, but actually that's positive. But I think the gravitational force of US banks is very strong.
I mean, do you think that actually US exceptionalism is really put into question, or is it just a buzzword right now?
Look, I think this is a tough call. It's come up a lot in our interviews with investors. I think the way I'd frame it is, it's a bit like Apollo. Maybe the hyper-exceptionalism is coming back to just sheer exceptionalism, but the innovation, and particularly the diversity of funding markets to support innovation in the States, is something which we are still a long way behind in Europe. But, what I'm being struck by our interviews is how many chief investment officers are thinking about, reallocating a bit from US to Europe. And that's partly because they came into the year max overweight US, not just in equities, but also in currencies. There was a State Street survey showing that the dollar exposure was the highest for over 8 years. And so, of course, we've already seen a retrenching of that. And the more you've got a regulated pool of money, a pension fund or insurer, the more they absolutely have to increase their dollar hedging. Right. So I think you're getting think about it as a rebalancing rather than an exodus.
Right, so it's not necessarily investors saying, look, we've always thought U.S. Treasuries were the perfect, we're safe, and now they're questioning that.
No, I think, so the way it felt to me is much more, so let's distinguish between the tactical trade around April, and in particular the first week of April, which we all remember was pretty yippee, exactly. Then some of this was FX risk. So imagine you're a Canadian investor. Well, you've probably lost 9% just on sort of currency and the move in that 1 week. So some of this was, if you see a risk, you need to take action. I think that was very much tactical. Yeah. I think what we're now starting to see is investment committees debating the strategic asset allocation. And there, I think it's a much more gentle rebalancing conversation.
Yeah, I guess the concern here is that it started, with trade and tariffs, Liberation Day, then it gets extended, but you also have this whole geopolitics with what's happening in the Middle East. It could flare up elsewhere that I guess weighs on investors.
Yeah, that's right. And so I think actually from the work we've just done in our survey, one of the big themes is the opportunity, let's say in Europe, a credit one or an equity one. Right. So actually, you can get, I think there was real conviction that with Germany spending money, with Europeans needing to invest in digital infrastructure, energy infrastructure, rearming, there's a huge opportunity for credit markets. Some will clearly flow to European banks, but also some of the private market players are super excited about private credit in Europe. On the equity side, I think, Francine, as you debate every day, the markets are, geopolitics does weigh on the markets heavily.
But private markets are also being open to retail investors more and more, so that will change the landscape forever.
Oh, I think this is one of the most interesting areas. In fact, the fastest growth in the investment industry is private credit to wealth. So we've just done some work showing, let's say in the States, the growth of evergreen funds. They're up 52% this year on Q1 last year. Okay. So it's a huge growth, and that's because the democratization of private assets, but it's been particularly around credit. So in fact, one of the managers which just launched 2 weeks ago has raised $500 million in 2 weeks in their new fund. So it's really gaining traction, and I think you've got Greg Fleming coming to talk about later. But I think seeing how the wealthy are thinking about what is the right diversification in my portfolio, not just because of this year, but because of what happened in 2021. There's a reappraisal of diversification, and private credit is becoming probably a much more important part of that over the coming years.
Yeah, and it feels like it's changing really at pace. Hugh, thank you for joining us. Pleasure. As always, Hugh Van Steen is partner and vice chair at Oliver Wyman. Coming up, we discuss the prospects for both the U.S. economy and the future of wealth management with, as Hugh was saying, Greg Fleming from Rockefeller Capital Management. That's coming up next, and this is Bloomberg.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Senior U.S. officials are said to be preparing for a possible strike on Iran in the coming days. President Trump says he's keeping his options open. The Fed leaves interest rates unchanged, but warns that some of the impact of tariffs will fall on the U.S. consumer. Plus, after Switzerland cuts interest rates to zero, Norway delivers a surprise reduction. Investors also look ahead to today's decision from the Bank of England. So let's start with geopolitics, and Bloomberg has learned that senior U.S. officials are preparing for the possibility of a strike on Iran in the coming days. Now, this as the two sides continue to trade missiles, with Israel's defense minister instructing the military to intensify strikes against government targets in Tehran. Well, joining us now for more is our EMEA News Director, Roz Matheson. Roz, thank you for joining us. I mean, it just looks like things are escalating, and I'm always surprised hearing the president say, look, he'll make the decision at the last second whether the U.S. wants to get involved because everything's so fluid.
Well, that's right. Even yesterday he was saying, I may not. No one knows what I'm going to do. But it's interesting that there is some talk about the weekend, because that does give us 48 hours potentially to find some kind of off-ramp. So is this ramping up of rhetoric from the US, the signals they're preparing the possibility of direct strikes against Iran, is that to sort of push Iran to find an off-ramp in the next 48 hours? I mean, it's very difficult to see how that happens, or in what form that would take, or how Iran does that without losing face at home too much, having to essentially probably cede its nuclear ambitions, at least for now. So how do they do that? Do they do that through diplomatic channels or what? But it does give at least some window of opportunity here to find a way out before the US, does go towards the idea of direct action. But it does seem that that's very much on the table. They're making preparations for it, for plans of how they would do that, and that would bring the US directly in, obviously, then to the conflict.
Yeah, it's really interesting how various leaders have reacted, especially in the Middle East, which I'll ask you about in a second. But first, let's also listen to the Russian president.
The level of trust between our countries is rather high. We have very good relations with Iran. We could continue this work and ensure their interests in this area. I will not go into details now, as there are many. All these details have been discussed with both the Israeli and American sides, and we have sent certain signals to our Iranian friends. Overall, it is possible to ensure Iran's interests in the field of peaceful nuclear energy. At the same time, it is possible to address Israel's concerns regarding its security. In my opinion, such options exist.
So, Ross, overall, apart from Russia, how are leaders viewing this? No one's really condemning the Israeli attacks, but they're also worried about escalation, and some of them are pushing for a more diplomatic solution.
Well, that's right. So you've got European leaders obviously watching this with a high level of concern. We know the foreign ministers of Germany, France, UK are set to meet tomorrow with the Iranian foreign minister. The question is, can they do anything? I mean, it seems as though Benjamin Netanyahu made this decision himself to do this attack on Iran, even against perhaps the advice of the US. If Donald Trump can't change Netanyahu's behaviour, can anybody else change that behaviour? And so what is the role of Europe in this at all? Is it maybe to convince the Iranians to find an off-ramp? Who's talking to them to negotiate there? So maybe it's the Europeans, maybe it's some of the other Gulf states. They're obviously very worried because this is right on their doorstep. They wanted calm, peaceful times. They wanted to be able to do business, trade, investment. If this conflict spirals, all of that goes out the window.
Ross, thank you so much for the terrific briefing, as always. Ross Matheson, our EMEA News Director. Now, geopolitical upheaval is, of course, also weighing on investors around the world. Well, I could not be more delighted to get the view of Greg Fleming. He's President and Chief Executive of wealth management and financial services firm Rockefeller Capital Management, responsible for over $160 billion in client assets. Greg, thank you for joining us. Welcome to London and welcome to The Pulse.
Thank you.
I mean, there's just a lot. There's policy uncertainty on the geopolitical front, on tariff and trade coming from the U.S. How's it playing out in your world?
You know, I would say there are two words I would use to describe the U.S. today. One is resilience and one is uncertainty. Let's start with the uncertainty. Clearly, the tariffs created a whole bunch of uncertainty way back in April. That's mostly still in play. You heard the Fed say that yesterday. And uncertainty is a challenge for both business and consumers because they can't predict. I mean, businesses are slow to make capital decisions. If supply chains have to be changed, they really don't know where to move the supply chains yet. And consumers are uncertain as well, given are prices going to go up, where are they going to go up? So that is a break on the economy, and I think you're seeing that. Having said that, the U.S. economy is still quite resilient. Employment, there's some weakness in employment, but it's hanging in there. Yep. Inflation is really, the data has so far been under control. But again, you listened to the Fed yesterday. They're concerned about where it might go. So I think the summary I'd say is that the U.S. economy really is hanging in, despite all of the uncertainty created by all of the geopolitics. And obviously things going on in the Middle East now add to that uncertainty.
Greg, is there a worry that actually the U.S. economy is hanging on and then it goes badly all of a sudden? I know Jay Powell yesterday, to me, felt like he was really warning on inflation. But there's such a difference between what surveys are telling us on inflation, the economy, and real data. Does that match up at some point?
Well, you know, that's actually a really good point, Francine. The data is not there yet. I mean, inflation is still in check. And having said that, there are clearly inflationary things in motion, like tariffs. I think the tariffs, the effective tariff rate in Trump 1 before they made the changes in his first administration was 1%. It went to 2.5%. It's 14 today. So that's a significant move on the tariff front. But when you pull it all back together, and the Fed said it again yesterday, they're not clear on where it's going, and they're trying to balance the two. Francine, the word that the Fed is most focused on, which would be the biggest challenge for the U.S. economy, is stagflation. They don't want to see that unemployment rate tick up and the economy really start to slow when at the same time inflation starts to kick in because of a delayed effect of tariffs. And you know, let's talk about the fiscal situation in the U.S. too. You know, there's a budget bill on the table that will keep the deficit at roughly 6% of GDP. That's very stimulating and inflationary as well. So they're worried that inflation might tick up as the economy slows, and then they've got both problems and that word that we haven't seen in the U.S. in decades, stagflation.
That's a nightmare. I mean, we don't even pronounce the word because people are so scared of it.
Yes.
I mean, this is, so if you're the Fed right now, how do you operate it? Is it in a wait and see, or is there anything that they can do now to actually get up front of it?
They need to do what they're doing, which is wait and see, and they're just not sure. And actually, the language yesterday was more direct on that point than you've seen in a while. It is a very uncertain world. They want to wait and see what happens, so they're going to figure out which way to pivot based upon what comes in. I would guess that they probably don't move until late in the year, because unless they see something clear, because they are reading the data. So unless there's something that actually tips them in one direction or another, they're going to continue to stay on the sidelines, monitor, and react to real events as opposed to things that they can't see yet.
Greg, I guess your main job is to interpret and action some of the big changes that we're facing. Sure, you're a very busy man, but there's a lot of concern about treasury auctions, debt. Do you think the U.S. will be able to grow itself out of the fiscal situation? And we haven't even talked about AI.
Yeah. Well, let's get to AI, because if we're going to grow our way out of the fiscal situation, AI will be a big part of that. But the deficit is a big issue. Between 1945 and 2024, receipts as a percentage of GDP in the U.S. were 17%, effectively taxes. Spending was 19%. So you had deficits, but they were relatively constrained. When Bill Clinton left office in the late 1990s, 2000, we had surpluses. In the 5 years from 2019 to 2024, receipts were 17% of GDP, and spending was 27%. That's unsustainable, even in an economy like the U.S. So, yes, we can grow our way out of a lot of it, and AI is going to be a big part of that. But we really need to do a better job of constraining that 6% as a percentage of GDP deficit year in and year out. You just can't keep doing that.
But there are also so many questions about whether the U.S. can be a reliable ally. There are questions about, is there U.S. exceptionalism? So is there going to be enough growth in the U.S. to put all of those bad mouths to one side?
The U.S. is going to stay the strongest economy in the world. It's a dynamic place where entrepreneurs create new businesses every year. There are 3 or 4 million new businesses created in the U.S. every year. Secretary Bessent, early in the administration, said they were targeting 3% real growth, 3% inflation, and a 3% budget deficit. If they hit those numbers, the U.S. will do really well moving forward. And the 3% real growth is a very high number relative to anything we've seen for decades. Yeah. AI is truly transformational. I mean, I'm seeing it in our business, seeing it in all the businesses of the clients that we provide advice to. So you could, with AI, get to 3% real growth.
How do you use it?
We use it for everything from drafting emails to clients, where they can look at the history of the dialogue and write something that's terrific, to looking at investment performance. I mean, it is going to transform the wealth management business, but every single business in every single industry over the next 5 or 10 years will be transformed by AI.
Yeah, transformed, or, some companies could also have a Kodak moment where they kind of they become completely irrelevant. Do you think enough chief executives and boards are having that conversation?
I do, but Francine, one thing I'll say about new technologies, and my colleague Rashir Sharma, who's our chairman of Rockefeller International, has done a lot of research on this. There has never been a new breakthrough technology that has cost more jobs than it's created. So if you look at the internet in the late 90s, today we have things called search optimization engineers, something that nobody conceived of in the late 90s. So, we believe on balance that AI will create lots of change and it will eliminate jobs. But the productivity improvement and the ways that it helps transform businesses, we have no idea of now going forward. So on balance, when you have a breakthrough technology, it's better for the economy in the U.S. and around the world.
Okay, I like it, an optimistic guide to AI.
It is an optimistic view on AI.
Greg, when you look at some of, how basically people deploy capital, so it could be chief executives investing, I know there's a big chunk of money that's going to AI, but in general, it's also companies not wanting to list, being more private, resurgence of credit. Does that change, again, how investors and clients see the world? If more companies want just to be private instead of public?
100%. For our clients, and remember, our clients, we focus on high net worth and ultra high net worth, primarily Americans today, with offices across the country. We have increased the allocation within the asset allocation for those clients to private alternatives.
Right.
Because these clients are wealthy enough to withstand the illiquidity discount of privates and alternatives. And there's been enormous growth in private and private alternatives available to clients across all the different asset classes, from PE to private credit. I mean, you're familiar with all of them. So that is a long-term secular change in the way certainly high net worth and ultra high net worth clients should invest.
Does Europe gain in these trade and tariff uncertainties? Or do clients want to be more invested in Europe?
Well, one thing I'll say, coming into the year, and there's this whole discussion of American exceptionalism. American exceptionalism is real, but it went very far. So 70% of global market capitalization at the end of last year was the American stock markets. That's on the high side in any historical context. So there was going to be some correction. where and the U.S. also had over 50% increase in the stock market in the 2 years in 23 and 24. The last time we saw that was 98 and 99. So no matter what happened with the new administration coming in, even if the whole tariff situation hadn't occurred, there was likely to be an adjustment, and international markets were going to do better. You know, part of what we've seen in international markets outperforming U.S. markets is that. But we believe that American exceptionalism is here. You know, as I talked about the entrepreneurialism, that's going to continue for a long time.
Even if China wins the AI race, we haven't talked about China.
Well, the AI race is very important to win. And I think the American economy is still leading in that. And this is why private investment in the entrepreneurialism of the U.S., that's a really important part of the American economy. You know, small business, people forget that 60 million Americans work in businesses with fewer than 500 employees. There are 33 million businesses in the United States with fewer than 500 employees. And that dynamic startup mindset, as I said, 3 or 4 million new companies created every year, that's powerful. No country in the world has that. And as long as that continues, you're going to see innovation and entrepreneurialism driving the American economy and hopefully keeping our lead in things like AI.
Greg, thank you so much for joining us. A real pleasure to host you.
Great to be here,
on the Post.
Francine.
Greg Fleming, Rockefeller Capital Management President and Chief Executive. Now let's also shift the focus to tech. Well, back to tech. Bloomberg has learned that Microsoft is planning to cut thousands of jobs as the firm continues heavy spending on AI. Well, Charlie Wells is here with the latest. Charlie, good morning. So tell me about Microsoft. It's trimming its workforce.
Good morning, Francine. So Bloomberg has learned that these job cuts would focus primarily on sales roles. That's according to people familiar with the matter. And it follows some 6,000 cuts that went into effect in May that really targeted more of the product and engineering side of the workforce there. And this comes at a time when Microsoft has been investing significantly in AI. Wall Street has liked what it's hearing on the AI investment front, but Microsoft has also had to communicate that it intends to keep a lid on costs, and this is where we're seeing some of these reductions in the workforce.
So, Charlie, on the topic of tech jobs, Bloomberg has also learned that Amazon will be ordering some employees to move closer to their managers. What's the rationale behind that?
Francine, so this is related in some ways in trying to keep a lid on those costs as well, and we know that some of these jobs would actually be required to move closer to their managers. So Amazon earlier this year implemented a policy that staff had to return to office 5 days a week, but they did not have location specificity. So this adds that specificity to that mandate. So people who may be working out of satellite offices across the United States at Amazon in cities like Dallas or Austin or Boston might be required to move to places like Seattle, more hub locations such as Seattle or Washington, D.C. Now, Amazon has said that it does not take a universal approach here. They're going kind of one by one, and that teams have been moving closer together. But this is according to people familiar with the matter who say that this could disrupt people who have been working out of a lot of these satellite offices for years.
Charlie, we're also learning that OpenAI is phasing out its work with Scale AI. Why?
Well, the gloves are off in that race for AI dominance, Francine. And basically, this is following news that Meta invested some $14.3 billion in Scale AI. Now, OpenAI has said that its data needs have changed, that they are not as reliant on Scale AI's data labeling technologies. But there has been concern following that significant investment from Meta and the 49% stake that Meta took in Scale AI, that could give Scale AI access or at least exposure to competitors, including OpenAI or Google. So this could be a shift, and it could create some problems for Scale AI as they take that investment from Meta.
Charlie, thank you so much. Charlie Wells there with the very latest, of course, on some of the tech stories. Now, coming up, LVMH confronts one of the worst crises in its history. We'll break down the multiple challenges of the luxury giant. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch the new Bloomberg Tech Europe. Premieres Friday, only on Bloomberg Television.
Hi, everyone. Now, a 220 billion euro slump in market value is heaping pressure on LVMH founder Bernard Arnault. A widespread luxury slowdown and succession concerns are adding to what one analyst is calling the biggest crisis in the firm's history. Now, it's a subject of today's Big Take, and Angelina Rasquet is in Paris to talk us through it. Angelina, thank you so much for joining us. Now, you wrote this Big Take. It's extremely interesting, extremely timely, and it's about the challenges right now at LVMH. There are many. What are they?
Hi there, Francine. Well, indeed, I mean, the backdrop is that there's a big slowdown in the luxury industry that's affecting all the companies. The two biggest engines of growth, the U.S. and China, are suffering, but there are internal problems to LVMH, and notably at two key assets that we focus on. That's Dior and also Moet Hennessy, the alcoholic, the wines and spirits unit. They've been both culprits in recent years of hiking prices too much. So there's been a consumer backlash. At Dior, there was also last year a supply chain scandal that generated a lot of bad press. So these are some of the biggest problems. So in the past 2 years, since LVMH shares reached a record in April 2023, they've lost about half of their value. But that hasn't prevented Bernard Arnault and his family from buying about more than 1 billion euros worth of their stock.
Angelina, tell us a little bit more about the conglomerate discount and what you found.
Indeed, Francine, well, LVMH is a group that's composed of 75 brands. And when you have a rising market, maybe investors are more willing to ignore the fact that it's, it owns companies that have different, that are in different industries, whether it's hotels or wines and spirits or leather goods, but also restaurants. But basically, these assets have different valuations and different margins. However, when things start to become more shaky, then there's probably more scrutiny. And what we found out is that in recent years, LVMH actually considered spinning off Sephora and listing it in Amsterdam. That was in 2021. And Diageo, which owns a stake in Moet Hennessy, 34% stake, they also asked about 2 years ago to also list the unit, but Arnault dismissed that idea.
So what are people saying about succession and governance?
Well, that's another topic that's on investors' mind. Bernard Arnault controls LVMH. He's 76. Recently, he lifted the age cap of the CEO from 80 to 85. signaling that he intends to lead the company for the foreseeable future. All his children, he's got 5 children, they're all involved in the business, and they all have prominent roles, but there's not an obvious successor there. Last year, he named a deputy who's still relatively unknown to the markets and to investors. His name is Stéphane Bianchi. He's 60, and his career, basically, his track record was leading family businesses, much smaller than LVMH, but also mentoring heirs.
And meanwhile, I mean, there was big news earlier this week with Kering actually hiring a former Renault chief executive, Luca de Meo's. I mean, it's quite unusual to have, the chief executive of a car maker going to a big luxury company.
Yeah, that was a major surprise, Francine. Generally, the luxury sector functions in a closed circuit. I mean, in recent years, it also hired people from the fast consumer goods, whether it's Unilever or Procter & Gamble. But really going from the automaker industry, that was really surprising. But Luca de Meo's track record at Renault is second to none. He stayed there for 5 years, and shares simply doubled. He managed a turnaround, and that's probably what François-Henri Pinault is hoping that he will do at Kering, which is really struggling with its turnaround, and especially of its biggest brand, Gucci.
Angelina, thank you so much. Angelina Rasquet there with the very latest. Now, Chinese EV maker BYD's aggressive push into Europe is seeing results, with sales growing more than 200% in the first 4 months of this year in the region's 5 biggest markets.
For BYD ourselves, we are still in the fast-growing pace because, like a Q1 of our UK sales is higher than total of 2024. So even in May, all the auto industry is dropped by between 5 to 10%, but the BYD still keep like 200%, 300% growth in different countries.
Well, that was BYD's Executive Vice President, Stella Lee, speaking to our Tom McKenzie. He joins us now. So, Tom, thank you for joining us. How important is the European market for BYD?
Well, Stella Lee told me that Europe is its now most important market. They're going to commit $20 billion equivalent in terms of investments here. They're building out a factory in Hungary. They're hiring pretty aggressively in terms of top talent from the incumbent European automakers. And you've seen this incredible growth in sales in recent months, a quadrupling in so far, year to date, in terms of sales into countries like Germany, France, Italy, Spain, and the UK. And the UK now is its strongest market. In fact, it's outdoing, in terms of recent sales, outdoing the likes of Fiat, Honda, and even Mini as well. One of the aspects going forward for BYD is the pricing story. It's very aggressive on pricing, but it's also betting on the dealerships and on its tech on winning over consumers. And broadly across Europe, it is now selling more electric vehicles than Tesla.
What are the challenges?
There are challenges for BYD, and part of it goes to the pricing story because as a result of that very aggressive pricing, they are on razor-thin margins. The other challenge is winning over customers and dealerships, winning them over on the question of quality. They have the supply chain, everything from batteries all the way to the actual shipping as well. They think that's put them an advantage, and Stella Lee told me when they bet on something, they go in big, they're going to put all their resources into Europe, but the challenges are there.
Tom, thank you so much. As always, Tom McKenzie there with the very latest on BYD. You can catch also Tom tomorrow for Bloomberg Tech Europe, which debuts 6:30 a.m. UK time on Bloomberg TV. The show, of course, spotlights the biggest names and key trends shaping the European tech ecosystem every month. Up next, Bloomberg Markets, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Well, good morning, everyone. It's 10 a.m. here in London, 5 a.m. in New York. I'm Francine Lacqua, and welcome to Bloomberg Markets. Now, we begin this hour with our top stories. Israel and Iran entering a seventh day of conflict. Sources telling us here at Bloomberg that U.S. officials are preparing for a possible strike on Iran in the coming days. The Federal Reserve holding rates steady for a fourth consecutive meeting. Chair Jay Powell signaling tariff impacts are coming. And this morning, it's Bank of England's turn. Policymakers also expect to hold steady as they try to strike a balance between higher inflation, higher oil prices, and a slowing economy. Now, first thing is first, let's quickly check on the markets. Of course, a reminder for everyone at home that there's no cash equity trading, and U.S. Treasuries are also closed for Juneteenth. The picture is really one of equity markets in Europe kind of on tenterhooks about what happens. Looking at the oil market for possible repercussions on the Strait of Hormuz, you can see Brent crude 76.93. I also look at euro dollar, but also sterling on the back of, well, we're waiting for the Bank of England. We had two surprises, S&B actually cutting interest rates, and then Norges Bank. That's a big surprise because we were not expecting Norges Bank to lower to 4.25%. Krona actually probably set up for some weakness after this surprise rate cut. So let's get to tariffs, trade, geopolitics, and central banks. Joining us now, Bloomberg's Noor Al-Ali alongside Sandlinton Brown of BNP Paribas. So thank you both for joining us. Noor, let's kick off with you. So treasuries are closed today because of Juneteenth, but there's certainly a lot going on as we try and first assimilate what we heard from Jay Powell yesterday, which was there's a lot of uncertainties, but inflation's going up.
Well, good morning. Absolutely. Look, if we package what Jay Powell has said yesterday with what we're hearing and seeing from the S&P and Norges today, that's pretty much showing that we are in an anticipation mode where the world expects, where the global economy, ex-U.S., expects inflation to come down or to ease because of the impact of tariffs, and a lot of uncertainty, right? If you look at both statements from Norges and the S&P, they say, look, there's heightened uncertainties. There's a sense that we really don't know what's next. But what's very clear from both Fed and those central banks in Europe is that inflation is expected to tick higher in the U.S. as a result of those trade uncertainties or the repercussions that we still haven't seen yet, according to Jay Powell. So, you know, in terms of a market's perspective, that tilts the odds back towards the dollar, which we've seen ease since April.
And Sam, this is a problem. Like, you know, surveys tell us one thing, and it's a little bit slow to trickle through the real economy. So if you already have lower rates like the ECB, you're not sure how to do it. For someone like, you know, Norges, it's easier to just say, you know, we're cutting now and we'll keep on cutting.
Yeah, I think, and the discussion for the Fed is really crucial here for the market. We don't think they're going to cut rates at all this year. And to the point that was just being made, inflation's really what's key. The framework we'd suggest for thinking about how most central banks are perceiving their reaction function at the moment, but in particular the Fed, is they'll begin to cut more decisively once they see the unemployment rate rise, the labour market weaken, and or the peak in inflation. The peak in inflation isn't coming for several months still this year, and therefore, unless we see some weakness in the labour market, which, to your point, while surveys have been soft, the hard data has been comparatively strong, it means central banks are in this very difficult trade-off between growth and inflation.
Sam, the nightmare is stagflation. I mean, is there a possibility going into third quarter, fourth quarter, that we start seeing the seeds of stagflation?
It's effectively what we saw in the Fed's dots last night, predicting relatively soft growth, high inflation, and some rate cuts into that. For the UK, you mentioned the Bank of England that we have today. They're also in a tricky spot. They've got below-trend growth with above-trend inflation. It's not quite a stagflationary backdrop, but it's to some extent in that ballpark. Our view for the Bank of England is no action today. That's very much in line with consensus. But they'll have a quarterly pace of rate cuts from here down to 3.5% by February next year.
Okay, we'll come back to the Bank of England because I also want to ask you about treasuries. Nora, how do you see treasuries developing in this kind of market?
Look, it's quite tricky, right? We've seen a pivot away from bonds as the traditional havens in the last couple of months. Really, that inflationary picture really weighing on treasuries. But there's been almost a growing consensus that the trade away from treasuries isn't really going to last, right? I mean, the whole idea that basically the world reserve currency, the dollar, treasuries losing their global status is still something that a lot of entities are still having a hard time digesting. We're certainly discussing it, right? But right now, what is anticipated, particularly with the Fed holding on its reins, those are higher yields. I mean, obviously, the markets are closed today, so we can't have that immediate rate. But if you look at Europe, rates are all higher, right? And gilts are underperforming. And unfortunately for gilts, there's sort of like that barometer of almost risk in those, if you were to compare them to Germany, the treasuries, and gilts. And so if they're leading the charge lower today, I'd expect treasuries, when they reopen, to kind of also push higher in terms of yields.
Sam, you have an interesting call actually on coupons, right, that the market is not expecting. What's your call?
So the market's concerned about the back end of the US curve. We understand why. Yep. Yields are high, and there's this narrative around de-dollarization and whether or not global investors are going to want to buy treasuries to the same extent as they have before. And so that's really been impacting the back end. That's been steepening the curve. We think that all makes sense, and we're very much bearish on the dollar. We agree in the de-dollarization trend. I think the thing that the market perhaps isn't paying as much attention to as we think it should is how do the Treasury respond to this? The consensus in the market is that they're going to have to increase bond supply perhaps early next year. We disagree. We think that the Treasury can signal that any incremental financing need is going to come in the form of T-bills. If you like, taking a leaf out of what we saw earlier this year from the Debt Management Office in the UK, where they also shortened issuance, perhaps also what we're going to see from the Ministry of Finance in Japan. So there's a general theme here, I think, where the market's pressuring back-end rates higher, but now we might begin to see issuers respond by the way that they skew issuance more short-term.
Yeah, I mean, BOJ is actually, I mean, first of all, I don't know whether the main theme will be divergence, right, as you go into, mid-2025, and what that means also in terms of how central banks need to react, Nora.
Yeah, absolutely. Look, I mean, what we're seeing is a global reaction function of dovishness, right, from central banks. How that fiscal end responds is really key, right? We're worried about, debt spiraling globally, the needs for greater defense spending. Obviously, we're also thinking about ESG. I know there's a lot of concerns going on, but, a lot of those ESG targets that we've set pre-COVID are starting to come to fruition here, and we're not really meeting them as well. So that need for extra spending, although, Sam, I can see your point about that T-bill, because there has been calls for central banks to kind of leave that long end untouched. We're already very worried. I mean, reminder, right? I don't want to keep mentioning it, but the 2022 gilts crisis, or that sell-off that happened in gilts after that budget spending, is a cautionary tale for pretty much any other global entity or government that's looking to step up spending on different aspects of their economies, while also paying attention to the market, right? they're not here to close out spreads, as we historically know from the ECB, for instance. But also the concern here is that they need to meet their spending targets. How they meet them, I think, is going to be key for bond vigilantes on markets globally.
What are you expecting BOJ and actually some of the Japanese bonds?
We saw earlier this week the Bank of Japan say that at the beginning of its fiscal year next year they'll reduce the pace of QT. So we've seen the sensitivity from the BOJ to the sell-off in long-end JGBs in Japanese government bonds that's been prevalent over the past few weeks. Next up could be the Ministry of Finance, so the issuer in Japan, the equivalent of the US Treasury. And we think it's likely they will also skew issuance less to the long end that can support back-end rates. For front-end rates, we think they go higher. We think the Bank of Japan will hike again in October by 25 basis points, and that the eventual terminal rate they get to is going to be quite a lot higher than the market is pricing in.
And Sam, this is all in the assumption. I mean, this is what oil at 80, 70? I mean, it's not like a huge spike because something happens in the Strait of Hormuz or something. We look at oil every day. I mean, we now have some analysts calling $150. I mean, is there a reaction function where, Donald Trump says this is not possible, Saudi has to open and put a lot more oil out there?
The way the market so far has been trading what an escalation in the Middle East that pushes energy prices a lot higher will mean for central banks is that the market thinks it means central banks will be more hawkish. We've seen that rate cuts for the ECB have been getting actually taken out. The front end's been selling off. We disagree with that. Okay. We think that while there is a short-term inflationary challenge, it's actually not unbearable for the ECB. So a 10% move in oil translates to 18 bips on peak cumulative impact for inflation over 1 year. So if oil were to rise to 90 to 100, say a 30, 40% move from here, that's 60 bips for the ECB on inflation. It's a lot, but it's not unbearable for them when they consider the fact that recession risks have also risen. Yeah. So we'd argue the ECB is more likely to cut in September. That is already our base case, but more likely if escalating tensions in the Middle East push energy higher, and the probability of cuts thereafter is even greater as well.
But Sam, I mean, just broadly, I mean, how bad does the economy have to be for the ECB to go below 2% interest rates?
I think the ECB sees neutral around where we are now, perhaps even 25 bips beneath where we are now. So for them to go below 2 with one more cut, I don't think the economy needs to be bad. I think from the ECB's perspective, that's normalizing to neutral, having had policy that's very restrictive. I think for them to go meaningfully lower than that, we would need to see a recession. Certainly not our base case.
What are you expecting from the ECB?
Look, it's pretty tough, right? I mean, the ECB has really cut rates a lot more aggressively than the Fed. I mean, Trump would tell you that even in his post, right? And so we've heard from different central bank policymakers since that cut. Whether one more or not seems to be baked in, at least from a market's perspective. If you look at overnight swaps linked to meeting dates, that pretty much seems to be the base case as well. The ECB certainly does also have room. If you have the SMB, Norges banks all preemptively, defensively rather, cutting rates now, given those concerns on the economy, I agree that there is definitely room for that. But what's interesting for me as well is the role of the euro rising despite that narrative as well, and the calls from Lagarde, Schnabel, and the rest of them really talking about the euro rising as that alternative reserve currency of the world. Perhaps not dethroning the dollar entirely, but certainly making the case for it to continue to rise despite that dovishness. And that also gives the ECB more room to operate, right? And I think that potentially sets up the argument for the post-summer of whether or not we see the dovish reaction function really pick up from those developed central banks.
And so I'm going back to, the Bank of England. I guess one of the main concerns is that if you have a vote that's not, I mean, markets really latch on to one vote. The complexity of how MPC operates, seeing the individual votes could mean that the market gets a little bit skewed.
Today isn't a non-event. It's important. The market will, as always, be very attuned to anything that we get that signals its reaction function. The call that we have that I think for the Bank of England that's interesting is that they'll end active gilt sales, in our view, much quicker than the market expects. We think in September they'll announce it, and in October they will implement it. And that ties into this general theme, BOJ, reducing pace of QT, DMO, skewed issuance short-term. Treasury might issue fewer coupons than people expect. Ministry of Finance in Japan, similar. It's governments issuing sovereign bonds, central banks concerned about the long end beginning to some extent to push back.
So interesting. Thank you both for joining us. Bloomberg's Noor Al-Ali and Sam Linton-Brown of BNP Paribas. Now, coming up, Bloomberg's Jumana Bersetchi as the U.S. prepares for a possible military strike on Iran. That conversation up next, and this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back to Bloomberg Markets, everyone. I'm Francine Lacroix now. Let's get a quick check on the markets. Equities definitely declining. Investors worried about a number of things. So first of all, they're seeing a growing likelihood of direct U.S. involvement in Israel's conflict with Iran. We'll have a full rundown from Jumana shortly. And then, of course, the Federal Reserve Chair, Jay Powell, warning of meaningful inflation ahead. So that's not only impacting crude. You can see Brent at $77, euro dollar 114.74. We do have the Bank of England a little bit later, 134.23. The voting will be important, although we're not expecting them to move on interest rates. We did have a big surprise from Norges Bank today, so just watch out for any surprises. And S&P futures down 0.4%. So this is moving markets. The U.S. possibly preparing for a strike on Iran in the coming days. Well, sources telling us here at Bloomberg that the situation is still evolving and could change. Well, joining us now is Bloomberg's Jumana Bersetchi. Jumana, it does feel like everything is pointing towards that direction, but what's the likelihood that diplomacy comes in? I mean, President Trump is very uncertain. He says he could make the decision at the last second because the situation is so fluid.
And that's exactly the decision that is facing the U.S. president right now, either to use this vulnerability in the Iranian regime, the various military setbacks that they faced over the course of the last 6 days, to bring them to the table, to force their hands really to accept more onerous requirements when it comes to those nuclear deal discussions. Remember, the U.S. had been pushing for zero enrichment. The Iranian stance was that zero enrichment was a red line for them. Perhaps their perspective has changed. And indeed, the Iranian foreign minister put up a post yesterday on X saying that they always wanted to pursue a path of diplomacy, but they will not do it as long as Israel continues its attacks on Iranian infrastructure. Now, when it comes to the U.S. decision, U.S. officials did tell Bloomberg overnight that they are preparing plans for that military strike to come in coming days. So if it does happen, it should happen within days. The decision still rests with President Trump, though his tone has shifted to notably a lot more hawkish in the last few days, demanding that Iran surrender unconditionally. And on the back of that, we heard from the Ayatollah himself, a televised speech that he gave yesterday in Iran, saying that the Iranian regime will not capitulate easily, very defiant terms, and also warning that if the U.S. decide to join in Israel on these strikes, then they would have to respond in kind as well, warning irreparable damage on U.S. assets and a proportional response should the U.S. choose to get involved. So what is facing the U.S. president right now is a choice of escalating the situation and potentially drawing in the broader region into this conflict, or pushing once again for the diplomatic resolution, which is what many countries in the region are also pushing for as well.
Yeah, Jaman, I wanted to ask you actually about, leaders in the region. There hasn't really been a condemnation of the strikes that Israel has put on Iran, but a lot of concern about what happens next.
That's right. So they were very quick to condemn the attacks that Israel conducted on Iran. On Friday morning, actually, one of the first foreign ministries to put out a statement was the Saudi Arabian foreign ministry. By Monday, you had a joint statement from 21 Arab and Islamic states, Islamic countries, joining that tone, condemning the actions, and also reaffirming that they would like to see a diplomatic solution to this. There has been a lot of pressure from GCC states on the U.S. to apply, in turn, their leverage on Israel to reduce the intensity of attacks and try to bring Iran back to the negotiating table. But I think for many Arab states, the intensity of the strikes did come as somewhat of a surprise, despite the rhetoric that Israel has been pursuing the last couple of years. And now there's a real concern in the region that this could be not only politically destabilizing, but also economically destabilizing as well, Francine. The last few years, many of these countries have been focused on their economic diversification agenda. This just throws a lot of uncertainty into the mix, especially if you think about going one step further, the real possibility of regime change and what that could entail in terms of knock-on effects for the region as well.
Jumana, when you look at efforts to contain this escalating conflict, it seems like there are talks between foreign ministers from UK, France, and Germany and their Iranian counterpart. Will that make a difference?
So you're referring to a meeting that is scheduled to take place in Geneva tomorrow with the Iranian Foreign Minister Abbas Araghchi. He's set to be meeting with his counterparts from the UK, Germany, and France to talk about the nuclear deal, potentially restoring the nuclear deal. But at this point, the Europeans don't have a lot of leverage in terms of what is transpiring in the Middle East right now. Ultimately, the decision to get involved militarily is going to fall back on President Trump. And this is what the whole world is waiting to see. And yes, Arab countries are looking to mediate. And yes, European leaders are looking to de-escalate. But at the end of the day, Francine, it is up to President Trump. And no one has a crystal ball into his head.
Jumana, thanks so much. Bloomberg's Jumana Barsechi there with the very latest, of course, on the Middle East. Now, still ahead, the IAEA Director General, Rafael Grossi, on damage to nuclear sites in Iran. That's coming up next. We continue following the markets. A reminder, treasuries and cash equities, of course, closed today because of Juneteenth. This is Bloomberg.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Welcome back to Bloomberg Markets. I'm Francine Lacqua. Now, the IAEA Director General, Rafael Grossi, discussing the extent of damage at a number of Iran nuclear facilities. Take a listen.
We are following as good and as much as we can every military activity and assessing the radiological impact of those. For example, I informed that in Natanz, this facility that sustained the most, I would say, serious damage, there has been some contamination, but it is contained inside the perimeter, if you want, of the facility. So there is no immediate danger for the population. Then, if you move to a higher amount of material, like for example, these highly enriched uranium and more, because there is not only, let's not forget, there's not only the 60%, there's the 5% stockpile, there's the 20% stockpile, there's a lot of nuclear material around in the country. And of course, a direct impact would have a radiological consequence, which would be commensurate with the attack. So this is why I unfortunately cannot be as precise as I would like to, because it would depend if only a part of it is affected or more.
Coming up, Valentin Marinov of Crédit Agricole. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past
to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back, everyone. Bloomberg Markets. I'm Francine Lacroix here in London. Now, let's quickly check on the markets. Quite a lot going on. Equities declining. Again, investors seeing a growing likelihood of direct U.S. involvement in Israel's conflict with Iran. The Fed Reserve Chair Jay Powell warning of meaningful inflation ahead. A reminder, of course, treasuries and cash equities, closed today because of Juneteenth. Now, sentiment definitely turning a little bit more cautious after Bloomberg reported that senior U.S. officials are preparing for a possible strike in Iran in the coming days. You can see that's really weighing on oil, 77.15 for Brent crude, and then you see S&P futures down some 0.4%. Now, to discuss all of this, the route forward for central banks, we're now joined by Valentin Marinov. He's head of G10 FX research and strategy at Crédit Agricole. Valentin, thank you so much for joining us. Let's start with what Jay Powell was saying yesterday, because he said basically there's no uncertainty. There's a lot of uncertainty. Nothing is certain apart from the fact that he thinks inflation will go up.
And that has been Fed's key message throughout the year. Investors have tried to push against that for a number of reasons, but it is clear that the Fed won't be moved. And indeed, they stay the course, and rate cuts, at least for now, are off the table. Because of the inflation.
But Valentin, I mean, again, there's a difference between surveys and the data. When does the inflation really starts picking up? And is there a danger that GDP goes down, inflation goes up? We're looking at stagflation.
Well, I think that over the summer we're going to see clearer evidence that the tariffs are starting to filter into the harder data, and therefore the Fed's expectations will be confirmed. As a result, essentially the stance at the moment will definitely be justified. So from that point of view, it's only a matter of time, in our view, really to see harder evidence that's indeed the case. But to your point, the stagflationary conditions may still warrant some easing down the road. We think that fourth quarter of this year, we could have reached a situation where the real economic weakness may warrant indeed some Fed action.
What does it mean for dollar, and what does it mean for gold? I know you like gold. Everybody likes gold.
Yeah, gold is the ultimate hedge in the current environment. Again, both against risk aversion, but also against currency debasement. What I wanted to emphasize here today was the fact that the contrast between the Fed's message yesterday and the fact that, so far, yesterday and today, we had 3 European central banks that cut rates. And indeed, that emphasizes how different the outcomes, the macro outcomes so far this year have been for the US on the one hand, I guess Europe on the other, and how much the likes of Norges, SNB, and the Riksbank, the ECB have been surprised by the combination of trade war, but also currency appreciation that could force them to cut rates further still down the road.
I mean, Norges was a real surprise, and not only did they cut today, the markets wasn't expecting it, but they said they'll cut further. Is it because in absolute they're just too high?
Well, that plus the fact that, as highlighted, that the Norwegian crown has appreciated slightly more than they were expecting. Mind you, that the weakness of the currency in the past was one of the key reasons for them to really keep rate cuts off the table. Right now, with that concern seemingly having abated, they are much readier to respond to, obviously, disinflation and presumably any negative impact from Trump's trade war on the Norwegian economy. So I guess as a result, the grand total of the more recent developments makes European central banks, including the ECB, more likely to cut rates than the Fed.
But, I mean, with the Norges Bank really taking markets by surprise because of guidance, could you see other central banks surprise?
Well, I guess it's really very much a function of what's been happening in the economies and, I guess, on the FX side as well. But the way I see it, that should, say, for example, the euro appreciation were to persist or the Swedish crown's appreciation to persist, that will be, over time, met with some potential further easing. So I guess the FX markets being forward-looking, the prospect for rate cuts should act as a corrective. So we have to all incorporate all of that into our forecast. So therefore, I mean, on the FX side, we do not expect any significant further gains, given the threat that it may cause further easing. But in the big scheme of things, Norges, in that context, may have more ample ammunition to ease than, say, the ECB or the Riksbank. So the threat may be more significant.
Valentin, Bank of England. I know people say it's a non-event. It's never a non-event.
Yeah. But in the current context, I think the Bank of England will be very much the outlier in terms of as far as European banks go. We do not expect a cut. We do not expect a cut anytime soon. On the whole, the outcome today could be described as a comfortable hold from the MPC. It is the case that, different from the economies on the continent, the UK relies much less on trade. We also actually have the beginning of a trade deal with the US. We have the thawing of the relationship with the EU. All of that should bode well for the economy as a whole. And at the same time, UK still has the highest wage growth rate. I mean, of all of Europe, inflation is quite sticky. So I think a comfortable hold where essentially almost unanimous majority in favor of stable rates today.
And what happens to sterling?
Well, the pound, I like it. It trades at a pretty steep discount given its rate advantage versus euro versus other currencies. We are bearish euro sterling. In cable, I guess it is the case that at the moment, at least, the dollar is back to its old king dollar self for the time being. So I wouldn't be surprised if cable or sterling could lose some more ground against the dollar. But the pound, I think, one of the outperformers among the European currencies.
Valentin, as always, thank you so much for joining us. That was Valentin Marinov of Crédit Agricole. Now, we're also, as we were hearing, counting down to a BOE rate decision in just over 90 minutes from now. Joining us also on the BOE is Bloomberg's Ven Ram. Ven, I know you're very good at actually, cutting through the noise to get to what's important for the Bank of England. What are you expecting today?
Thank you, Francine. I think that, the Bank of it's pretty much a foregone conclusion in the markets that the Bank of England will hold their rates. I think the key for the markets will be two things. One is the vote split. The markets are expecting 7-2 split in favor of holding, but I wouldn't be surprised by 7-3. Anything more than that would be pretty dovish. The other thing that the markets will be watching is the language. And the Bank of England has previously said that they're going to be careful in cutting rates going forward. And I think that, what has happened since then is that energy prices have shot up 20% this month. And that will have the BOE mighty worried in the context of a UK economy that is extraordinarily vulnerable to imported energy inflation. And therefore, I think that the BOE will really have no chance of signaling a dovish stance today. And I think that will rub off on gilts, which will find it a struggle to eke out further gains from here.
Ven, I mean, I know you've been writing extensively also about the Swiss franc. I mean, I think that the two big things today is probably what we heard from the Swiss National Bank and Norges Bank. What do you think is more of a template of what could happen elsewhere?
Well, I think that, what we have seen in the cycle is that, there are some idiosyncratic factors working in favor of the markets, like the Norges Bank decision. As much as it was a surprise today, it needs to be seen in the context of a Swedish central bank that cut rates yesterday. So, and Sweden and Norway economies have very close linkages, and therefore it was kind of not a total surprise that Norges Bank should have cut rates today. As far as the SNB is concerned, even though they cut rates and kept the language to suggest that they're going to be dovish going forward, I think that Shelgel has been pretty hawkish in the press conference, saying that he doesn't want the unwanted side effects of negative interest rates, and that the bar for the next rate cut will essentially be higher than the markets think. So, which is why we have seen the franc rally this morning, and I think that feature will continue in the weeks to come.
Ven, when you look at, I know you spend a lot of time also looking at BOJ. Is there a general worry that, the focus is really on QT being unwound and some of the effects that could have, whilst also looking at, divergence of banks, something that we haven't really seen for the last 5 to 6 months?
Yeah, absolutely. I think that, the Bank of Japan has been kind of dragging their feet on further rate hikes. And I think that, normalization of policy looks further and further away, especially given the tariff concerns. And now they've got the bond market that's been in a pickle for a while. So I think that's going to be a drag on stocks. And I think that, stocks have outperformed fantastically in Japan for the past couple of years. And I think that increasingly investors will start to question the valuations. As far as the yen is concerned, I think that, it's struggling to make further headway. And I think it's vulnerable if the dollar kind of recoups some of its losses that we have seen in the recent weeks.
What's the most interesting then over the next 7 days? We're also looking at oil. There's so much anxiousness out there. Is there a data point? Is there a central bank that you're looking for guidance?
Well, I mean, I think, it's been, as we have seen in the past 24 hours, central banks are remarkably dovish and hawkish at the same spectrum, even within the DM market. So I think that, each market is kind of behaving differently and the dynamics are different. But I think that the most interesting market at the moment is what happens in the UK because of the vulnerability that I mentioned earlier of the UK economy to imported inflation. Now, if you look at inflation in the past decade in the UK, it's averaged 3.1% thereabouts. So in an environment where the economy is even growing below trend, say well less than 2%, but say 1.5%, and you add in an inflation rate of 3%, that means that the terminal rate can't really go below 3.75, 4%. And that is where I think that the markets are kind of mispricing what is likely to happen. I think that the markets are much more dovish than the outcome from the Bank of England over the next 6 months.
Thank you so much, as always, for your wonderful insight. I urge everyone to go on the terminal and, of course, our website to read Ven's pieces. Now, coming up, more job cuts for Microsoft. The tech giant planning to lay off more workers, this time in sales. More on that story next. And this is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Welcome back to Bloomberg Markets. I'm Francine Lacqua. Now let's quickly get a check on the markets. A reminder, happy Juneteenth, everyone. It means that U.S. equities, but also cash equities and treasuries are closed for the day. But I would focus really on what's happening with crude oil because of the concern out there in the markets that the U.S. will get involved with strikes in Iran. Now, Donald Trump has been really on the fence of this, but there is concern that's weighing on risk assets, and then Brent, and you can see WTI gaining between 0.2 and 0.6%. Now, Bloomberg has learned that Microsoft is planning to cut thousands more jobs as the tech giant spends more on AI. Now, this after 6,000 workers were laid off in May from product and engineering positions. Well, joining us now with more is Bloomberg's Charlie Wells. Charlie, thank you for joining us. If you look at, Microsoft, so how and why is Microsoft actually trimming its workforce?
Those are really good questions, Francine. And really, this news of these cuts really gets at some interesting issues that we've been trying to watch in the labor market, right? So the data on the labor market has been a little bit messy here, and we've heard a little bit about, say, a white-collar recession. This kind of feeds into that narrative on one front. But there's been this other talking point about how, workers are worried that AI will replace their jobs. Some experts have basically said it's too early to make those kinds of pronouncements. But what we're seeing here is the potential that it's not AI replacing jobs. It could be AI spending replacing jobs, right? Because Microsoft's share price has been performing incredibly well over the past few months. They are now the world's most valuable company by market cap. And basically, they've been able to keep a lid on pretty much all other expenses except AI spend. And so that is where some of these job cuts that Bloomberg is learning about seem to be coming into play.
On Amazon, because we have 3 tech stories that we need to watch out for. So Bloomberg has learned that Amazon will actually be ordering some employees to move closer to their managers. What's the rationale?
So a lot of employees are not going to be happy about this. So Amazon earlier this year...
We love being close to our managers.
Yeah, sure, Francine. So earlier this year, Amazon implemented this policy of workers needing to be in office 5 days a week. But they did not specify precisely where those workers needed to be. And a lot of these staffers work in satellite offices in places like Dallas or Austin or Boston, even New York City. So this would be a requirement, at least according to people familiar with the matter, that some staffers return to these hub locations like Seattle or Washington, D.C.
And we're also learning that OpenAI is phasing out its work with Scale AI. Why?
So look, we are just seeing competition in the AI space heat up. And OpenAI has said that they were scaling this down over the past few months, but it is interesting timing because Scale AI, as we all recall, just received some $14.3 billion in investment from Meta. Meta, of course, is a competitor with OpenAI. And one of the concerns with that investment, with Meta taking a 49% stake in Scale AI, is that it would give Meta a view into some of its competitors' AI developments, right? So OpenAI or Google. So the company says that this had been in the works for a long time, of course, but that competition issue is certainly live right now.
So how does it play out?
I mean, look, I think what we know is that the race is heating up. There have been fighting words. We were just hearing earlier this week about Sam Altman talking about these, signing bonuses that Meta has been offering to staffers from OpenAI. So that's on the staffing front. We're hearing more on the business front. These sorts of things play out. So AI is so young, but we are already seeing it grow up quickly and move from a space where it seemed incredibly collaborative, everyone was willing to work with everyone, to a space that is just so sharp-elbowed.
Thank you so much. Our Charlie Wells there with the very latest on some of the tech companies. Tune in tomorrow for the premiere of Bloomberg Tech Europe with Tom McKenzie. That's at 6:30 a.m. in London, 1:30 a.m. Eastern Time. Now, coming up, LVMH under pressure thanks to a demand slump in major markets. That conversation is up next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Welcome back, everyone. This is Bloomberg Markets. I'm Francine Lacroix here in London. Now, LVMH facing a 221 billion euro slump as pressure continues to build on the chief executive, Bernard Arnault. Well, joining us now is Bloomberg's Angelina Rasquet. Angelina, you wrote a very, very good, of course, big take on the challenges right now at LVMH. Can you just lay out what these challenges are?
Hi, Francine. Thank you. Indeed, I mean, the industry backdrop is difficult, it's challenging. We know that demand in the two biggest growth engines of the past few years, the US and China, is suffering. But there are internal problems at LVMH, and in our story, we focus particularly on Dior, as well as Moet Hennessy and Louis Vuitton. Basically, Dior and Moet Hennessy have been culprits in the past few years of hiking prices too much. So there's been a consumer backlash. Dior, which is headed by Delphine Arnault's eldest child, there was also a supply chain scandal last year, which generated a lot of bad press. So basically, in the past 2 years, since LVMH shares reached a record in April 2023, shares have halved basically, and so that shows you the tough times. But that hasn't prevented Arnault and his family from buying more than 1 billion euros of LVMH stocks since the end of January.
So, Angelina, when you look at some of the things that they need to do, like how difficult is it going forward? I know a number of their competitors also had similar issues, but it has been better for them than others?
Indeed, Francine, when there was a rising market, I mean, basically LVMH is a group that has 75 brands, and those 75 brands are in different industries. They have different margins, and when the market was rising, maybe investors were more willing to ignore those differences. But now we're seeing more the conglomerate discount when the market is suffering, when it's a bit more shaky. And what we found out is that in the past recent years, LVMH actually studied potentially listing Sephora, one of its assets in Amsterdam in 2021, and Diageo, which has a stake in Moet Hennessy, 34% stake. They actually asked to study the potential spin-off of Moet Hennessy, which was actually dismissed by Bernard Arnault. But again, I mean, for sure they're going to be doing strategic reviews, portfolio reviews.
Yeah, I like, Angelina, the fact that you really, double down on the conglomerate discount and you tried to figure out what that means. And it's really interesting what you found that you've just laid out. What are people saying about succession and governance?
LVMH, indeed, LVMH is a family-controlled business. The Arnault family is a main controlling shareholder, but also all of Bernard Arnault's children have prominent roles inside the company, whether it's Delphine, the eldest, or Jean, the youngest, who works at Louis Vuitton and is in charge of developing watches. Bernard Arnault is 76, and recently he actually lifted the age cap of the role he holds of the CEO from 80 to 85. So basically he's signaling that he intends to stay for the long term. But between the children, there's not an obvious successor. And actually last year, Arnault named a deputy, Stéphane Bianchi, who's not really that well known by the market and the investors. He joined LVMH in 2018, so relatively recently. He's 60, and his track record is actually that he led a much smaller family-held consumer companies, but he mentored heirs. And recently at the LVMH AGM, he was asked, he actually answered a question of what would happen in case of a sudden event. He said, in case of a sudden event, there is a plan, but obviously he didn't reveal those details.
Of course not. Angelina, talk to me a little bit about Kering. So this is a big rival of LVMH, and they actually, just announced earlier this week that they would have the Renault CEO becoming the CEO of this other huge conglomerate.
Absolutely. So that was a very surprising move, moving from the automakers industry to the luxury industry, because generally luxury, it functions in a closed circuit. Even though in recent years they've hired people from fast consumer goods. If you think about the CEO of Chanel, Lina Nair, she comes from Unilever. But also top executives have been hired from Nestlé, from Procter & Gamble. However, from the auto industry, that was really I don't think it's for such a prominent position if it ever happened. However, the track record of Luca De Meo at Renault, he spent there 5 years at CEO. He turned it around, and shares simply doubled. So François-Henri Pinault, who's going to be remaining chairman, and he was CEO and chairman, so he'll keep the chairman role. He probably hopes that Luca De Meo can do that at Kering, because they've been trying to turn it around, especially their biggest brand, Gucci, but so far it hasn't worked out.
Angelina, thanks so much. As always, Angelina Rasquet there with the very latest on luxury, and I will urge everyone to go and read her big take. We'll push it on social media. You can, of course, find it on the website and on the Bloomberg terminal. Coming up on Bloomberg Markets, Tim Urbanovitz of Innovator Capital Management, as Fed Chair Jay Powell warns the impact of tariffs are coming. That's next, and this is Bloomberg.
is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I am never doing that again.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Thursday the 19th, good morning. 11 a.m. in London, that means it's 6 a.m. in New York. I'm Guy Johnson. Welcome to Bloomberg Markets. It is, of course, Juneteenth in the United States. Markets are closed. But let's talk about our top stories this hour. Israel and Iran enter a 7th day of conflict, with sources telling Bloomberg that U.S. officials are preparing for a possible strike on Iran in the coming days. The Federal Reserve holds rates steady for a 4th consecutive meeting, but Jerome Powell signals that the tariff impacts, quote, are coming. And global central bank rate decisions continue. The Norges Bank shocks with a surprise 25 basis point cut. The S&P drops to 0 as it looks to stop inflows into the franc. Up next, it is, of course, the Bank of England's turn. That's in 60 minutes' time. We will, of course, bring you that decision live. Let's talk about the markets, figure out exactly what is happening. As I say, the US markets are closed. That means we see a light volume around the world, but there is plenty of news flow to focus on. Stocks generally are a little off. We're not down that much. We're down by 0.4% here in Europe. Brent is going nowhere. I think we're waiting for the next move out of the Israel-Iran story. You've got a pound that is unchanged as well, waiting for the Bank of England. But elsewhere, you are seeing some movement. So the Norwegians this morning surprised with a 25 basis point cut. We've also seen the S&P cutting to 0, and in some cases below 0. Let's talk about all of this, figure out exactly what we should take as important, what is not important, what we're waiting for, what we can factor in. Nurul Ali joins us from our M Live team, Markets Live team. Good morning.
Good morning.
So a few surprises this morning. We'll park the Fed for a moment. We'll come back to that in just a second. But let's talk a little bit about the Norwegians. The Norwegians have cut. We didn't see that one coming.
What a defensive play from the Norwegians. I feel like I'm watching a football match, Guy, just waiting for the next, where does the ball go next? And it's that concern, that's uncertainty that even the Fed talked about yesterday. We think it may be inflationary for the U.S. Of course, Powell's saying that's where the consumer may have to pay the price for. Yep. But the Norwegians and the Swiss, but looking at what that effect means globally, and that's potentially deflationary, and they're defensively cutting the rates. Reminder, the ECB has cut has cut quite a bit this year. Yep. And now you've got the Norwegians backing it up. What's interesting, though, is that geopolitical risk, right? If we know, the Norwegian krone is a commodity currency, so that rise in oil prices should typically see it catch a bid, but that relationship is fraying, right? Just because of that concern about that global economic backdrop, that rate impulse really taking a step higher and dictating the effects market moves.
The Swiss have got a really big problem, as much as basically in a world that is as uncertain as it is right now, if you want to be long uncertainty, you are probably long the Swiss franc. And that's the issue here.
Yeah, absolutely. You are long havens, right? We've seen gold really rise. We've been struggling again to break that record that we've seen set earlier this year. And now it's back to that currency play. Interestingly, though, we're also seeing the dollar pick up, right? But still, the Swiss franc this morning, top G10 currency, easy. Even though you had the S&P cut rates, even though now we're talking again about zero interest rates, guys.
Yeah.
What a time.
In some cases, negative. They've actually, if you put enough money on reserve, if you're a bank, you've actually got negative rates to deal with now.
Absolutely, you do. And right now, still, the Swiss franc still higher. That haven demand really leading the market higher. You're seeing the market really just effectively hedging for risks. We don't know where they're coming from. You've got tariffs, you've got geopolitics, you've got Fed on hold. You know, just last year, we were talking about the Fed cutting a lot more than it did. And now you've got some people talking about the Fed effectively not cutting at all this year.
Yeah. Let's talk about the Bank of England. Is the Bank of England going to be boring? No cut this time, but maybe a cut in August.
I can never say the Bank of England is boring, Guy. I
think sometimes they think they want to be boring. Maybe this is one of those moments. We're just going to sit on our hands, be like the Fed. We're not going to do anything. We'll wait and see exactly what some of the impacts are going to be.
Absolutely. I think the impulse for the Bank of England, Bloomberg Economics also backs this view, is they're going to continue to back that one cut a quarter this year. They've been very predictable, which is excellent. That's what you need from a central bank, at least. But you also need to consider the fact that you've got central banks around the world reacting preemptively to those tariff risks. We've seen the ECB cut rates a lot more aggressively than the Bank of England. You've got Norges cutting today as well. But then if you have the Bank of England standing pat, I think that risks, the idea of, discussions of whether or not we've got policy complacency, whether there's a policy mistake here being put. Reminder, though, the UK imports about 70% of its inflation. So they've got their hands tied. I mean,
energy prices are going up. And that's going to be a problem. That's how you relate it back to the geopolitical story. Was the Fed boring last night? I'm struggling to find a difference between what Powell said last time and what he said this time. There were tiny changes.
Yeah, absolutely. Look, I mean, if you're in Trump's seat and if you're watching everything that's playing out politically, it wasn't boring, right? Trump had called for a 2.5% cut. That obviously was not delivered. Instead, you have a central bank that is really concerned about the effect that the consumer will have to eventually pay up when it comes to the tariffs. Obviously, we're still waiting whether or not more deals will be made. Trump came into the G7 this week wanting to make deals. He took in his top brass with him. However, he had to cut that trip short because geopolitics risk really took precedent. Whether that continues, we've got PMIs coming in next week. Are they going to still show that concern from those surveys? Businesses really worried about who's going to pass on that price import or that cost increase. And in that light, you'd expect the Fed to really stand pat, just trying to figure things out. Whereas in Europe, we're acting. We're moving a lot faster.
Consumers are going to pay, or is it going to be shareholders that are going to pay? It's going to be one or the other. No, great stuff. Thank you very much indeed, Nurul Ali, joining us on what's happening with the markets. Let's continue the conversation around what is happening with the Federal Reserve, holding rates steady once again, fourth time. But the Fed chair, Jerome Powell, signaling that tariff impacts are coming.
Despite elevated uncertainty, the economy is in a solid position. We expect a meaningful amount of inflation to arrive in coming months. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are. The current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments.
What do you make of that? Tim Ivanovitz of Innovator Capital Management joining us down the line to figure out exactly what we should make of what Powell had to say. What do you make of what Powell had to say last night? He didn't change very much, but the fact that he didn't change very much is significant.
Well, Guy, I think my key takeaway from everything he said yesterday was that as long as the economy remains in decent shape, the Fed's not going anywhere. And this has been a long-held view of ours, is that you are not going to see the Fed cutting this year. The two cuts that the market has priced in right now, we don't see coming. And Guy, that's been a very consistent trend that we've seen from market expectations, 6 months out to what actually plays out. Very consistently over the last year and a half, 2 years, they've been 2 to 3 cuts off. And we think that's going to be exactly the same now. There's a lot of inflationary pressures, not just tariffs, that we see on the horizon.
So they sit tight. So what does that mean the next move is, Tim, and when does it come? You're signaling higher inflation, but at some point there's going to be potentially a weaker labour market to factor into our thinking as well.
Well, we have to wait and see that. And that ultimately is the key. As long as you have a strong labor market, I think it's going to be tough to get inflation back down to that 2% target. And if we take a step back now, Guy, I think you have to look at this in the context of everything else that's coming. You look at the spending bill, the tax cuts that's coming out of the Trump administration that should likely pass in the summer. You know, that is going to be potentially inflationary in nature when you're packing that on top of an already $2 trillion deficit. And then more immediately, when we look at this situation in the Middle East, you know, if the U.S. gets involved, if they don't, we still see energy prices heading higher here. And yes, energy makes up a smaller component of the CPI basket, right around 6%. But if you look at its impact, the impact is much more broad. You know, going back to the 80s, that component explains about 21% of the entire variation in CPI overall. So you look at these forces, we see the Fed on hold for the foreseeable future, and 6 months from now, we'll reevaluate.
Could the next move be a hike? That feels like it's unlikely, given the fact that we're about to see, obviously, a new Fed chair being announced. It feels like there are other factors that are going to come into play here. How much longer do you think the Fed can be sitting on its hands doing nothing? I hear what you're saying about the operating environment they're working with right now, but politics feels like it's a greater and greater force that is playing into this story.
Well, we don't see necessarily a hike coming. I think overall policy is in a very good place, and I think we're actually pretty close to that neutral rate, much more so than I think a lot of folks out there think. But, Guy, this is not 2022. We don't think there's a huge inflation spike coming. It's more that inflation remains sticky. And when we think about the investment playbook in this environment, I think it looks much different than what you saw in 2022. And a big component of this, I think, is cautiously leaning harder into equities as a way to protect purchasing power and leaning away from things like longer duration fixed income. And a big piece of that, if you look at these companies, especially those with strong pricing power, they have the ability to really pass those costs onto the end consumer and protect you as an investor.
Are you confident in that? Because at the moment, that's not what we're getting. At the moment, what we're getting is companies sucking it up, and that appears to be the story that's come from the latest inflation prints. I appreciate that Powell's talking about inflation coming later, but the latest evidence, certainly from the latest CPI print and the PPI print, is that companies are absorbing that. You think that doesn't last? You think that ultimately these prices get passed on to the consumer? When does that happen?
Well, I do think that, and I do think there's going to be a bifurcation in the market. And I think that's why right now we're talking to our advisors. It's really about leaning into those companies that do have superior pricing power. One area of the market that we continue to focus on is this AI infrastructure trade. You look at demand is off the charts there. They have tremendous pricing power because of that demand. Other areas like retail, it may be a struggle, especially for those stocks that cater toward the lower end consumer that has already been struggling. They're not able to absorb those price increases the same way. So do think there's going to be a bifurcation. But at the end of the day, Guy, we think the impact from tariffs is going to be more about demand destruction like you already have seen. I think that's why we saw the softening in CPI on the last print, because you do have that confidence that has been shaken. And again, we have to step back and view this in light of everything else that is coming. This tariffs are not in isolation. You also have to view this in light of all the tax cuts that are coming. Especially things like no tax on tips, tax cuts for seniors. Those are all very important, which we think they somewhat are offsetting forces.
Tim, great to catch up. Thank you very much indeed for joining us on this holiday. Tim Ivanovitz of Innovator Capital Management on what the Fed is going to do to the market, what the oil price is going to do to the market. Talking of the oil price, we need to focus back on what is happening in the Middle East. Bloomberg's Jumana Basecci is going to be joining us as the US prepares for a possible military strike on Iran. We are waiting to see which way that decision is going to go. We'll be joined by Jumana next. This is Bloomberg.
is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
40 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson. So let's check in on the geopolitical story that we are focused on this morning. The US apparently preparing for a possible strike on Iran. It could come within the next few days. Sources are telling us here at Bloomberg that the situation is still evolving and could still change. The US President, Donald Trump, refusing to give a clear answer on what he wants to do next.
You don't seriously think I'm going to answer that question? Will you strike the Iranian nuclear component? And what time exactly, sir? Sir, would you strike it? Would you please inform us so we can be there and watch? I mean, you don't know that I'm going to even do it. You don't know. I may do it. I may not do it. I mean, nobody knows what I'm going to do.
We watch with interest. Damage to nuclear sites in Iran, top of mind right now as fighting between Iran and Israel continues. I think we're on to the 7th day now. The IAEA Director General Rafael Grossi discussing the extent of the damage at a number of facilities in Iran.
No country in the world is enriching uranium at this level of 60%, which is technically almost equivalent of 90%, which is needed to have a nuclear weapon. At the same time, we are inspectors. We are not political analysts or national political officials. So we have to have concrete proof in order to say that there is an active program to make a nuclear weapon, which we have not seen. That doesn't mean that they are in a territory which is of concern. And this is the reason why there is international concern, why I had a very, I would say, serious report that I presented, as you may know, to the Board of Governors of the IAEA a few days ago. I should also mention that in my conversations with my Iranian counterparts, they have always reminded that there is a fatwa from the leader saying that no nuclear weapon would be compatible with Islam and things like that. But at the same time, I have told them that many high officials have said that Iran has all the pieces of the puzzle, so to speak. So there has been a lot of ambiguity, and this is never good.
Director General, there's a real question about what type of nuclear risk there is should there be some sort of explosion at some of these facilities. I know you've been directing a number of studies on this. What have you detected so far, and how concerned are you that a direct strike on Fordo in particular could release nuclear material into the environment?
Well, there could be, of course, a release. We are following as good and as much as we can every military activity and assessing the radiological impact of those. For example, I informed that in Natanz, this facility that sustained the most, I would say, serious damage, there has been some contamination, but it is contained inside the perimeter, if you want, of the facility. So there is no immediate danger for the population. Then, if you move to a higher amount of material, like, for example, these highly enriched uranium and more, because there is not only, let's not forget, there's not only the 60% There's the 5% stockpile, there's the 20% stockpile, there's a lot of nuclear material around in the country. And of course, a direct impact would have a radiological consequence, which would be commensurate with the attack. So this is why I unfortunately cannot be as precise as I would like to, because it would depend if only a part of it is affected or more. But certainly the possibility of a radiological impact, environmental impact, exists. And as you also know, there are other facilities, including a nuclear power plant in Iran, which of course should never be touched, because this could be another level of concern and environmental damage. So this is what we see at the moment.
Director General, this is one reason why some people have speculated that there has been hesitance by Israelis as well as by the United States of truly dropping some of the bunker bombers and other types of military equipment to try to destroy some of this weaponry. Do you think that this is actually a real risk, the sort of release potentially of radiological material into the environment that you think people are taking seriously? Have you had conversations with the U.S. or Israel?
Well, we have reminded everyone, not that we need to be honest, because I think in the United States, you are the leading country in nuclear science and technology in the world. So I think there is complete awareness, and also in Israel, and in Iran, and in the region, and in Europe. I'm talking to, and I would say in the Gulf states, I'm getting lots of calls from high officials, ministers, prime ministers. They are all very, very concerned about this probability. And I think, of course, I'm a diplomat. I'm not privy to military decision-making. But I want to believe, and I think this should be the case, that the potential radiological consequences of any military action is well taken into account. What is important is to return to the diplomatic table as soon as possible, because what is at stake is very serious.
Very serious. Rafael Grossi, the Director General of the IAEA, talking about what potentially could come next in terms of this conflict and the risks that surround what could come next. Let's get an assessment of what could come next with Jumana Basetchi, Bloomberg's Middle East correspondent, joining us out of Dubai. Jumana, what is the central case? What are people talking about in the Gulf now about what the expectation is of what comes next? Is there an expectation now that the US will be involved? It feels increasingly likely.
I was just speaking to a senior official from the region, and he said to me that they are on tenterhooks, they are cautious, they are hoping for the best, but, quote, preparing for the worst. There's a real sense of heightened alert, especially given the reporting overnight, Bloomberg reporting as well. U.S. officials have said that they are now actively working on plans for the U.S. to join in the military campaign against Iran. Unclear what format that's going to take. Obviously, at this point, we're not privy to what those plans are. Those same officials said that the plans could well evolve in the next couple of days. They could change over the course of the next 24 to 48 hours. But another White House official who spoke to Bloomberg also said that all other options are still on the table as well, i.e. they haven't completely closed out on the possibility of a diplomatic solution. But what is clear, Guy, is President Trump's stance towards Iran has most definitely hardened. If you look at the post, the various things he said the last 24 hours, remember, he demanded an unconditional surrender out of Iran. He said that they know where the Ayatollah is hiding, but they're sparing him for now. So those are thinly veiled threats being leveled at the Ayatollah. Now, the Ayatollah himself actually did deliver a televised speech yesterday, and he was defiant. He said, look, we're not going to capitulate. We're going to fight back, and we're watching very closely to see if the U.S. get involved militarily. And if they do, we would have no hesitation to fight back in a proportional manner. So it is very high stakes at the moment.
Let's break it down and talk about this kind of component parts of what you've just been talking about. You talk about the worst case scenario. They're preparing for the worst case scenario. What is the worst case scenario here? Is it a radiological impact, some radiological impact coming from the use of 30,000-pound bombs being dropped by B-2 Spirit bombers that could spread across the region? Is it regime change and chaos in Iran? What is the worst-case scenario here?
All valid questions, and I think your point about radioactive substances being released into the atmosphere is certainly one consideration that President Trump will have to think about when deciding whether to get involved militarily. At this point, there's no radioactivity or radiological molecules being observed to have been released into the atmosphere. But what I would say for the Arab states, it's less so about that and more about the fear of retaliation. Now remember, the U.S. have military installations, 9 of them dotted all over the GCC. Should the U.S. get involved militarily and the Iranian side saying that they would respond in a proportionate manner, that puts those U.S. military assets at risk. The other thing that I would say as well is, and we haven't talked a lot about this in the last couple of days, but don't forget the Iranian proxies around the region. Hezbollah very much weakened. Houthis, remember, have signed on to this tentative ceasefire with the U.S., truce, I should say, rather than ceasefire. Hamas very much diminished as well. So what remains? Iraq is a big focus. And earlier on in the show, we were speaking to an analyst in the region. They were saying that one potential target area that perhaps there is more of an Iranian presence than in those other places that I listed could be in Iraq. And I think there is a real fear that should they want to strike back, that could be one country that could be set in their sights. But of course, the U.S. have military installations all around the Gulf countries.
Jumana, you talked about the Ayatollah, and you talked about the threat, the thinly veiled threat that President Trump issued. Were we to see regime change, is there any sense of what could come next? Is it chaos in Iran? Because there is no obvious alternative government here. And how fearful are those in the region of that chaos coming? Iran's a huge country, but I'm wondering what that country would look like in the absence of the Ayatollah.
Look, the question is nobody knows, and that is key to the decision making as well. And I think the whole world actually does remember the chaos that ensued after the 2003 Iraq War, after the military interventions in Libya, after the Arab Spring in 2011. Even today, there is no homogenous government that has been formed in Libya. It's divided. The country is divided into 2 parts. You still have tribes fighting amongst one another. So from the Arab state perspective, the Gulf states have done a lot in the last few years to resume diplomatic relations with Iran. I'm not saying that there is a lot of love lost between the 2 sides, but it's important to their own economic program for the region to be stable. And the biggest concern for them is chaos.
Joanna, thank you for the update. Thank you for the analysis. Joanna Basechi joining us out of Dubai on what we see in the Middle East. Still ahead, we will be joined by a former head of the Mossad counterterrorism unit on the possibility of the United States entering this conflict. We'll talk about that next. We'll carry on the conversation. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything. Thursday the 19th. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson. Quick check on where assets are right now. Remember, it's a holiday in the United States, therefore you are seeing light volume around the world. You've got European equity markets. The stock 600 down by 0.3%. We're basically unchanged. We're waiting to see what happens next. There are plenty of catalysts out there that could cause some significant change. Crude is also a little elevated, but not by much. Again, waiting, watching, seeing what happens in the Gulf, trying to get an assessment of what comes next. We've got a Bank of England decision coming in 30 minutes' time. The pound is trading 134.36. The cable rate, we're up by less, kind of 0.1%. It's not a big move. Again, looking for the catalyst. Where we do have a catalyst this morning is in Norway. A surprise cut by the Norwegian central bank, the Norges Bank, by 25 basis points. As you can see, the Norwegian currency, which remember is a commodity currency, this is an oil-producing nation. But that currency is softer today, despite the fact we have all this tension around the Middle East and a possible higher oil price coming. But nevertheless, that surprise 25 basis point decision from the Norges Bank this morning, catching the market on the hop. Let's come back to that geopolitical tension, try and get an understanding of what is coming next, because that is what the market is hanging on right now. Sources are saying that senior U.S. officials are preparing for the possibility of a strike on Iran in the coming days. President Trump speaking to reporters about the issue.
Iran's got a lot of trouble, and they want to negotiate. And I said, why didn't you negotiate with me before? All this death and destruction. Why didn't you negotiate? I said to the people, why didn't you negotiate with me 2 weeks ago? You could have done fine. You would have had a country.
Oded Aylam, former head of Mossad counterterrorism, joining us now to discuss what comes next. Oded, good morning. Thank you very much indeed for your time today. We're trying to understand whether or not Israel needs U.S. assistance in order to complete the task of destroying Iran's nuclear program. Is it required?
Absolutely, yes. Having said that, doesn't mean that Israel cannot inflict severe destruction on the complex of Fordow, where we are talking right now, but definitely we will need the U.S. aid in order to initiate such a blow that will be very hard to Iranians to reconstruct or rebuild. We are talking about a compound that is dug inside a mountain, about 120 meters inside. There is even one bomb that can really penetrate most of that, which is the BGU 57 that can be carried by the B-2 plane. And so if we want to shorten as much as possible this campaign and to bring the Iranians to the negotiation table under completely different terms, the U.S. should step forward and come across and assist us.
What would be the implications of that?
Well, you know, if you asked me this question about 2 weeks ago, or even less than that, I would say that the Iranian had the capability of striking major American places or installations across the Middle East, or even striking their neighbors and so on. But we had diminished quite a lot of their capabilities, and they're right now pretty much preoccupied in defending themselves. The Israeli Air Force, in fact, flies above Tehran completely free. I was amazed just to see the photos of Iranians shooting with machine guns towards the sky. It was more or less of Germany in 1945 and not Iran in 2025. So right now, the implication would not be severe, and I think we should all take the chance.
So a regional war is not on the list of your kind of outcomes from such a strike, because that would be the fear, that they would hit targets in Qatar, in the UAE, elsewhere around the region. The US has plenty of bases, particularly in Iraq as well. You don't see those strikes coming?
I see those strikes coming, definitely yes, but I see they are very much limited, and they don't have the capability to sustain it for a long period. Don't forget, we have already reached about between 40 to 50% of their ballistic missiles, and together, if there is a coalition, and I'm talking about coalition which include, of course, the US first, but not only the US, we can definitely limit the damage that they can inflict on the Americans and coalition targets, and bring them back as soon as possible to the negotiation table under different terms.
Okay, let's talk about that a little bit more. Why would you do that? Why would you not carry on and deliver regime change? Is it enough simply to change the narrative around the nuclear program? Or do you think regime change is ultimately the objective here?
The official objective of this campaign was to, first of all, to bring back the capability of developing nuclear devices by this regime, and to diminish as much as possible their missile capability. And those two objectives should be reached, and we can do that, because right now the campaign is proceeding in a very, very efficient and good way. But there's a hidden agenda, which is of course, changing the regime. I don't think it is possible within days, weeks, or even months, because it's not Syria. It's not that there are strong militias and all you have to do is bring them together and charge with Toyota SUVs straight into Tehran. That's not the case. The things should come from bottom up in Iran. I don't see right now the leader or the group that can do it, but we have to think of changing the regime on the medium long term.
The President of the United States issued a very, very thinly veiled threat to the Ayatollah. How seriously should we take that?
They are with their back to the wall. They are a wounded animal, and so the threats are becoming more and more vigorous and more threatening. I don't think this is the case right now. I think the Ayatollah regime is in the lowest position since 24th August 1988, the end of the Iran-Iraq war. They had lost all their proxies. They had lost part of the defense shield. And they, of course, are right now in the process of trying to analyze what's going to be next. They're bewildered. Their top echelon command is cut off, and you can see from the white beard of those people that those people had been in power for many, many years, and so it's very difficult to replace them.
But you wouldn't replace them, but it's figuring out what regime change could look like and whether or not there is, as you say, a grassroots bottom-up process that could unfold and deliver that regime change. Because I struggle to see how the regime in Tehran survives with a significantly diminished capability on the nuclear front. Any kind of agreement that would be signed with Israel and the United States would be very harsh and would deliver a significant blow to the regime. Is it capable of surviving that? Is it capable of surviving, A, in the current environment in which it's being threatened by the United States physically, or B, is it capable of surviving in a world where it has effectively had to sign on to a very, very harsh set of requirements that are going to be issued now by the GCC, by the United States, and by Israel?
It's a lose-lose game for the Iranians, in a way. But I don't have a definite answer for that because, you know, we have seen in the past the tremendous ability of recovery and survival of this regime. We remember 2009, the riots, 1.5 million Iranians poured into the streets. And we remember 2022, the hijab. So I don't have a definite answer right now, but I can say one thing, that the only way in the near future is to make sure that Iran is no longer a nuclear threat, not to Israel, but to the world, is by the change of the regime. It's not going to happen now. It's not going to happen one day, but I strongly believe in the process that we are right now planning that will eventually lead to that.
Oded, let's just talk about an area in which you specialize. We have watched over the last 18 months the Israeli security forces deliver a significant blow to Hezbollah and to other proxies within the region of Iran. What is the capability within Iran to deliver something similar now? And we talked about Fordo, and we're trying to figure out whether or not US capability is required to destroy that site. Can it be done with alternative measures? You say that we need Israel needs the United States, but if it doesn't get the assistance from the United States, how long will it take to reach the same objective, and how will it achieve that objective?
Israel had pretty good capabilities on the ground in Iran. As you can see, Israel had managed to penetrate Iran and cover almost every place in Iran. That I can just imagine that the Mossad agents are working freely everywhere in Tehran. And then, having said that, it's you know that they're also recruiting assets and spies and so on. But it's a very, very difficult task to annihilate or eradicate Fordo independently without the Americans. I don't say it's impossible. We can inflict a huge damage on Fordo in different ways and different tactics. But I think if we want to shorten the process and to reach as soon as possible some sort of an agreement, Americans should step in.
Oded, we're going to leave it there. Thank you very much indeed for your time this morning. Oded Ilam, former head of Mossad counterterrorism, joining us as we wait to see how the US is going to respond. We are 19 minutes away, 18 minutes away now from a Bank of England rate decision. We will return to the central bank story very, very shortly. Sri Koshagovidan of Aberdeen is going to be looking ahead to that decision. We also, of course, need to analyse what has been happening with the Fed, the Swiss National Bank and the Norwegian Central Bank, all delivering decisions of various types over the last 24 hours. We'll come back to all of those stories next. This is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this.
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Thursday the 19th, welcome. You're watching Bloomberg Markets. I'm Guy Johnson. We've got a big focus on central banks today. The SNB, the Swiss National Bank, cutting rates to zero as it looks to stop franc inflows.
There are several factors at work here. One is certainly the stronger Swiss franc, especially against the US dollar. But it's also tourism that is lower, and it's also energy prices that were lower and put inflation to the downside.
Martin Schlegel, boss of the SNB, talking to Bloomberg a little bit earlier on today. Bastian Benrath-Wright joins us now from Zurich. Bastian, is that it? Are they done? We're at zero. Can we go any further?
Well, they can. Hi, Guy. Good to talk to you. Well, they can because they were there between 2015 and 2022. They had the lowest rate in the world, minus 75 basis points, below zero. So they certainly can. However, it's a good question if they want to, because when Martin Schlegel addressed reporters here in Zurich today, he was very hesitant. He was like, yeah, we see how much stress this poses for banks, so we wouldn't go negative lightly. So if you ask me, I think this is a wait-and-see decision. I think if they could have chosen very freely, they would have preferred to keep interest rates in the positive, not go to zero. However, they weren't quite able to because the franc got so strong from Donald Trump's tariff onslaught on the world. We see investors just piling money into the franc as a safe haven. And so if they had opted to keep interest rates unchanged, you would have just seen the franc go through the roof, which would have pushed Swiss inflation even lower than it already is.
Absolutely. Bastian, great stuff. Thanks for the updates. Bastian Benrath-Wright joining us out of Zurich. We've got the Bank of England next. It's coming in a few minutes' time, 12 minutes' time. Adam Bledford joins us now on what we should expect. Adam, the expectation is we get no change, but there might be some nuance here. What nuance are you looking for?
We're looking for nuance in the guidance. As you say, Guy, the bank is widely expected, all 43 economists surveyed by Bloomberg expect BOE to hold in 11 or 12 minutes. But we are looking to see whether the guidance changes. What's the background, as Bastian was saying, in the light of Donald Trump's tariffs, in the light of some rate cuts by other European banks, and of course, in the view of the Fed's decision to hold and the European Central Bank's recent decision to hold as well. Inflation in the UK is stubbornly refusing to come down particularly quickly. It's remaining at a high level, relatively at 3.4% in recent figures, and the economy is facing some other challenges. So they're definitely be looking to see whether the previous guidance of, I think the words were gradual and careful rate cuts, whether there's any change to that, whether there's any change in the expected vote split on the Monetary Policy Committee, which previously was voting 7-2 to cut the last time that was done.
Adam, great stuff. We'll look forward to the updates, plenty of them coming on Bloomberg over the next few minutes as we get that decision and the analysis that goes with it. Remember that we don't have a press conference this time around. We get one in August. We get an update in terms of the projections in August as well. Adam Blenford on what we can expect from the Bank of England. Shri Kochagovidan, Senior Research Economist, joining us from Aberdeen around the table. Good morning.
Good morning.
What are you expecting from the Bank of England?
Bank of England, well, as with everybody, it's unchanged from the Bank of England. What will be very interesting will be the vote split and the guidance, as we've just heard. I think in the past we've had some very interesting vote splits.
Yeah.
I mean, this time we're expecting potentially just two dissenters. The Dingera and Taylor are expected. There's some noise about perhaps Ramsden could join them, but we're not expecting anybody to vote the three-way split that we had before, maybe anybody voting for 50 just yet. I don't think that's really justified in the data as we see it.
They're trying to avoid groupthink, so we're getting more surprises in terms of the vote splits that maybe we're getting. There's a real tension in the UK, though. There is an economy that looks like it's slowing. Certainly the latest data would seem to indicate that. Hayes this morning, huge recruitment company, out indicating that it sees actually permanent hiring coming under significant pressure right now. Its stock has dropped significantly on the back of that. Yes, on the other side, you have an oil price shock potentially coming, inflation that remains incredibly sticky.
Yeah.
So does the Bank of England just how little should it do right now until we see the resolution of those two tensions that exist?
Yes. I think what they'll be focusing on, first of all, domestic inflationary pressures are starting to ease. Services inflation, the wage pressures are starting to move in the correct direction. So that's good news. Yes, we do have an issue with oil prices. They're up 15% or so in the last couple of weeks, and there is potential for it to spike further because of the Middle Eastern tensions. But I think those spikes from geopolitics tend to be quite brief and short-lived, and they can pull back down. What would the Bank of England or any central bank do in that situation? Most likely look through it. So there could be some feed-through in the next couple of months in terms of energy prices, but it's not something that, unless it's more persistent and we have a geopolitical situation where Strait of Hormuz is blocked for a period of time, then that would be quite meaningfully different.
Other central banks are beginning to cut. So this morning we've seen a surprise out of the Deutsche Bank.
Yes.
The SNB has cut. Is the Bank of England in a different position?
I think so, in the sense that inflation pressures are a little bit more sticky have been in the UK, but it's not on its own. The Fed have been on hold, BOJ is on hold, and I think what all three of them have in common is this uncertainty from the trade talks. So yes, we now have for the UK a trade deal in principle, and we have a framework, but there's still so many questions around that need to be ironed out, and these things take months to sort out,
if not years.
Yeah. Exactly.
So what did you make of the Fed? Very little change, very little movement coming through from Jay Powell last night. He says the tariff effect is, though, coming. So when?
Yes. Again, we're not seeing it in the CPI or PPI just yet, but it's interesting when you look at the breakdown. There are pockets where you see prices jumping month on month in furniture, I think it was, and there are little pockets starting to feed through. So you could see some margin squeeze initially, but then we are in a situation where if this is persistent, we are approaching the deadline, the first deadline of July the 9th. We're not seeing any signs of progress in terms of Japan, who is supposed to be one of the front runners, or South Korea or India. All three of them are pushing back on the current sort of framework. They don't want the UK template for themselves. So it does look like, the current pause could just expire on July the 9th, or we could see some further noise just before Independence Day. We could see another set of announcements from the administration. So again, with all this uncertainty, it's very difficult to really read the data at the moment. So we're going to see this filtering through into the data in coming months.
Of all the certainties he seems to have right now, and there are plenty of uncertainties, he feels fairly certain, it seems, that hit is coming.
Yes.
But we don't know who's going to take the hit, I guess, is the question at this point.
Yes.
Is it in the margin story or is it the consumer front?
Yes, I think it's most likely a combination of the two. How the proportions, we don't know this yet. And it could be a case of we won't know this until well into the second half of the year, possibly even Q4, before this becomes really clear how this is filtering through into the data, at least for not just for the US, for other countries as well. What is the impact on growth, activity, as well as the trade and inflation backdrop?
In terms of government spending, it's an issue on both sides of the Atlantic right now. The President of the United States is pushing very hard to reduce rates. You can understand why. His government is currently facing a very high bill, as is the UK government as well. And the pressure on both is absolutely enormous. How big a factor is this going to be in central bank thinking? Are we heading for a world ultimately where, yes, rates will come down because we require financial repression in order for government deficits, in order for government spending to continue at the rate that it is?
I think we're not in a world where central banks have lost their independence. We're not in that world yet. And so I think the central banks have a clear mandate in that they will focus on the economy and on inflation. So, yes, the governments can try and push that boundary, but the bond markets are there for discipline. And I think that any sign of loss of independence would be very quickly priced into yields.
The markets are there, but they're not at the moment. They're not baring their teeth. There's no. We've seen it in the UK. We haven't really seen it in the United States. How close could we be?
I think it will just if it happens, it could be very, very sharp. And we saw that just a few weeks ago in terms of the JGB auctions, where there are countries with supply and demand imbalances in the bond market, where you have very heavy issuance in the long end because of the government spending, and then you have very weak demand again. That's what those bond markets will rise up and bear their teeth in the future as well, and that includes not just the Fed.
Okay, 4 minutes to the Bank of England. I'll put you on the spot. No change. Vote split looks like?
I'm going for 7-2.
Okay.
Yes.
With a couple of doves still there.
A couple of doves still there, yes.
Okay. Sri, great to see you. Thank you very much indeed for stopping by.
Thank
Sri Pejagopeda joining us from Aberdeen. As I say, coming up, the Bank of England is just moments away. We have 4 minutes until that decision, 7-2, according to Sri. We'll see what the vote count looks like. We will break that news for you very, very shortly. As you can see, at the moment, European equities barely budging. There's plenty of things going on around the world, but the Bank of England is up next. We've got some great coverage coming up. That's next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could without question, support an NFL franchise.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Thursday the 19th for our audience worldwide. Welcome to Bloomberg Markets. I'm Guy Johnson in London. US markets are closed today for the Juneteenth holiday, but we have plenty of action elsewhere that we need to focus our attention on. The Bank of England is on deck next. It has a decision. The decision is no change. We have rates being left at 4.25% as expected. Nobody, none of the economists that we surveyed expected any kind of a rate decision to be coming today in terms of a change. So we've got a maintenance of the rate story. We've also got a maintenance of the language, to be honest. Gradual and careful approach to easing is appropriate. Basically, they're signaling that rate cuts are coming, but just not yet. August could be the next obvious date. A little bit of a surprise, I have to say, in terms of the rate split. 6 voted to hold rates, 3 voted for a quarter-point cut. The consensus was broadly that we would have a 7-2 vote split, but maybe this is slightly more dovish, therefore. And you can see that being reflected in the pound right now. The euro is up just a little bit against sterling, as you can see on the screen in front of you, maybe associated with that dovish vote split. The Governor of the Bank of England, Andrew Bailey, says rates remain on a gradual downward path. Yes, you're getting a theme here, and the idea is that it's going to be gradual. Rates are going to be cut, but it is going to be gradual. That's the language that keeps being reinforced. Let's talk to Bloomberg EMEA News Desk Managing Director Adam Bledford for some instant analysis on what we are getting from the Bank of England. Adam, great to catch up once again. We spoke just a few moments ago about what we were expecting. 7-2 seems to have been the consensus. A little bit maybe more dovish in terms of the vote split.
That looks like it, Guy. Absolutely, yeah. As you say, the hold was widely expected. But all the focus, as your last guest was also saying, was on whether the breakdown was going to be 7 members of the Monetary Policy Committee voting to hold and 2 for a quarter-point cut. But in fact, we've got 3 for a quarter-point cut. And it looks like the addition to that one is Dave Ramsden, who's sort of on the more dovish side of the bank anyway, but definitely was not one of those that was potentially projected in the 7-2 split. So, you know, there's obviously a lot of headlines crossing the terminal as we speak. We're seeing Governor Bailey, that they're obviously monitoring how far the economic slowdown feeds into inflation. We've had some weak numbers on GDP recently, and the bank's being vigilant, as you probably would expect, on Middle East developments and what the impact of anything that has happened or is still to happen might have on energy prices as well, because all of that feeds into CPI and all of that feeds into their coming decisions.
Adam, the way the market's interpreting this is that August is a done deal. The market's now pricing in an 80% probability that we see a rate cut from the Bank of England in August. But given the fact that we do have that geopolitical risk, given the fact that we do have the potential for energy prices to go sharply higher, is the bank running a risk of locking itself into that decision? How locked in is it right now? 80% sounds like a very high number, and it'd be hard to fight the market with those kinds of figures.
Well, I mean, we've already seen this morning. I mean, the Norges Bank is not the Bank of England. They're different beasts, of course. But we've seen one surprise there. These things can happen. The markets. Andrew Bailey's come out potentially. I certainly recall in times before when Andrew Bailey's come out and said the markets will do what the markets will guide us in certain ways, but the bank still has the agency, of course, to make those decisions. So there's a lot still to come, as you say, perhaps sort of standing pat, as it were, and thinking about being careful and watching all the data over the next few months is exactly what the bank says it's going to be doing. We will see. It seems like we may well know in the next few days or so what the mood music is from Washington, whether the US gets involved in that ongoing conflict in the Middle East. And indeed what happens with tariffs before the BOE meets next. So there's so many uncertainties, and as we've all seen in the past, market bets and traders' expectations can change pretty swiftly.
What does this mean in terms of the other factors we're watching in the UK? What do we need to worry about here? We've got a growth slowdown, but we've got a sticky inflation. Increasingly, it feels like the bank is focusing on that growth slowdown, which feels maybe a little different to what the Fed is delivering right now. It's concerned maybe about the upside to inflation. Is the bank taking a different path here? Is the growth risk now the bigger risk?
Growth is the main conversation in the UK. If you listen to obviously the bank is independent and charts its own course, but if you listen to the narrative out of the Labour government, all they want to talk about is growth. They have to talk about it when it's anemic, and they very much want to talk about it if and when it becomes stronger. They're pushing for investment, and they're pushing for an increase in the underlying factors that might fuel growth, and that's what we're all looking out for. So that's the sort of the dominant narrative that swirls around the Bank of England in the UK, and the mood music and the wider narrative in the US slightly different. They've had obviously a much stronger performing economy over recent years, now being sort of beset with all of those questions around what might happen when the full tariff suite comes into play, if it does, in the US. But yeah, definitely growth central to the mindset of policymakers in the UK.
Adam, thanks for the instant analysis. We greatly appreciate it. Bloomberg's Adam Blenford on the Bank of England rate decision. As I say, 6-3 split. A little bit of a surprise, maybe slightly more dovish, as a result of which the market's now pricing in an 80% probability that we see a cut in August. And we have seen a weakening of sterling. Front-end yields on the gilt curve have also moved. Let's talk about some of the other assets that are moving in Europe this morning. The Swiss National Bank, the SNB, this morning in Zurich, cutting rates down to 0. They're in Zurich this time around. And there are hints that maybe they could go further, but that's not the desired path. So what we've seen maybe is actually a little bit of a pickup in the Swiss franc. So as you can see, the euro is weakened versus the Swiss franc. The expectation is it gets harder from here to cut, and you wonder what the SNB is going to do if it continues to see inflows into the Swiss franc. Let's talk about the Norwegians. The Norwegians actually this morning have delivered the surprise of the day. We have seen the Norges Bank out with a 25 basis point cut. We didn't see that one coming. Most of the economists we surveyed certainly expected the central bank in Norway, in Oslo, to sit tight. That hasn't happened. So that's where the surprise has come out of Europe this morning. Other central banks feel pretty much in line with expectations. Little surprise here, little surprise there, but nothing too far from the sort of center of distribution of outcomes we were expecting. So let's get back to the Bank of England, talk more about this, and then put it in context, the wider context of that central bank story. So we have seen a cut from the Bank of, a no change from the Bank of England, but a dovish no change being delivered. Obviously, this comes hot on the heels of yesterday's much anticipated FOMC decision, where actually we didn't anticipate very much. The Fed left rates on hold. Jerome Powell, though, saying some interesting things about what comes next in terms of, while we are in wait-and-see mode, we are anticipating a tariff hit. Take a listen.
Despite elevated uncertainty, the economy is in a solid position. We expect a meaningful amount of inflation to arrive in coming months. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are. The current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments.
Jay Powell speaking last night, and some of the key highlights from the press conference. Pooja Kumar, senior European and UK rate strategist at TD Securities, joining me around the table. It's interesting. The Bank of England now looks like it's nailed down for an August cut. 25 bips looks like it's coming. The market's pricing an 80% probability, but we don't know when the Fed is going to deliver anything. Is the Fed the surprise? Is the Fed where the wild card comes from next? And I'm wondering how you would compare and contrast the situation the Fed finds itself with the Bank of England.
Yeah, I think Fed is the tricky one right now. I think for Fed, it's the risk of inflation that is holding them back when they have basically a steady labor market report. For basically, we have already talked about for ECB, BOE, there's less of an inflation bump, right? We are not retaliating that much, and therefore inflation is under control. So where these central banks will be leaning more towards is growth. And I think we have seen the entire stream of data from UK this week, last week. It's softening. And I think that has given BOE members a bit more confidence. And definitely August seems like a done deal. They'll have one more inflation report and one more wage data report. And we would see that gradual decline. But also, I'm more cautious when it comes to BOE because they are still sticking to the wording, right? Gradual and careful. And unless they remove that, I'm not bent on thinking that BOE is at the stage that they will be cutting consecutively like what ECB did.
We've got a lot of things that we need to worry about right now.
Lots of them.
The list goes on and on. The most obvious one right now, though, is an oil price spike.
Yeah.
Which central banks, in theory, should look through, but it depends on the duration of the shock. Is the Bank of England putting itself into a corner in terms of signalling to the market? 6-3. The governor once told me that we should take the vote split seriously, and it is a communication tool. Is the communication tool that a rate cut is coming in August? And why are they locking themselves in effectively to that? Are they locking themselves into that?
I think when it comes to BOE, I would say they don't lock themselves into anything, just given the fact that we have seen lots of swings when it comes to the voting, and this is something that we were discussing before as well. I think what we need to see when it comes to BOE is that rates are still restrictive, right? For ECB, they are at neutral, and so they want to give a little more time to understand what is this layer of new uncertainty. Yeah. But when it comes to BOE, even if they reduce a bit of rates, they are still in the restrictive territory. I think that's the key.
Where's neutral?
Neutral is around 3%. That was their new forecast.
Right. So 425 now. We've got 125 bips of cuts to get us back to neutral.
So a gradual easing is something still I don't think that is inflationary. But to your point, it all depends on the time frame that this uncertainty remains when it comes to either oil prices or tariffs, on how the global economy works through it. But it's just that our situation is still tight. But we know that for BOE, the domestic drivers are still key, right? If you look at their forecast, they are still looking for services to remain around the 4.7, 4.8 level until end of the year. And I think if they still see that path easing, they'll be a little more comfortable on this gradual path of reduction, even if, say the oil prices stay at 75. But I think if you see that wage inflation again going to 5%, I think that's where they will be like, we need to be a little more thoughtful in this process of reducing restrictive policy.
Norges Bank's S&B. The Norges Bank was a little bit of a surprise this morning.
Yeah. I think...
Why?
I think for them also the currency has been a key player, right? Like the currency strength. And I think that's
it's a petrocurrency, effectively.
Yeah. I mean, we did get a string of dovish central banks after pretty hawkish. I thought the Fed was a bit on the hawkish side, but... Yep. I think this was markets wanted, but what they are doing right now is they think the policy is on the right stance. They want to give a dovish sense, just given the fact that nothing is working in their favor right now, whether it's the tariffs, Middle East, everything seems to be impacting the economy, but no one knows to the extent it would be. Central banks who have the place to cut rates can cut rates, but they don't want to make the economy below neutral, just given the fact that it can be more inflationary. I think that's where BOE is different, just because rates are restrictive right now.
There is a kind of emerging split maybe in the Bank of England. There's an emerging split coming with the Fed, though, as well. There appears to be two camps increasingly. You've got one camp that's worried about inflation, you've got one camp that's worried about the labour market. And I wonder what happens when the labour market weakens, but inflation potentially gets more sticky, which is what Powell's hinting at. How much tension could you see on the FOMC about which way that central bank needs to go?
I think if they see that kind of move, they will be bending more towards the labor market because they're still seeing inflation as a one-off jump. But if you see as 2026 forecast for inflation, it does come back to 2.4, 2.5, right? Even though they see inflation bumping above 3% in 2025, it goes back to 2.5 in 2026. So they are taking this tariff as a one-off impact. But if they see labor market deteriorating, that's not a one-off impact. Labor market hit is something that once it starts, it does not end.
And tends to accelerate.
Yes, exactly.
Pooja, great to see you. Thank you very much indeed for coming to see me. Pooja Kumra of TD Bank, joining us on the latest out of the Bank of England, the SNB, the Norge Bank, and of course the Fed. All of this in the context, obviously, of what is happening in the Middle East. We'll talk about that next. The Israel-Iran war entering its 7th day. President Trump weighing US involvement. What is the next move? We'll talk about it next. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch the new Bloomberg Tech Europe. Premieres Friday, only on Bloomberg Television.
There's no way that you can allow, whether you have to fight or not, you can allow Iran to have a nuclear weapon because the entire world will blow up. I have ideas as to what to do, but I haven't made a final. I like to make the final decision 1 second before it's due, you know, because things change. I mean, especially with war.
President Trump keeping his cards close to his chest, which is interesting in itself, not offering any real clues as to whether or not the US plans to strike nuclear targets in Iran. Sources telling us here at Bloomberg, though, that senior US officials are indeed preparing for a potential strike in the coming days as Israel and Iran continue to exchange fire. Let's talk about what comes next. Jumana Basechi joins us now from Dubai. We're on tenterhooks. The region, I'm sure, is on tenterhooks, Jumana, as we await to see what the US does next. I was speaking to a former senior Mossad official a little bit earlier on who seemed to indicate that in order to do the necessary damage to the Iranian program, US involvement is necessary now at this point.
Yeah, the official line out of Israel is that it would be helpful to have the U.S. participate in these military strikes, but at the same time, they feel that they are in a dominant military position when it comes to total control of the airs, of the skies, which is something that even President Trump posted about the other day, but also in terms of just how much military capabilities they've taken out. According to the Israeli military, they've already eliminated about 1/3 of Iran's missile launchers. They are continuing to strike at key nuclear facilities, ongoing. Even in the last 24 hours, they hit a couple of centrifuges. And so those strikes continue. As for Fordo, which is obviously the more difficult nuclear facility to get to, there is an understanding that in order to penetrate some of those deeper systems, that you would have to use U.S. munitions, those MOBs, that can only be transported by those B-2 bombers. So yes, there's a necessity from a munitions standpoint, but at the same time, Israel feel like they are in a militarily dominant position, which is also perhaps one of the reasons why U.S. may want to capitalize on this, because they may sense that this could be a unique opportunity to level a fatal blow on the Iranian regime. So all of these are considerations that President Trump has to think about when they make their minds up. Because, Guy, we are getting to crunch time now, and it certainly appears, according to our sources, that they will make a decision on whether to get involved or not in the next 24 or 48 hours.
Jemana, the fear is that the implication of a U.S. attack would be Iran attacking U.S. facilities in the region. But as Israel continues to degrade Iran's ability to use its weapons arsenal, its missile arsenal, is that fear receding? That maybe Iran doesn't have the capability to strike in the way that it would have done only a few days back?
Yeah. Look, the numbers, the figures that the Israeli military have pointed to, they have said that since the beginning of this war, so roughly 7 days ago, Iran has sent over north of 400 ballistic missiles towards central and northern Israel. They have eliminated, as I said, about 1/3 of their missile launchers, but it is estimated that they are sitting on thousands of these ballistic missiles. So not all of them have been eliminated. They certainly still do have the firepower and the stockpile to respond should they want to. And up until this morning, the last couple of days, actually the intensity of the strikes from Iran into Israel had started to slow down. But then this morning, a couple of rockets actually did manage to penetrate Israel's air system, and there has been a big strike on one of the Israeli hospitals, the number of wounded counting to over 50. And so this morning we heard from the Israeli defense minister saying that they're going to strike back hard at the Iranian regime. So the Iranian regime, while weakened, is not out, Guy.
Jemana, we will watch with interest. Thank you very much indeed for the update. Jemana Basetchi joining us out of Dubai. The focus is firmly on kind of what happens next and on Israel's next actions in Iran and what happens if we do see the US getting involved. A few moments ago, I spoke to former Mossad head of counterterrorism, Oded Aylam, to get a take on what he sees happening next. Take a listen to a bit of that conversation. Oded, good morning. Thank you very much indeed for your time today. We're trying to understand whether or not Israel needs US assistance in order to complete the task of destroying Iran's nuclear program. Is it required?
Absolutely, yes. Having said that, doesn't mean that Israel cannot inflict severe destruction on the complex of Fordo, where we are talking right now. But definitely, we would need the U.S. aid in order to initiate such a blow that will be very hard to Iranians to reconstruct or rebuild. We are talking about a compound that is dug inside a mountain, about 120 meters inside. There is even one bomb that can really penetrate most of that, which is the BGU 57 that can be carried by the B-2 plane. And so if we want to shorten as much as possible this campaign and to bring the Iranians to the negotiation table under completely different terms, the U.S. should step forward and come across and assist us.
What would be the implications of that?
Well, you know, if you asked me this question about 2 weeks ago, or even less than that, I would say that the Iranian had the capability of striking major American places or installations across the Middle East, or even striking their neighbors and so on. But we had diminished quite a lot of their capabilities, and they're right now pretty much preoccupied in defending themselves. The Israeli Air Force, in fact, flies above Tehran completely free. I was amazed just to see the photos of Iranians shooting with machine guns towards the sky. It was more or less of Germany in 1945 and not Iran 2025. So right now, the implication would not be severe, and I think we should all take the chance.
So a regional war is not on the list of your kind of outcomes from such a strike, because that would be the fear, that they would hit targets in Qatar, in the UAE, elsewhere around the region. The US has plenty of bases, particularly in Iraq as well. You don't see those strikes coming?
I see those strikes coming, definitely yes, but I see they are very much limited, and they don't have the capability to sustain it for a long period. Don't forget, we have already reached about between 40 to 50% of their ballistic missiles, and together, if there is a coalition, and I'm talking about coalition which include, of course, the US first, but not only the US, we can definitely limit the damage that they can inflict on the Americans and coalition targets, and bring them back as soon as possible to the negotiation table under different terms.
Oded Ilam, former Mossad head of counterterrorism, speaking to me a few minutes ago. Let's check and see how asset markets are dealing with all this uncertainty right now. Of course, the United States is closed for Juneteenth. European equities are softening up a little bit right now. We're now down by, let's call it circa 0.5%. We've softened a little bit this morning. Brent crude is beginning to gain a little bit of traction on the upside. We're now up by circa 1% there, so we're watching that quite carefully. Elsewhere, sterling actually turning around a little bit, but actually not doing much on the back of the Bank of England, and the Norwegian kroner a little weaker today. 25 basis points being cut. Up next, we'll talk about what we can see in the United States next, particularly with the labor market. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Thursday the 19th, welcome back. You're watching Bloomberg Markets. I'm Guy Johnson in London. The reason I'm here, of course, is that it is Juneteenth in the United States. The markets are closed. But we had a lot to think about as we went in to this holiday. And the Powell press conference last night, I thought was quite interesting. And very much wait and see. That's the message coming from the Fed chair. Rates left unchanged. But while there was a signal that the economy remains in the United States largely in good condition, there's plenty of uncertainty bubbling up. You've got the tariff impacts, but of course you've now got to factor in as well what is happening in the Middle East.
Despite elevated uncertainty, the economy is in a solid position. We expect a meaningful amount of inflation to arrive in coming months. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are. The current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments.
Timely manner, I think is the key phrase there. We don't know when the next kind of catalyst is going to crystallize for the Fed, because there are so many right now. Clearly, Powell sees inflation coming down the pike towards him. He's worried about what is happening on the tariff front. You then throw in higher energy costs as a result of what is happening in the Middle East. But he's kind of balancing that at the moment with a labour market that largely at the moment is holding up. Now, it's a slightly different picture over at the Bank of England, which is interesting. Dave Ramsden adding his voice to the calls for a cut at the Bank of England. So we had a 6-3 vote split today. And Dave Ramsden is basically signalling his concern about what is happening with the growth picture and also with the labour market. Now, there's another piece of evidence I just want to throw out there today, which I think is interesting. Take a look at what is happening with the share price of Hays. Now, Hays, if you don't know it, is a big recruiter, big recruitment company. It does temporary staffing and it does permanent staffing. And what it signaled today is that it is seeing a tough time at the moment. This was an unscheduled update from Hays. It is seeing a very tough time in terms of the permanent hiring conditions that are beginning to develop in the UK. And the stock's taken another big leg lower as a result of that. So you're getting slightly different conditions emerging on both sides of the Atlantic. But the Bank of England and the Fed are having to think about what is happening with the inflation picture and how that's going to develop. But the recruitment story on either side of the Atlantic does look quite different. So I think that's an interesting point to bring up with our next guest. Nina Richardson joining us now, the chief economist over at ADP. Clearly, they have quite a lot of visibility on the payroll front, on the labour market front over in the United States. Nina, great to see you. Talk to me about how strong the labour market is in the United States right now. Powell, at the moment, seems to believe that he can sit back and wait to see how things are going to develop. Is that the correct response? Is it as solid as he suggests it is?
Yeah. Hi, Guy. The labor market in the U.S. is solid. If you look at all the big picture items, indicators that we look at, the unemployment rate, the initial jobless claims that are a proxy for layoffs, what you're seeing is a very clear picture that any central banker would be happy to see, a labor market that continues to produce jobs on the surface. It's when you unpack it a little bit that there are some concerns. Labor force participation rate is low. The jobs, though steady, the job gains are coming from just a couple of sectors, namely healthcare and leisure and hospitality. They're not widespread. And wages are solid. That's a great thing for workers, but they are at elevated levels. And so you have to have an eye to where wages are and where labor shortages might come if you're the Federal Reserve. So right now, the Fed has the labor conditions it needs to stay pat on rates, but I think they are sensitive that things could change.
And how quickly could they change? At the moment, there's this kind of there's this calm between the two factions which seem to be growing within the Fed on the FOMC, those that are worried about the inflation picture and those that are worried that ultimately we are going to see a growth slowdown and the labour market could be a victim of that. How much tension do you see coming between those two groups? Are we heading for a kind of showdown? Which of those two factors could ultimately be more important?
In the way that the FOMC makes its decisions, I wouldn't count tension as a negative. When things are clearly deteriorating or clearly improving rapidly, it's easy for them to have a consensus view. It's in this middle ground where things could go either way, where the uncertainty leads to several different scenarios, where the FOMC members are talking to different parts of their constituencies and coming up with different views. That's when you see divergence in the opinions, and that divergence is healthy in terms of getting the right outcome. So I expect to see more divergence as long as the economy stays solid, and yet there's still some uncertainty about the future. We're going to have different interpretations coming out of the Fed of what it all means. But what it means at the bottom, when you look at those projections, the median typical projection, you're seeing an inflation picture that's slightly higher, a growth picture that's slightly weaker, but still an expectation in that consensus of 2 rate cuts this year.
Yes. I think Powell was definitely trying to downplay what the dots were telling us.
Right.
How wide do you think the divergence? He was at pains last night to basically say, this is a very low conviction set of dots. How low conviction do you think it is?
Well, I think the divergence means it's low conviction. The median is quite convicted, but probably there are more extremes on either end because the uncertainty is higher. And, the clock is running out on 2 rate hikes. That was a really confident conclusion in February. We are now in June. As we progress through the year, it's going to get harder if the conditions stay the same. But I think what the Fed is waiting for is for the full effect of all the policy and in particularly the tariff policy changes to roll through the economy and stabilize. And I'm going to add something else that it's not talked about as much. We tend over here in the U.S. to look at tariff impact from the U.S. perspective on businesses and workers, but tariffs will have an effect globally, and those global economic conditions will feed back to the U.S. So big picture, there's still some uncertainty on the horizon. I think the Fed is just trying to wait as long as it can to put its foot on the gas or take it off immediately, depending on those conditions globally.
Neela, how do you think the Fed's going to think about an oil price shock?
I think they're going to weigh it the way they would weigh any shock, which is to assess whether this is a temporary shock that flows through the economy quickly and they don't have to respond to, or a permanent shock that has knock-on effects into other industries or production process that lead to higher inflation. So they're going to have to hold these two timing views very closely together. They're going to have to add it to already higher tariffs and a global slowdown if that is what a higher oil price leads to. So it complicates their decision-making process. It definitely doesn't ease it.
Just can I throw in a few other things? I'm starting to see headlines on a more regular basis, not quite daily, but certainly approaching that. Large firms in the United States, and Microsoft is the latest one I'm hearing from, are beginning to start to talk about more aggressive layoffs. You've been through cycles before. You can see kind of patterns that form. What's your reaction when you start to see those kinds of headlines? If big companies are beginning to lay off jobs, is that a cyclical change? Is that a structural change? How are you looking at this?
I look at it as structural, actually, Guy. I know there is an easy interpretation that this is cyclical, but I think the labor market is changing dramatically. First of all, you see the aging of the boomers out of the labor market. That's a key change that large companies have to figure out. Also, how they've adjusted through shocks and cycles have changed. Large companies had coming out of the Great Recession, the ability to grow and shrink their labor forces at will, depending on their particular economics. That ability has left since the pandemic. They found out that if they shrink their workforce, they may not get those workers back. And so they have been very conscious and intentional about their headcount. At the same time, we're not seeing the kind of dynamism in the U.S. labor market that we have enjoyed historically, which means workers after the Great Resignation in the U.S. are staying put. We're not seeing the kind of turnover that we used to, with workers seeking more fertile ground. People in the U.S. are less likely to move to jobs. So you take all these factors, and including that the U.S. worker has become more productive over the last 3 years, except for this last quarter, another complication. And you can see why firms are taking a slightly different stance on their headcount than maybe they would have 10 years ago.
Okay, so pull that all together. Does that mean they're going to be laying off more people? I'm trying to understand what you just said. It sounds like they in the past have held on to more staff, and that maybe is the muscle memory, but you sense that that's beginning to change because of the changing structural forces, but also maybe some of the cyclical forces as well.
Right. I think what you're going to see is that maybe they don't fill openings. There's a lot of ways to restructure headcount, especially when you know that a larger percentage of your headcount is of retirement age, and that is exactly what we're seeing in the United States and what we're seeing in the UK. And so that headcount tends to be more expensive. It's also closer to leaving your firm altogether. So I think demographics is part of this challenge that large companies are trying to figure out. It's also the efficiency gains from innovation, and that's been not just the last couple of years, that's been decade long, and it's where the workers are. Labor force participation is lower in the United States than it has been historically. So they're pulling all these pieces together and trying to make an efficiency-backed solution to some challenges in the labor market as demographics change and as innovation actually changes the nature of work. And you're seeing that right now in slowing down on those hiring, possibly some restructuring as well.
Yeah, participation is what, 62% used to be. I think it was 2000. It was 67, which is the recent high.
And that's a large degree because of the demographics. So, ironically, you look at these slowdowns in hirings and maybe some reduction in force, and you think, oh, it's because companies are trying to reduce their headcount size on its own. That's not the only factor. There's another factor here in that they may not find the workers they need. So they're trying to do more with less, knowing that the employment growth that the U.S. has enjoyed has slowed significantly, and the dynamism around labor market churn has slowed. So it's not just coming from the firms themselves in terms of labor demand. It's also a factor of labor supply and the kinds of workers they have access to now versus 10 years ago.
Great to catch up, particularly on a holiday. Thank you very much indeed, Neela. Neela Richardson joining us from ADP. Coming up, we're going to take you in a very different direction. SpaceX, another Starship rocket exploding on a test stand in Texas, setting back Elon Musk's ambitions to reach Mars. We'll talk about where that program is next. This is Bloomberg.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Of June, 45 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson in London. The US markets is out today, but there's plenty of action elsewhere. Let's recap what we've learned this morning. The Swiss National Bank has cut rates, 25 basis points. The Norges Bank has cut rates, 25 basis points. The Bank of England, it's left rates on hold, but given us a slightly dovish outlook in terms of the vote split, which was 6-3 on the MPC, the Monetary Policy Committee. The market was expecting 7-2. Sam Unstead joins us now. Is that a surprise? How big a surprise is it?
It was a surprise, actually, and not just that it was narrower than expected, so 6-3, 7-2 was what was expected, but also that it was Dave Ramsden, the policymaker, who went over. Before, although there was 7-2 kind of agreed upon, the person who is being talked about was Sarah Breeden, so it was a different person moving over to the side voting for cuts than had been expected. So that is probably why that kind of slightly more powerful, if you like, dovish signal is coming through from the vote split in particular.
So does that mean that we are locked in for August? 25 basis points in August?
I think we're pretty close to it because, so not just in the vote split, but I think going into this, the question is the inflationary concern going to outweigh the labour market, the economic concern, and those two things balancing off against each other for the Bank of England. Reading through the statement, it appears that it's the looseness in the labour market that's coming through. They're a bit more sanguine about wage growth coming through. That appears to be outweighing concerns on inflation, which they still are putting down as almost entirely the same as
I'm still hearing the language of gradual.
Yeah, very good. Gradual and careful. So that's all. None of that's really changed. So, I mean, you could say that really there's a lot of noise around this one, and there's a lot of noise in the data as well. It's made it very difficult for the Bank of England to really decipher, particularly on the labour market, but even on the inflation front as well, how well the economy is doing. But it appears that those concerns are outweighing the inflationary
So in terms of the cadence we should look for next, is it once a quarter? Are we still kind of on track for that kind of a move? I'm being told, is around kind of circa 3%. We're 125 bips off that. Just a series of 25 basis point cuts coming.
Yeah, so certainly I think through to the end of the year. And actually, if you go back to the beginning of the year, that is broadly what the Bank of England was saying was going to happen. That we were going to go effectively at a quarterly pace. That has been what's occurred. And a little bit more on bets for August. That was already, it's not quite priced in, but it's about 80% likelihood. So pretty much there. And there's no real change in that from this statement today. It's certainly dovish enough on the labour market side to keep that unchanged.
A little bit of weakening in the pound, but actually it didn't last long. Sam, great stuff. Thank you very much indeed, Sam Unstead, joining us on the latest from the Bank of England. They're taking in a totally different direction now. SpaceX, a SpaceX Starship. Going to start that again. A SpaceX Starship, which you would think would be fairly easy to say, has exploded. The rocket was on a test stand in Texas. It was doing a routine static fire test, quote, of the engines that are used. But it's another major setback for Elon Musk's space ambitions that includes, obviously, return trips to Mars. Kate Duffy's going to be smiling because I was trying to get her to say anomalous on air, but I've now completely messed up that introduction. So she's definitely 1-0 at this point. What do we know? What happened?
Well, it's unclear exactly what caused this massive explosion. If you look at the footage, it's just a big flash of light and then all this ball of flames, essentially, lots of smoke coming out from the launch site. SpaceX have just called it a major anomaly. Elon Musk has tweeted today, posted something on his X saying, just a scratch. I mean, that could have been related to anything, but potentially down to this Starship launch. But as you say, it was during a static fire test. So this is when the engineers are sort of testing out the engines before they do the sort of major launch before it reaches orbit. And it was considerably big. I mean, the sort of local windows were shaking, the properties were disturbed. So there needs to be an investigation into this. You know, there usually is when something like this happens. But, you know, the SpaceX team will conduct investigations to see exactly what happened.
SpaceX had developed a reputation for being able to deliver. It was becoming routine that they would deliver payloads into space. Obviously not with this particular program. They're struggling with this one. Is it getting harder to deliver on the ambitions that Elon Musk has set?
I mean, this is definitely a setback. The past couple of launches have resulted in explosions, and this will be the next launch will be the 10th launch of Starship. So we're not quite sure when that's going to happen. The past launches, they've exploded because of various reasons. You know, sort of propellant leaks or hardware issues with the engines. So this will be a setback. We're not quite sure what's going to happen now. Musk's goal is to get to Mars in 2026. It's obviously coming around the corner in terms of sort of rocket world. That is literally next week. So it's yet to be seen whether they can actually achieve this goal or not. But we will see.
In terms of kind of how is there a cost? How does this business? Can you continue down this road? This company must be quite literally burning cash at this point in time in terms of its ability to get this to happen. What are the financial implications? What does a business like SpaceX, which has got other things that it's got to do as well, can it continue? I guess I'm really kind of reaching for, do we get to a crunch point where actually it's kind of, there is a problem here and we are struggling, and what has looked like a really solid business and a business that can deliver, as I say, payloads? Do we get to a point fairly soon, as you say, where actually the challenges start to become really quite substantial? If we can't make this work, and we're seeing rocket after rocket being destroyed, it must take a long time to rebuild this stuff, and a huge amount of cost to rebuild this stuff and get these rockets, the motors built into a larger program. What happens next? Is there a crunch point, can't we?
I think what we have to remember is, you know, when SpaceX set up, it took them so many years to launch the Falcon 9, which is their most reliable rocket right now. That's the one that delivers all the satellites into orbit. It took them years to get that right, and there were so many failures with that. I mean, if you look at Starship, we're very much in the early days of Starship. There is a lot more to come. So actually, these explosions that are happening, for them, that is just SpaceX's approach. This is what they need to do in order to get to the next level. This is what they need to do in order to sort of rule out, you know, the anomalies that are happening, you know, whether it's
this is something that happened in previous programs. This is normal business. It's
hard to compare because no other company has sort of done this like SpaceX. They are the guinea pigs in this respect in space world. This is how they do it. They have the money to do that. They get some of their money also from the government through funding, but they've also got their own private money too. So they are able to do this, and they will get to a point where they will succeed, hopefully. But that will come at a cost, and it could be further down the line because of these setbacks.
As Kennedy says, it's not easy.
No.
And it certainly is being demonstrated as being not easy. Kate, thank you very much indeed. Kate Duffy, covering SpaceX for us, fresh back from the Paris Air Show, where I have to say space is becoming an increasing part of the narrative as well. Let's shift gears and talk a little bit about what is happening in the Middle East right now. We are watching very carefully, obviously, the oil price. The oil companies are monitoring the situation in the Gulf very, very carefully. The CEO of Shell was speaking a little earlier to Bloomberg, talking to Bloomberg Sherry Ann at the Japan Energy Summit and exhibition. Now, he shared how he is seeing the conflict in the Middle East and how it's impacting his business operations right now. Take a listen.
The escalation in tensions over the last few days, in essence, has added to what has already been significant uncertainty in the region. Our focus has been very much on making sure our people are safe, that our assets are protected both physically and from a cyber perspective as this escalates further. And of course, we're observing the markets. I mean, you've seen a bump up in both oil and gas prices, but it's still moderated, I would say, because people are waiting to actually anticipate whether physical infrastructure damage might happen. That's been a bit more contained. We're being very careful with, for example, our shipping in the region, just to make sure that we do not take any undue risks.
Will you need to change that strategy if we get any U.S. military action, which could happen in the next 24 hours?
We are monitoring that very, very carefully, and of course, we are in close discussions with the government. At this stage, we continue to be confident in the posture we have taken, but of course, we have plans in the eventuality that things deteriorate.
How important is the Strait of Hormuz right now? And even if we don't necessarily see a closure, just disruptions in that region?
I mean, massively important. 20% of the world's oil is flowing there and a roughly equivalent amount of the world's gas. What is particularly challenging right now is some of the jamming that's happening on GPS devices and the like, which is a concern. The Strait of Hormuz is, at the end of the day, the artery through which the world's energy is flowing. And if that artery is clogged for whatever reason, it'll have a huge impact on global trade. And so Shell, of course, has a very broad portfolio of assets. We have to already anticipate if, for whatever reason, those arteries get clogged, we have to think about other means to be able to supply our customers from other locations.
Are you trying to look for alternative supplies at this point?
Yeah, we have multiple production points, both oil and gas, that we would need to be able to mobilize to fulfill our customers' needs. But there is no question that a 20% impact for the supply of both oil and gas will have massive implications for the world's energy system.
Asia is a continent of contrast. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Minso, give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "Call me blue, hwai 불치." It means simple, but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have an income through the robot.
From space tech in India to robotics in Japan, Asia is driving the future, reshaping industries, societies, and the way we live. Join me as I take you through the bold innovations. Discover Asia's next-gen technologies on Momentum.
Addiction isn't a choice.
I would isolate, self-medicate, and fabricate to continue my use.
I didn't really think I had a problem.
Rachel and Pete are just 2 of 48.5 million Americans with substance use disorder. But 3 out of 4 people find recovery is possible with help. Go to shatterproof.org/findtreatment to watch the short film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
You missed it on Bloomberg Open Interest. This data from Trump's trade war. What are you seeing in your district?
Businesses are afraid to accelerate. By and large, they're pulling over and putting on the hazards.
You're constantly speaking to businesses. Is anyone making big investments?
Inflation is a big bugaboo. There's no evidence yet that inflation-driven drop in sentiment drops spending. That's why I say there's the disconnect on the consumer side.
Don't miss Open Interest live weekdays.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Thursday, the 19th of June, for our audience worldwide, welcome to Bloomberg Markets. I'm Guy Johnson in London. The reason I'm here is that US markets are closed for the Juneteenth holiday. We will resume tomorrow. But there's a series of top stories that actually outside of the United States are certainly moving today. Israel and Iran entering a seventh day of conflict, with sources telling Bloomberg that US officials are preparing for a possible strike on Iran in the coming days. The Federal Reserve last night from our perspective, holding rates steady for a fourth consecutive meeting. Jerome Powell signaling that tariff impacts are, though, coming. And global central banks, we've seen a series of decisions this morning, some of which have surprised. The Norge Bank, certainly shocking, with a 25 basis point cut. The Swiss National Bank dropping to zero as it looks to stop inflows into the franc. The Bank of England has delivered a little surprise this morning in the form of the vote split, but no rate cuts coming from the bank. Let's talk about the impact of all of this on markets and figure out what is happening. You did see a little weakening in the pound, but that's kind of shifted around a little bit as we try and analyse the news that we've had out from the Bank of England. As I say, a 6-3 vote split, catching a few by surprise. Dave Ramsden, I think, probably is the one that has shocked this morning, adding his voice to those that have called for a rate cut. So let's get a sense of what is happening here. Markets Today economist Moana Conningham joining us to give us some assessment. So a little bit of a surprise. Not a big surprise. Let's kind of put this in context here. Dave Ramsden, though, voting for a rate cut. Not many people saw him voting for a rate cut.
No, I think the vote split itself was always going to be one of the more uncertain elements of this decision. You know, the actual rate cut or not a rate cut, itself was not really up for question. But I think how they voted was. Some people have been looking for some more hawkish signals, but actually there was also a chance that they voted in a more dovish way, which they did. But I don't think that Dave Ramsden was the person that we were necessarily expecting.
Sarah Breeden was the one that we were looking for. So what do we know about why he's made that decision? Presumably he is more worried about what's happening in the labour market and the growth picture.
Right, exactly. And it's really those domestic factors outweighing concerns about the international inflationary sort of trajectory. Those threats from, oil prices pushing up inflation and just a lot of macroeconomic uncertainty. But the BOE is very focused on the domestic growth picture. And they're looking at the labour market. There was quite a lot of discussion about that. The signals are showing a weakening, and that seems to be the real element of concern. And they see the inflationary pressures, which are still noted as being temporary, not being the sort of aspects that will be passed through long term, and they seem at the moment, confident to keep things on hold, and certainly there's a slight dovish tilt in the voting pattern.
It's interesting, the pound has actually kind of come up a little bit, which is fascinating. It didn't actually stay down for very long. There is now an expectation that 25 bips, a cut of 25 basis points is coming in August. How done a deal is that? The market's pricing, what, circa 80% of a probability?
Well, it was already close to 80% before this decision. We have seen bets increase a little, but I think you'd probably expect that when the sort of vote split came in just a little more dovish than expected. It's not been a radical change, and there's a slightly more certainty about there being two quarter point cuts by the end of the year. But again, that was still already largely priced in. So there's not been a huge shift there. I think right now it will be a surprise if we didn't have a rate cut in August, but that's quite a long way away. And of course, with the global environment being quite uncertain at the moment, I think it's really difficult to say with certainty where I think we'll be then.
Quite uncertain sounds like British understatement for me. Wayne, thank you very much indeed. Wayne Cunningham joining us on the Bank of England story. Let's talk about another central bank this morning that is out with news as well. The SNB, the Swiss National Bank, cutting rates to zero as it looks to stop inflows into the Swiss franc.
There are several factors at work here. So one is certainly the stronger Swiss franc, especially against the US dollar, but it's also tourism that is lower, and it's also energy prices that were lower and put inflation to the downside.
Segel talking, the boss of the Swiss Central Bank. Talk about the decisions that has been taken and why those decisions have been made. It's interesting to hear him talk about tourism and how the Swiss franc is impacting that. I can see why. Bastian Benrath-Wright joins us now from Zurich to talk about this. Is that it? Are we done? I guess that's the question that everybody's asking themselves today. If we continue to see Swiss franc strength, what else can the SNB do?
I think it's an open question if we're done. I think this is very much a wait-and-see decision. If the SNB could have decided very freely, I think they would have opted for not changing rates at all, keeping them in the positive. However, they were not really able to do that because markets had overpriced actually on a 25 basis point cut. Investors were split on 25 basis points and 50 basis points. So if policymakers had actually opted to keep the rate unchanged, then you would have seen the franc go through the roof. And we already have the problem in Switzerland. It's pretty unique in this position. We have too low inflation. Inflation dropped to negative 0.1% in May. So this is just something which the central bank can't have. It's because imports are getting cheaper through the strong currency, and the SNB has a clear target to keep inflation between 0 and 2%. So they want to stoke inflation a little bit. So they were basically forced to this cut. However, we'll see what happened. They could go lower. They had negative rates in place from 2015 to 2022, and I think it is definitely not off the table that we'll come back there.
Bastian, they've kind of also introduced negative rates today. If I'm a bank and I have enough reserves on deposit at the central bank, I'm going to be hit with negative rates. Have we already breached the kind of the zero bound? Are we already in some ways into negative territory?
Yeah, we are kind of, because the SNB introduced a negative rate of negative 25 basis points, minus 0.25% for deposits at the central bank, which exceed a certain threshold which every bank has here. The reason for that is just that they want to make sure that we have an ample amount of interbank lending, that banks are giving the money to each other instead of parking it at the central bank. And so it penalizes banks if they park it, they park too much at the central bank. So yes, Petra Chudin, one of the rate setters of the SNB, has said in a press conference today that she expects negative money market rates from tomorrow. So we'll see a SARON, that's the Swiss average overnight rate between banks, trading slightly below zero, so maybe at 3 or 4 basis points into the negative. So yeah, you could say, in a way, we already have negative rates in Switzerland.
Bastian, thanks for the update. Really appreciate it. Bastian Benrath, right, joining us out of Zurich on what we've seen from the Swiss National Bank this morning. In some ways, actually, the surprise today came from the Norwegian central bank, the Norges Bank, which cut by 25 basis points. Let's talk about monetary policy and stocks and try and get an understanding of where we go from here. Clearly, the Fed is obviously the other factor that we need to throw into the mix. Leslie Marks, equity CIO at Mackenzie Investments, joins us now to discuss. Leslie, let's start actually with the Federal Reserve and figure out kind of what we learned yesterday. Powell didn't change the script very much a wait-and-see approach being adopted. What do you think is going to tilt the central bank one way or the other? Was there any hint yesterday on that front?
I think there was a hint from the central bank yesterday, and I think that hint was really the focus on inflation. And this is where the central bank has a different view than the Trump administration, which is very much focused on the backward-looking data, and particularly inflation. And in the context of the Fed, what we heard yesterday from their economic forecast is there's definitely concern that inflation is going to rise as a result of tariffs. And of course, that's into the future. We really haven't seen that yet. In fact, inflation has been surprisingly muted in the United States thus far.
Do we know where does the tariff hit come? And this is the bit that I think probably the Fed is still trying to figure out. We don't know yet whether companies are going to suck it up, whether this is going to be a margin story or whether or not this is going to be a pass-through story. Is the consumer strong enough to take higher prices?
Well, the most important thing for the consumer to be strong enough to take higher prices is that consumers continue to be working. And what we have seen on the labor front, the labor market has been, marginally weaker, but really overall has been quite resilient. So that's definitely the good news. To your question about, who's going to take price, businesses or consumers, of course, it's too early to see. But what we have seen so far is two things. The first is that businesses were able to stockpile inventories ahead of the most recent round of tariffs. So we haven't actually had to see anybody really take price in a material way. And that's what's showing in the inflation numbers, which, as I said, are backward looking. The expectation is that come around September or into the fourth quarter, that we will start to really see who is going to take price as those inventories draw down. And we think that most likely businesses will have to take the majority of price.
Does that mean investors, stockholders, will ultimately suffer as a result of that?
Well, this is definitely a concern. I mean, the consumer can take a little bit of price, but we don't see the consumer being able to take most of that price increase. And of course, it really depends on the goods that you're talking about. But when you're talking about necessities, things like clothing, food, these are the things that we think that consumers are going to have a harder time taking, because this is the area of the economy that is most vulnerable to price increases. When it comes to things like luxury goods, yes, you could see consumers taking price because that is an area that is not as susceptible to price increases. Those consumers will still continue to consume those goods. So you have to look at the bifurcation of the economy with respect to who's going to take price, whether it's, as you said, businesses and therefore shareholders. And this is definitely a concern for equity investors. I mean, this is really a big part of why we saw the massive drawdown in April and then a big recovery when the president moved to give a 90-day reprieve on tariffs while he negotiated with different countries.
So S&P closed today, 59.80 closing price. Is there anything that gets it up from here? I'm hearing lots of things that could get it down from here, but is there anything that gets it up from here?
Well, I do think that we're going to enter, or we're already probably in, a period of consolidation. We've had a very strong run, a strong recovery in the S&P. We've seen that across global equity markets. And so right now we have two areas of uncertainty. One is, of course, where we end up landing in the tariff front. As I said, the president and his advisors are currently in significant negotiations with many countries, but we really don't know where we will end up on those trade agreements. So that's one area of uncertainty. And we now have a second area of uncertainty that's entered the market, which is the escalation of the war in the Middle East, particularly with the threat of the United States entering the fray with Iran. And that has had a particular negative impact on, well, positive depending on how you look at it, but the price of oil, which is up 30% since the beginning of May. And that has introduced another level of uncertainty, not only for inflation, but generally for investors, where there is just a lack of predictability. So we think that this period is more of a trading range period and consolidation after the strong recovery in equities. Your question is really about what happens, that could actually be positive for equities. And we think that comes next. We think that heading into the end of this year, even into early 2026, you're going to see a real tempering in the focus on tariffs. And you're going to have an offset to that if the One Big Beautiful Bill Act passes through the Senate. And that will help to support the permanence of tax cuts. It also has significant enhancements on things like incentives to invest capital into the United States economy, such as tax deductibility. So we do think that there will be stimulus that will come from the One Big Beautiful Bill once it is approved through Senate, and also deregulation. So what we've seen is a lot of policy that has created uncertainty and negativity, as you rightly pointed out, potentially for businesses and the consumer. Later this year, we'll start to see some nice upward momentum that actually acts as an offset for those issues that we've been enduring throughout the first half of this year, and that could be the next move in equities.
Leslie, great to catch up. Thank you very much indeed. Leslie Marks of Mackenzie Investments joining us out of Toronto. Coming up, we'll return to that risk of a wider war in the Middle East. The Israeli-Iran conflict now in its 7th day as President Trump weighs U.S. involvement. We'll talk about what could come next. That comes shortly. This is Bloomberg.
To the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
In case you missed it, on The Pulse.
I think the idea of wait and see and pause is really yesterday's news. Our best advice to CEOs right now is that if you're not operating differently than you were a year ago, you may be falling behind. Yes, we need to build resilience, but we need to also build growth despite the environment, and that requires a different strategy than just a year ago.
Don't miss The Pulse, live every weekday.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/finds treatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/finds treatment.
Thursday the 19th, welcome back. You're watching Bloomberg Markets. I'm Guy Johnson in London. Let's talk about what is happening between Iran and Israel and kind of what could happen next and how the region is viewing the conflict. The Israeli military is saying that it's now destroyed 2/3 of Iran's missile launchers. This, as President Trump is considering involving U.S. forces in striking Iran's nuclear targets. Let's get an update from Dubai and some analysis on what could come next. Let me hand things over in Dubai to Bloomberg's Jumana Basechi.
Yeah, Guy, thank you so much. As we've been talking about a critical time over here in the Middle East, I'm really happy to bring in Nabil Fahmy. He is the former foreign minister of Egypt, to lend some perspective on how the region is thinking about everything from here onwards. Really good to have you with us on the show. Sir, overnight we've been reporting that U.S. officials have started preparing plans for military intervention in Iran as soon as the next couple of days. What are the implications for the region if the U.S. gets involved militarily?
Very dangerous, multidisciplinary, and complex. First of all, of course, the devastation and destruction caused by a heavy payload of engagement is the first issue. Secondly, if you're targeting nuclear sites, then the implications on not only Iran, but the regional states is, of course, a big factor. Thirdly, the reaction from Iran, whether it is against U.S. targets or against U.S. friends or bases, third issue. And fourth and fifth, we need to get back to diplomacy. The strongest, most important power needs to lead the way back to diplomacy. If it is engaging in use of force because of a policy difference, that is a very dangerous practice to pursue. The others will also pursue. Third and lastly, it is illegal by virtue of the Article 56 of the additional protocol of the Geneva Convention to attack nuclear facilities. So if they engage in attacking nuclear facilities, then that's a fifth additional point of major concern. I am seriously concerned about the next few days.
What is your level of concern about U.S. assets being targeted, specifically the assets that are dotted around the Gulf region, if the U.S. decides to intervene militarily? Iran has said that they will react and retaliate in a proportionate manner. Does that expose U.S. military assets in the Gulf?
According to what the Iranians are saying, yes, it does. The U.S. is strong enough, powerful enough to determine what it wants to do vis-a-vis its own assets. My concern is these assets are in the Middle East. Therefore, they put the Middle East on another level of tension and violence and destruction. And that is tremendously detrimental to the security of the region. We want peace between everybody in the Middle East. But this cannot be done using force. It has to be done by using forceful diplomacy. And I'm very encouraged, but not yet optimistic, about the call for a tri-European discussion with the Iranian foreign minister tomorrow. And I hope that opens the door for serious diplomacy.
Yeah, I'm going to ask you about that in a moment. But before we get to the diplomatic routes, let me just ask you whether you think regime change is actually a viable prospect in the near term in Iran.
Well, I don't know where regime change has actually worked before. And I would argue that even when it happened before, in Iran itself, by America, over 50 years ago, the ultimate result was the regime went more towards an anti-American perspective than a positive one. So let regime change be an expression of domestic politics rather than that of foreign politics.
Let's talk about the diplomatic angles. You reference the fact that the Iranian foreign minister, it looks like he's going to be meeting with European foreign ministers, his counterparts, tomorrow in Geneva to discuss the potential removal of sanctions, nuclear deal. What ramifications could that have on U.S.'s decision-making?
Well, first of all, I actually think that the permanent five of the Security Council have a responsibility to play a leading role in diplomacy. So that would include UK and France, but also the US, Russia, and China. But if somebody has an initiative, I welcome that initiative. If it comes up with some concrete, tangible results or pathways, it should help the US choose the diplomatic trend rather than trying to push the military one, which was, by the way, its original perspective.
Yeah, but one of the lines, the red lines that Iran put in these nuclear deal discussions was that no nuclear enrichment was just not going to be acceptable to them. Given their vulnerability now, and given the fact that Israel's military strikes have managed to strike into the heart of their defense systems, their military systems, and even their nuclear facilities, do you see Iran returning to the diplomacy channel, but also being more willing to accept some of the onerous terms that the U.S. are putting forward because they have no choice?
Let me put it this way. In principle, Iran, like anybody else in the region or around the world, has the right to peaceful uses of nuclear energy, including some enrichment. But there have been concerns about the Iranian nuclear program, and that's why you had JCPOA, and that's why you had the negotiations between Trump administration and Iran. So Iran has to be more receptive to trying to find a solution which removes the concerns, and that is by two issues. One, increasing transparency as to what you're doing, but also at the same time managing the level of enrichment that is undertaken. So I don't think it is an either-or situation. I think you have to deal with both, but I do believe that as long as Iran is consistent with its international obligations, it does have the right to a certain level of enrichment, but it can do that in a transparent fashion to remove the concerns.
Yeah. Sir, this war has taken the focus away from Gaza. We know that there is a humanitarian crisis on Egypt's doorstep as well. What hope is there of a lasting ceasefire in Gaza while this war rages on?
Thank you for this question. It's very important. My concern with this war, especially the Israeli attack against Iran, is that, again, it's an expression of one state deciding, I'm going to use force to pursue my objectives. That's not the way international order should be managed. That's not the way we should respond. We need to find political solutions, be they between Israel and Iran with the help of the US, or be they between Israel and Palestine. The focus now has been, for the last few days, on Iran, but we need to go back to the Palestinian issue. Let me also mention that I think today alone, there are at least the same number of people killed in Gaza as there were in the Iranian-Israeli conflict. So it may not be on the radar in the West, but it is in the Middle East.
Yeah. Sir, thank you so much for your time. Egypt's former Minister of Foreign Affairs, Nabil Fahmy. Thank you very much.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch the new Bloomberg Tech Europe. Premieres Friday, only on Bloomberg Television.
Thursday the 19th, welcome. You're watching Bloomberg Markets. I'm Guy Johnson in London. Let's recap some of the news that we've had throughout the morning. Remember, the US is out, so we're focusing elsewhere. We had the Fed yesterday. Today we're focusing on the Bank of England, the Swiss National Bank, what's happening at the Norge Bank. Let's get an assessment of the Bank of England decision, first of all, and try and figure out exactly what we have learnt or not learnt. We've got a 6-3 decision. There was an expectation that maybe actually the Monetary Policy Committee would vote 7-2, but Dave Ramsden decided he would vote for a 25 basis point cut as well. Nora Lally joins us now from our Markets Live team to give us an assessment of all of it, plus also the Swiss franc and what's happening with the Norwegians as well. Let's start off with the Bank of England. Like, kind of a surprise. The Bank of England has given us a little surprise. Sterling initially kind of wobbled a little bit, but we're basically back to unchanged.
Yeah, look, I mean, I think voting and dissenting is primarily the closest thing that we're going to get to a dot plot with the Bank of England, right? Because we've had Bernanke recommended earlier this year. The Bank of England hasn't really adopted that sense of forward guidance that we have from the Fed. So dissenting is pretty much the only tool that we have with markets. But here's the kicker. The markets were already leaning towards an August cut and them skipping today. We already have a general working assumption that the Bank of England is going to adopt a 1 cut per quarter pace. So it seems to almost anchor market expectations rather than surprise them altogether. The bigger story here, of course, is the earlier central banks this morning really turning more defensive in their decision in cutting rates and how the markets have reacted to that.
So you're talking about the Swiss and you're talking about the Norge Bank as well. Both cut by 25 basis points. The Swiss down to 0. We'll talk about that in just a moment. The Norge Bank has cut as well. That's probably where the bigger surprise came from. Is this a reaction to uncertainty? We don't know what's happening with tariffs, but we're starting to see an impact here in Europe. In theory, the Norge Bank should be facing a strong currency. It's not in many ways because of the impacts that we're seeing in the global economy, because of tariffs starting to have an effect.
Yeah, absolutely, Guy. And if you look at the Fed's statement yesterday, mentions of uncertainty really much higher than the previous statement. We're seeing just an increase of that general sense of unease from policymakers. And to be honest, that's the kind of reaction you'd want to get from these policymakers in the face of these uncertainties. You want central banks that are a lot more reactive, a lot more agile. And in that sense, then the currencies are just sort of rolling with the tides. And as you've mentioned, the Norwegian krone should be, in theory, higher because we are seeing that surge in oil prices on the back of those geopolitical risks that are developing in the Middle East. But that's not the case. That's giving us sort of a more general sense that you've got rate differentials differentials, you've got trade risks, you've got that haven demand really playing a lot more into traders' calculus as they bid into markets today.
The Swiss definitely have a problem of being a safe haven. At the moment, so much uncertainty. If you want to be long uncertainty, you either buy gold or you buy the Swiss franc. And people have been buying the Swiss franc. Is a cut to zero enough to stop that?
Well, look, some economists that have been surveyed by Bloomberg were actually expecting a 50 basis point cut today. So the fact that the Swiss National Bank actually went with a 25 basis point cut shows you that the market is actually gearing for a below zero new environment, right? And we're really rolling with the tides here. The general concern that the global economy is entering this sort of unfamiliar territory is really backed by these policymakers. You have China really struggling to stoke demand. Australia's earlier data today was also a lot weaker than expected, that the market is actually now starting to factor in a potential cut in July rather than a hike. There is a global movement that the markets are just waking up to now and really trying to not be caught on the wrong end of it, mostly because policymakers have shown in some countries that they're trying to go ahead of the curve. Yep. We've seen that from the ECB. The Fed also being ahead of the curve by staying a lot more cautious, right, despite that political pressure that we're getting from Trump. Bank of England, though, Guy, 4.25%. We're holding.
Yeah, we're holding. The Fed's holding as well, and I think that probably needs to be borne in mind as well. The Fed is like in some ways the statement yesterday really didn't change anything. Noor, thank you very much indeed. Noor Al-Ali joining us from our M Live team. As I just say, in so many ways, the message from Jerome Powell remains the same. The Fed leaving rates unchanged yesterday. The Fed chair basically indicating the economy is okay, it's in okay condition, but there's plenty of uncertainty. You've got the conflict in the Middle East, plus you've also got the tariff story to factor in.
Despite elevated uncertainty, the economy is in a solid position. We expect a meaningful amount of inflation to arrive in coming months. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but it tends to come down. The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are. The current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments.
But we don't know what these economic developments are likely to look like. That is what we've now got to try and figure out. Joining us now, Bill Lee, Chief Economist at the Milken Institute. Bill, great to catch up. What did you make of what Powell had to say yesterday? He is clearly waiting for inflation to show up. If I was to take anything away from yesterday, it's the fact that it did sound as if Powell was slightly more concerned about the inflation that is going to arrive from tariffs, and now we've got to fold in the prospect of higher energy costs as well. Is inflation the biggest threat?
Well, I can almost see Chair Powell biting his tongue and trying to avoid the standard economist reply, which is tariffs only jump the price level. They don't raise inflation. And he doesn't want to say transitory. So he's I think, just trying to give the impression that we are concerned, we may be wrong, but we think that we don't need to do much, but we're going to let the data speak for us. Because the data that has spoken so far has shown that the U.S. economy really is doing quite well. The cutback in retail sales is the consumer just showing that they bought up a lot of stuff earlier in anticipation of price increases. And the slowdown has been in the big items like appliances and consumer durables and vehicles. But the retail control, which is the other more regular elements of consumer spending that go into GDP, that was actually quite strong. So I think what Chair Powell is trying to give a sense of is we are aware of the risks out there, and we're not going to say anything until the data speak. And the survey data, the soft data, has shown that the world is concerned about the impact of tariffs. They may raise prices, but again, we'll see by how much and for how long.
How are you thinking about the potential for an oil shock as well? Because that's the other story that we've now got to fold in as well.
You know, Guy, one of the things about the oil market is that it really is reacting very differently to geopolitical risks than in the past. You know, if you find that there's an all-out war in the Middle East, prices would have spiked easily over $100 a barrel. Right now, we see them rising by from $65 to maybe $75, right? $10 increase, a very contained, moderate increase. And one of the things that you have to keep in mind is that now there's a big amount of reserves that are ready to come online, and a lot of it comes from the United States, but a lot of it is from the OPEC members. So right now, in some sense, the world is well supplied by oil, and the facilities in Iran is really not that much.
Yeah, but you could argue that some of those reserves are trapped behind the Gulf of behind the Straits of Hormuz in the Gulf, and were we to see a conflict, maybe that wouldn't be available, Bill, and so there's just huge amounts of uncertainty. So is the Fed just right to wait? Is that the right course of action at the moment? Because the president doesn't see it that way. The president wants to see significant cuts.
The president is a construction man, and there's no construction man you will ever meet who will not say that rates should be lower. So I think that bias in wanting to lower rates is in some ways a sense of frustration that his policies for restructuring the United States are really not getting put in place fast enough. The bill that's going through Congress right now that's supposed to lower taxes and ensure that the U.S. economy will have lower taxes and lower the cost of production that way is maybe passing and may not be passing. The smaller government has really, the DOGE efforts have not really paid off, and we have yet to see the deregulatory efforts on the part of the president. So the big policy packages are yet to be put in line, and to me, that's where a huge amount of policy uncertainty is, not so much with the tariffs, because the tariffs are really there to try to incentivize more people to invest in the United States, to partner with the United States.
Let's say the president changed the Fed chair tomorrow, and it's possible that we get an announcement on who the next Fed chair will be fairly soon. Let's say the market looks at that next Fed chair and goes, they're going to cut by 100 basis points, or they're going to cut by 50 basis points, or they're going to cut. What would be the impact of a Fed that cut by, say, 50 basis points or 100 basis points at this point? How would that? What do you think the implications of that would be?
Well, Guy, I think the surprise might be that if we really have a dove appointed as Fed chair, you're going to see maybe lower rates on the short end, but the long rate's going to start to jump. Right now, inflation expectations are pretty well contained, but if you get someone who's a well-known dove in that position, someone who's going to lower rates and keep them low as much as possible, regardless where the economy is going, then you'll find that the inflation expectations start to take off again. Right now, they're well contained, and 5-year break-evens are about 2.25. They actually are down from 2.5 of earlier. But once that picks up, with long rates are going to go up, and that'll really backfire and make the deficit situation in the United States even much worse situation to finance.
So the biggest risk to inflation right now in the United States is lower rates.
I think the biggest risk is appointing a dove that will unanchor inflation expectations. Right now, I think Chair Powell is doing the right thing to say we're going to wait until the data speak, and then we'll act accordingly. If the labor market falls apart, we'll lower rates. If inflation actually does take off and goes beyond that price level jump that we are anticipating, then we're going to have to keep rates where they are, or perhaps even raise them. Now, he won't worry. He didn't say raise them, but he certainly said to maintain current tight conditions.
Bill, great to catch up. Thanks for joining us this holiday. Bill Lee of the Milken Institute. Thank you very much indeed. Coming up, Google taking another hit after an advisor to the EU's top court said the appeal against a near $5 billion fine should be denied. We'll discuss that next. This is Bloomberg.
In case you missed it on the opening trade.
You talk to the airlines, they're watching what the demand picture looks like right now. At the moment, it appears that actually the demand picture is okay, but they're all worrying as well about what tariffs are going to do to their business going forward. Are they going to have to pay higher prices?
There's no question in the short term with what we've seen coming out of Washington and the political challenges of the trade negotiations. It's choppy.
We've got about a $500 million residual cost challenge as a result of those tariffs.
We have seen some softening, but it's rebounding a bit.
Things are steady. We're reassured that our premium demand is holding across all of our sectors.
They've got to just take stock and take a medium to long-term view as to what their costs are going to do, and then have a conversation with us as to what that may be.
Don't miss the opening trade, live every weekday.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. CFO Pascal Desroches has played a key role in restructuring AT&T, reducing debt and refocusing the business. Now his steady approach has the company primed for growth.
I'm a believer you try to make progress on big problems every day, and ultimately you'll look back and say, hey, you've come a long way.
Watch Chief Future Officer Wednesday on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
44 minutes past the hour, Juneteenth, that's why I'm here. The US markets are closed, but there's a few companies that we need to turn our attention to focus a little more on, and Google is one of them. So Google's antitrust fight. We've got a record 4.7 billion European Union fine coming down the pike towards it. They've been appealing. They're trying to get this reversed, but there's a major blow that has been suffered by Google. A key advisor to the bloc's top court has basically said the regulators were right to punish the tech giant for abusing its dominant position with the Android operating system, which kind of gives it all kinds of benefits, particularly in network effects. Charlie Wells has been covering this story for us. How significant is this? The Advocate General has made this decision that actually the fine should stand, and actually courts usually follow this piece of advice.
Well, that's why this is significant, and I think investors usually don't really care about every twist and turn of Google's antitrust fight in Europe. I think they're basically thinking, all right, another day, another fine, another development. This is a case that really for the better part of a decade has been winding its way through the courts. It goes back to Marguerite Vestager. Yeah. But what you say is really important to note, because this is the Advocate General, and basically what we know is that the ECJ tends to rely on those opinions. This is a non-binding opinion, but they tend to rely on the Advocate General's opinions when they ultimately issue their rulings, which could happen in a couple months. So this is actually an important one to pay attention to.
This is a final decision that's